the most beautiful things about this space. It literally doesn't matter what's going on in the outside world. The actual innovation space and the fund space is typically optimistic. No matter what pressures we're dealing with personally, overall, we're optimistic about what that actual future looks like. So, you know, today in setting up this venture and capital event, but the way we see this conference is there's two aspects to it. There's the exciting and the venture aspect, a lot of great technical companies that I'll go through in a second. And also there's the fund and yield aspect as well. And pretty much they've been the two biggest drivers of what we've seen over the last 12 months. Now, for today, we've got some incredible keynote speeches. I'll try and get that out. Some incredible keynote speeches as part of it. The first person I'm gonna give a bit more of an introduction to, which is Dr. Victoria Gordon. And you probably would have seen my email that I sent out last Saturday about why, you know, her and QBiotics have been one of the most important companies that Wholesale Investor has worked with. And you'll understand when you listen to her talk, you know, who she is doing and what their company is doing is transformational. We invite Ram from TAT Capital. Ram's an incredibly nice guy. I'm sure you probably all would have met him at some stage. You know, I really wanted to get Ram to come up and talk about the story of India. You know, I've got a few things that I'm excited about. I can't remember whether I was in a podcast or I was in a conversation with someone I really respect, but effectively they made this one comment and it really opened up my eyes. They said, India right now is where China was in 2006 to 2008. And when I heard that comment, I was like, okay, let's go all in. So effectively, I spoke to Ram about that. We did a podcast on it, which we'll be releasing shortly. But what's super exciting is when they talk about the India 2030 vision and everything they're investing in to get that, we're very lucky. We've got a lot of great people in this ecosystem that have been passionately working hard to build that gateway between Australia and India. And can't wait to Ram to tell that story. Dr. Stephen Moss, who's here as well, who's going to be giving a keynote presentation around the regenerative health aspect, a regenerative health project that he's been working on, but also some of the opportunities that come around in that space. When he first talked to me about this project, I was absolutely fascinated with, and I said, what I love about this space, when people bring me things and I'm like, I can't believe that people have been working on this for years and I've never heard about it. And you'll see that in some of the companies that are actually presented as well today. And then Llew, Drury, who I'm sure most of you all know, who's the founder of Sprint Ventures and also a family office himself. You know, incredibly nice guy, done a lot from an ecosystem perspective and an investment perspective. So a lot of great keynote speeches as part of actually today's event. Oh, sorry. And then the panel sessions. Now we've divided, you know, we've basically done the venture and capital theme on the two different panel sessions. So obviously we've put together an incredible panel session on the venture investment trend side. You know, you have a look at the lineup of the people that are participating in that. Very excited to have them participating today. And then also on the alternative investments with property funds and also private equity. So that's been a strong thing that we've been seeing with our database as far as from an interest perspective. And then there's going to be a fun fireside chat with me and Matt Allen, which might get a little bit spicy. Me and him had a sort of pre-call about that. And yeah, that should be a fun chat. And actually, I'll say that the conversation we're going to be having is how does venture investment change on the way that two different thematics have changed? Firstly, the bruising that many founders have taken on their own sort of preference shares over the last 12 months with having to do down rounds. And then secondly, with the role that generative AI plays going forward, how does that change the funding landscape going forward? And then what are the actual opportunities for investors coming out? So that will be our chat. So I'd like to say a big thank you to our sponsors and our partners. You know, Rocking Horse, if you haven't met Giles yet, make sure you go and meet Giles. He's going to be giving a talk today. The most relaxed, chilled guy you'll ever meet that's done an incredible job, not only building Rocking Horse, but also some of his other ventures as well. But he'll be talking about how companies can get access to their R&D financing earlier. Leone Hill, you said they're building an incredible technology platform for the tokenization of different sort of assets. They're also going to be giving a presentation today as well. Now, apologies, you probably noticed I've been losing my voice, as is always the timing, losing my voice right before one of our events. So as part of, really losing it. As part of today, obviously the actual app for today is sitting inside Crisp, so you would have received an email for that. Basically, just open up the app. Inside the actual app, you can actually network with all the other attendees. We've done our best to make sure that everyone is visible, everyone can be connected with everyone. That is the center point for everything today. The agenda will be on track inside the actual application, so you'll be able to see exactly where we're at for the day. So you can go to app.crisp.io to actually see that. Okay, now as part of with Crisp, one of the things we've done is we've tried to make it super easy for you to get access to the information that you're looking to from an investment perspective. So whether it be the recommendations for opportunities, whether it be the streamlined process, overview, etc. The matchmaking, so once you actually set up your preferences, it will match you directly with the most relevant opportunities for you. Likewise, as I said, it's just everything we've thought about is how to make everything simpler so that you can get access to the information you want and then also access to the opportunities that you're looking for as well. And then obviously we've integrated the conference software into the actual app as well. So the biggest thing I always say for this event, before I actually get into my talk, is that one conversation can change everything, right? Whether it be from an investee company in your portfolio or to one of the companies that are presenting today. That is why I do this. That is why I love this. And that is what inspires me, is that one conversation can completely change the trajectory of a business. The hard part is we just never know which one of those conversations it is. So today, make the effort to go around and network with everyone. And also, if one of the companies you see is not relevant for you, for your investment portfolio, then think about who it may be relevant for in your ecosystem of investors as well. How we build is via networks. It really does suck when you lose your voice the week of your own conference. So basically, I do want to give a passionate keynote speech on this, but it may be a bit dampened because of my actual voice. So we've been working incredibly hard because we think about capital raising in a different way. You know, we've thought about it from the perspective of how do we simplify it for everybody. And so one of the things we've thought about now, or one of the things that we've been working on, is how do we create an opportunity for the entire ecosystem to leverage off what we've built. Now, of course, you guys are used to actually coming here, accessing the opportunities, networking with each other. Now we want to take that opportunity to a whole new level for the ecosystem. So effectively, we've been doing this now for 14 years. And these are the things that we've got behind us as far as what we've been able to achieve, right? And it's very hard to replicate that. Every week I have someone telling me about a new platform. I don't care about the platform so much. Like, even though as much as we've heard, do you know how hard it is to build ecosystems? To build a three-sided ecosystem? To me, that is what makes this entire space special, is that most of you wear multiple hats. Everything we think about is creating an opportunity for tomorrow. Every presentation, every line of code, every email we send, every product initiative is all focused around that mission. Our mission is empowering innovation, capital, and ambition. That sits at the core of absolutely everything that we do, right? And the next phase for us, I said, obviously we utilize technologies, platforms, and partners to make that connection. But everything we think about is how to create international opportunities. So the next stop for this roadshow is actually Singapore, right? And then we're actually going to be doing something in London, because this opportunity is actually global in nature. And the common thought which we have is, well, how do you actually scale capital raising? How do you remove friction from the process? And then how do you do it globally? That is the fundamental thing that sits behind everything we actually think about. So then this was our solution, right? The Chris software that you're going to be playing with today, that you're going to be accessing the companies that is our solution to provide something which is integrated and end-to-end as actually part of the actual process. And if you think about this, you know, I've been showing this slide now for 3.5 years, and we executed this on March this year, the final part, which was making the entire ecosystem visible and contactable. So the three fundamental principles of how we build everything is, number one, build software that lets the ecosystem do what it naturally does. That's most important. Number two, the principle which we integrated at the start of this year is how do we help people monetize what we've actually built? How do we help the ecosystem monetize what you built, whether you be an investor, a founder, right? Or also an industry participant. The unique achievement that we crossed earlier this year is basically the productization of capital raising, which is actually one of the hardest areas to actually do that, because there's so much nuance and there's so much skill that's associated with it. But the key elements of what we actually deliver as a company, we've been able to productize. Now, those key elements focus around obviously the database, providing global investor access, where we did an API integration with Crunchbase to add over 200,000 investors, creating two-way AI ML-driven matchmaking, and also, most importantly, making the investor database visible, searchable, contactable, so that everyone can network with each other. And then integrating conference software, because fundamentally this entire ecosystem has been built off demo days, showcasing, and conferences like this. And then obviously the intelligent deal rooms is the last part, where having just access to data is not enough. Engagement is most important aspect of what it goes forward in the future between investors and also founders. So we've created a channel partner licensing opportunity, and it's really designed for whether you're an investor, right, that's looking to actually support some of your portfolio companies, or looking to add value to some of the startups which you actually come across, whether you're a business owner that actually works with a lot of companies in this space, private market opportunities that require access to capital, and then also industry as well, looking to add an additional product solution to your business. So effectively, we want you to leverage off what we've built, to utilize our investments in technology, in platform, in building our ecosystem, to basically monetize that as part of your own business. And for us, these are the key things which make what we do actually unique, right? Whether it be the investor ecosystem, the software we've built, the business systems and processes we're built in behind it, the conference capability, obviously the events that we run, and this is now across multiple countries and also online, and then also the access to the international networks. So one of the things that part of this we'll be doing is we'll be providing our channel partner and our licensees with access to our IP across all areas, from our business systems right through to how we actually invite and bring investors into our ecosystem, the marketing processes we use, etc., and everything related to capital raising and so forth. So it's really opening the door up for us to help, let the ecosystem monetize what we've actually built. And there's two approaches that people are often thinking about in this. One is a direct product offering, right? The second part is as a complementary offering to their existing business. And basically the next stage for us is most people know of us for the venture aspect, but obviously we've been working with ASX listed companies now for 12 years. We've been working with funds now for 11 years. But actually more importantly, WI will be repositioned over the next 12 months to be focused on private market opportunities covering the full spectrum. So whilst everyone knows us for venture, you'll see that we'll open up the doors to all relevant private market opportunities, because that is the big opportunity in here. And as you would have seen, there's the growth. And actually, I could tell you this, when I listened to Cameron from PEP at our last event, that absolutely opened up my mind about the size of private market opportunities and what that could mean for this entire space. And what I love about most of you is you're actually also active in this space as well. It's not just investment and then wait, it's also looking to add value to the companies that you work with. And for us, we want to facilitate that. And there's lots of different ways in which people can actually monetize that at different levels. And for us, it's really about empowering the ecosystem to actually do this on several layers. So to finish on this, I want to go through why I'm excited for the next 5 years, because let's be blunt, the last 15, 16 months have been absolutely brutal. I was having a conversation with someone. I think it was the hardest to raise capital over the last 15 months as what it was back in 2008 when I actually started WI. Like, I'll put it at that level. If anyone disagrees, happy to have a chat with you about that. But it's said that's how hard that. So then you think, well, why are we so optimistic? And for me, here's my 5 reasons why I'm super optimistic about what comes next. Firstly, the role that AI, software, and platform technologies can play. We've all experienced it now for the last, 7 months. It is absolutely life-changing, and it is just going more and more in that direction. The more we use generative AI, whether it be for anything we do, the more we follow the 20-year-old punks on Instagram showing us how to use AI is also fascinating as well, right? And for me, that's been an interesting lesson for me in how to actually expand my own business. If I could give you, another time in a few months, I'll tell our own journey about how we've actually incorporated this into our business and what we're planning for the future. But it is transformational from a scalability perspective. Then you've got the Bitcoin halving coming up at the end of April next year. We all know typically what happens around the Bitcoin halving period, what happens in the lead up to it, what happens after it. To me, this is one of the most exciting things, to have those two forces aligning around about the same time. Will be interesting to see what happens from a market, considering how depressed it's felt for the last sort of 15 months. It's interesting. It will be exciting to see how it unfolds, around that same time. The next one is the S-curve technology adoption. All these platform technologies like energy, and by the way, how cool is the different renewable energy technology? And I'll give a bit of a rundown of some of the companies here today as well. But basically, the S-curve technology adoption, a lot of the adoption is taking place, that early adopter, a lot of the platform technologies are taking place right now, right? And that means that basically the prime sort of uplift in growth is actually taking place at this moment. So that excites me. And then this one, Wright's Law. It's worthwhile. Do some deep diving on ARK Invest's and Kathy Wood's Wright's Law, and you can see that effectively, with each manufacturing output in these different areas, whether it be genomics, whether it be battery cell production, whether it be solar cell production, the cost is coming down significantly. And she does a whole thesis around Wright's Law on this. And likewise for us as solution providers, the more we actually scale our businesses, the cheaper it gets for us to do it. And this is what's exciting. And then the last one is the network effect. 2008 to now created all the different social media platforms. Over the last few years, there's been a massive explosion in the investment in data platforms as well. So now, whether you're a B2C business or B2B business, you can absolutely reach the world within 12 months. So if you translate that to what is the future scalability for companies, it is absolutely transformational. So for me, with all these 5 different things taking place at one time, it is super hard not to be excited about what comes next for the innovation space. And I'm just not surprised if 2 things take place. Number one, the same, if you think about the money that's been generated in the last 15 years in this space, I wouldn't be surprised if that gets generated in the next 5 years. Right? If you want a reference for that, go and have a look where the NASDAQ was in 2000, the NASDAQ 100 was in 2008, 2009, and then go have a look at where it is now. Right. And then the second one is I really believe some of the most profitable companies in history are going to come out of this period because of basically going back to the first one, AI, software, and platform technologies. So to me, that's what's super exciting about what comes next. So if you'd like to learn more about the sort of channel partner license opportunity, feel free to email me direct. You all have my email by now, or you can actually just give me a business card throughout today. So one thing I'm going to do before we kick off and before I introduce Victoria, I'm going to give a quick rundown of some of the companies, because I know you may not have seeing the agenda, but there's some really, really cool companies and some great innovations that are actually presenting today that I recommend to. So the first one I mentioned is Hone AG, who's just outside here. I didn't realize this, but basically, and if I articulate this incorrectly, I apologize, PJ, but basically I didn't realize that the protein levels in wheat crop make such a difference in the actual price. And I didn't realize the only way they could do that testing was actually in a lab. They've actually created a device where they can actually do it in field. And more than that, they've got Grain Corp as one of their backers behind it. H2I, building a solution for retrofitting hydrogen to diesel engines. You think about that capability for cleaner solutions going forward to existing diesel engines is phenomenal. Line Close Brewery are basically, it's almost like brewery as a service. How do you turn a brewery into a tech company? That's effectively what their ambitions are and what they've been doing, and really cool innovation behind that. Green Gravity, looking to convert old mine shafts into green energy providers. Like, how do you not love the engineering and the ideas behind this sort of stuff? AgLive, basically an end-to-end agri-tech solution, basically building end-to-end traceability and also monitoring. And they've also got large corporate customers as well as part of it. Tessera Therapeutics, building a discovery technology platform to assist in the discovery of degenerative brain issues, right, which affects so many people in so many different ways. Kinetics, basically got an innovative design for renewable energy that combines wind, solar, and also water. Myopharm, building novel therapeutics for metabolic diseases, for type 2 diabetes, and also obesity. Feasley, got a scalable financially modeling solution for property developers. Obviously, like there's a few property groups here today as well. Genius, providing clean energy technology infrastructure. Obviously, one of the biggest investments going forward over the next 10 years will be clean energy technology infrastructure. And then Verency, which is empowering sustainable finance with innovative climate tech and fintech solutions, got some big deals with some large corporates, which they can actually talk about in their presentation. So, and of course, we've got some great fund managers in the likes of Palace Capital here today, Quanta, and Arcana have all got incredible track records of producing yield for investors. And I know that's obviously a strong appeal for some investors right now. So that's my introduction. It's been a long introduction. I'm definitely out of time. I want to say thank you very much for coming to Venture and Capital. Now, to introduce the first person, I'm going to introduce Victoria Gordon from QBiotics. Victoria has been an inspiration to me. In 2009, as I said, when we were just starting WR, we were 6 months old, I come across Victoria. And I won't go the full, but basically all I'll say is at that time, that was the worst possible time to be a life science company trying to raise money. And we had this situation where one of my co-founder trialed their product on their dog, right? And this is an anti-cancer drug. And the dog was on death's door, and he watched over the next few days that the actual wound started cleaning up, it started healing itself, and the next thing it was running around like it was a puppy. And so that was transformational. And then for the last 14 years, I've been fortunate enough to watch the growth of QBiotics from a company which basically was struggling from a cap raising perspective to being, a near $500 million company. And the person behind it is also one of the most inspiring, because if everyone knows, life science is one of the hardest sectors. And to be that persistent, that globally focused, but also that protective of such powerful IP. But what she did is so inspiring in that instead of what people did before and how they'd go and try and do drug discovery just doing it in a lab, she went to the rainforest. And in that, she discovered so many different pathways to create platform and in the process created a platform technology to help across so many different areas that, whilst what they're most known for is their anti-cancer drug for like skin cancers and so forth, and also wound healing. But there is so much more potential to that technology that I imagine it could take 2 lifetimes to commercialize the entire lot, what they've discovered already. And so it's my absolute pleasure to welcome Dr. Victoria Gordon to the stage. And I can assure you by the end of her speech, you'll understand why what they have done has been one of the most important things that we've worked with as a company, and also why she's one of the most inspiring people to leave it. Thank you.
Well, good morning, everyone. And I must say a big thank you to Steve. Like, as Steve said, we came across each other in 2009, and I've been working with Steve and Wholesale Investors since then. And I can't see you with that in front of my face. And he's just been so supportive and so dedicated. And I must congratulate, sitting here watching this presentation, Wholesale Investors certainly, Steve's grown this company into something that really is fantastic. But on to my talk today. And so really not so much about the company, but I'm talking about the power of biodiscovery. And so unlocking the potential of natural resources. And in many ways, this is about innovation in Australia. We are quite fantastic at innovation in Australia, and we should all be very proud of what we do. So biodiscovery, what is biodiscovery? It's actually medicines from nature. And of course, this is really the beginning of the pharmaceutical industry. What became Bayer, the company Bayer, isolated aspirin from the bark of the willow tree, and then that was in the late 1800s, and that was the start of the pharmaceutical industry, and it started with biodiscovery. And as you can see here, there's some major medicines that we're still in use today. Most of them you will recognise, some of them you may not. Taxol from the bark of the yew tree, that's the taxanes, it's chemotherapies, and vincristin and vinblastin from the little Madagascar periwinkle, another important chemotherapy drug. And just to note, I'll be talking about small molecules, but these are actually natural product small molecules. In other words, molecules that we isolate from the biological system. So, okay, small molecules. So they're easy to manufacture, and they're often easy to manufacture. And often highly stable. So that means low cost of goods, and that means a good profit margin. And also these are because of the many aspects of these drugs and these drug potentials, they really are PBS favourable, or in other words, governments are happy to support these drugs. 45% of all registered medicines at this point in time was based on biodiscovery. So just note that for the next point. However, the biodiscovery success rate, now when we started the company in 2000 as a discovery company, there was still some big companies working in this space, GSK, AstraZeneca, but their success rate was extremely poor. It was really on average out of 1,000 collections, one of them may have some biological activity. And so the industry, and I think most people will know the industry, has actually moved to biologics. I think a good example of that is Merck's drug Keytruda. It's an immune checkpoint inhibitor for cancer. So we do have some fantastic biological drugs in the market at the moment. So why would we go back to nature? Well, the bottom line is the natural system is an extraordinary system, and the chemistry out there is quite extraordinary. So remarkable diversity of chemical scaffolds. These chemicals are actually produced in biological systems, and so their drug ability, or their ability to survive in this system, which is ours, is really quite high. Plants and animals share common biochemistry, and so most biochemical pathways that we find in ourselves are also in plants, but the output of those biochemical pathways, they're used for different aspects. Good example of that is serotonin. I think most people will know serotonin. It's to do with sleep and it's to do with mood enhancement, but in plants, it's to do with growth and reproduction. So small molecules, they're very much important regulators of these pathways, and there's some good examples down there. So biodiscovery is a good idea, really lousy success rate. What are you going to do about it? So Paul Riddell, the other founder of the QBiotics group, and I, we're former CSIRO research scientists. We were working on plant defence mechanisms of the tropical rainforest. So we put our heads together and rather than the usual approach, which was serendipity, go out into a natural environment, collect what you can see, bring it back into the lab and run it through a bunch of screens, we actually applied a knowledge-based approach. The natural system really runs on chemistry. Organisms produce chemicals to repel, to attract, to get at their nutrients. And so we thought, well, look, we understand how the system works, and so why don't we apply that? So we came up with targeted approaches to find plant material with specific biological activity, and we combined plant ecological attributes with really how plants and animals interact. And so our platform technology is ecologic, and that's 90% successful. So out of every 100 collections that we make, 90 of them have the specific biological activity that we're looking for. And that was really the start of our company. All right, we've got some good ideas. Where do you actually look? Where is the best place to look for these compounds? And that's our extraordinary Australian tropical rainforest. We call it the ribbon of green down the east coast, and we only have about 1 million hectares left now of our rainforest. But it's not quantity, it's quality. We actually have 13 of the 15 rainforest types worldwide. This is, and that really really high megadiversity in plants, and that equals megadiversity in chemicals. And so really that is the best place to look. And of course, Australia is the only country in the only fully developed, highly developed country in the world that has tropical rainforests. And so we have the legal and political infrastructure to support this. It's basically to support ownership and intellectual property protection. So Australia is just a great place to be doing biodiscovery. Plants are very clever. They actually don't, they need a chemical to do a job. They don't just produce one chemical. They produce variations on the theme. And This is an example of what it looks like. Steve mentioned our anti-cancer drug, originally called EBC46. It's now called tigilinol tiglate. And so what happens there is, what we've done is we isolate these, what they're called analogues, variations on a theme, and that allows us to work through how the drug works. It's called structure-activity relationships. What parts of the molecule are the bits that work? And so we can actually select and also synthesize or semi-synthesize products that may be better than what we've actually isolated in the plant. So it really is a great place to look, because it's not just the drug that you're working on, but basically you're potentially looking at extending the life of that through patents and new drugs as well. So we've got high biodiscovery, and this is a bit of a plug for the company as to what we do in our company. Because we've got all of this great pool of innovation, we do a very hard cull early on and push our drugs, really try to make our drugs fail early. And the best place to do that is not in the lab with mice, but out in the real world. Now I'm losing my voice. With real world diseases. And so we actually work in the veterinary space to inform us as we move into the human clinical development. But of course, these are potentially very valuable drugs that we're producing for the veterinary space. And so within the company, we basically have repeatable revenue because they're quicker to get out into the market. So small molecules solving major health problems. Let's have a look at cancer and tigilinol tiglate. And I'm going to actually run through some examples of what we've been doing in the company. So tigilinol tiglate is a small molecule. It's an intratumoral product. You actually inject it into the tumour. And I won't go into the specifics, but basically this is not a chemotherapy. This is a signalling molecule. Part of the action of this drug is what's called a protein kinase activator. I won't go into the specifics. But the bottom line is this drug works very quickly. Within 5 to 7 days, we see full tumour destruction. And then, of course, with tumours on the outside, you will be left with a wound or a pocket. The drug also stimulates healing of that site and very rapid healing. And so that's the local tumour that's injected. This drug also stimulates a systemic effect, and so it does run through the body and actually deal with metastasized tumours. It's very early in our development there, but we are seeing signs of that with our drug. So let's have a look at the canine world, or dogs, and dogs with mast cell tumours. We actually have developed this anti-cancer drug for the veterinary space. What you're looking at there is the FDA Centre for Veterinary Medicine registration trial. It's a phase 3 type trial. If you're not used to waterfall plots, the blue bits down the bottom underneath are the good bits. And so this is really quite extraordinary. With a single injection, we had 75% complete response or complete destruction of the tumour. Where there was a partial bit of the tumour left, we went in with a second injection that took that out to 88%. And this was durable, so no tumour recurrence with 89% of those dogs at 12 months. Keytruda, I mentioned, great biologic, great anti-cancer drug, but across the board, it has a 20% success rate. So this is really quite an extraordinary success rate. And this is basically what it looks like. This is one of the dogs from the trial. Pre-treatment, inject the tumour. Day 1, you're seeing the tumour vasculature break down, the tumour cells themselves breaking down very rapidly. Day 7, full tumour destruction. That was quite a deep tumour there, great deep pocket. Day 28, site's healed up, excellent cosmetic outcome. And so really that is our drug. Just some other more tumour types. This is a drug that's effective against a range of solid tumours. So just a few other tumour types there. Soft tissue sarcoma in the leg of that poodle, oral melanoma on the puppy's face, and down to myxosarcoma. And that is the dog that Steve was talking about in 2009. It's Steve's brother's dog. And as you can see, it's a CT scan. The tumour was fully filling the sinus area. 15 weeks later, not only is the tumour gone, but that sensitive sinus area was left untouched. And Stelfonta is tigilanol tiglate. It's registered and marketed as for canine mast cell tumours. We're also working on other tumour types in dogs and in horses as well. And so, nice potential for income there. So what about humans? We've in our safety study, we had some great results. The drug was safe. It basically well tolerated. We didn't declare what's called a maximum tolerated dose before we got a treatment dose. And this is an example here. This is metastatic melanoma, single injection into the first 3 top tumours, not into the 4th. And as you can see, what you saw in the dog, you're actually seeing in the human out to day 35, complete response. Still a little bit of healing to do there, but a really nice response in this very nasty disease type. But with this patient, not only were the tumours that we injected the drug into showed a complete response, but that little 4th tumour did as well. That could be a bystander effect. Also, a tumour in the lung and on the sternum also regressed as well, and that's the systemic or what's called an abscopal effect. So, this is an isolated chemical from the tropical rainforest doing really well. We are in phase 2 clinical trials, and we're working with global key opinion leaders and major hospitals worldwide. We've got a soft tissue sarcoma phase 2 running with Memorial Sloan Kettering in New York, and a head and neck cancer study running with some major hospitals, the Royal Marsden and Guy's and St Thomas in London. Certainly here, Kinghorn Cancer Centre. We're over in Wales. We're up in Brisbane at the Princess Alexandra. And Gustave Roussy in Paris is the largest cancer institute in Europe. And yes, great potential for the market for this drug. You know, we hear about, investment, and we've had some fantastic investment in this company over the years that we've been running. And what we're pushing for is a great return on investment for those incredibly dedicated and wonderfully generous and supportive people. So we've done cancer. Now let's look at wound healing. So wound healing. This is a very interesting area. The products are littered with mostly new changes on a Band-Aid. And so, okay, the major causes of industry, the major causes of serious wounds really they've changed somewhat. We're not quite stabbing each other or firing arrows at each other mostly these days. So from the 15th century, but the first-line standard of care has not changed. We're still using surgical debridement. We're still using bandages, and hey-ho, we're back with the maggots as well. So it really is a space that needs some attention. EBC 1013 is our wound healing drug in development, and this is a very interesting drug because it has the 3 major modes of action that is needed for a good wound healing product. It kills the bugs. It has an antimicrobial effect. It has infill of the wound mostly without scarring. It covers the wound. And this is a drug that we're developing for acute and chronic wounds and burns. The US military is interested in this drug, so it really is quite an amazing drug. We're kicking off with venous leg ulcers, and we are preparing for our first-in-human trial at the moment. And as you can see, this is a big market just in that one chronic wound. And here's an example of what it does in the veterinary space. The top is the top line of photos. That was a dog with a big tumour on the leg. It was removed surgically, and the vet could not close that. It could not close the area. The white there that you see is bone. We applied EBC 1013 in a gel 3 times, 7 days apart. Nothing else for this dog. No antibiotic cover, no bandaging. Day 19, you can see that beautiful infill, and as you follow that 8, day 78, completely healed, no scarring, and the pigment is coming back. The second set of photos is a burn on the back of this poor puppy. We saw the dog 8 days after the burn. Now, this dog was in for a lot of trouble, a lot of infection, a lot of scarring, etc. We applied the gel 3 times, 7 days apart. Just followed those pictures through. Day 38, pretty well healed up. Day 73, healed up, no scarring, hair grew back the same colour. We've been working on this drug with the Cardiff Institute for Tissue Engineering and Repair for about the last 8 years to understand what is going on here. They believe it's not just wound healing, it's site regeneration. We are also interested in this drug for the cosmetic application. So again, these marvellous little molecules from the tropical rainforest doing some pretty fantastic things. Okay, cancer, wound healing, what's next? We're actually looking at antibiotic resistance. Just a quote here from Dr. Robert Redfield, the director of the US Centre for Disease and Control. Stop referring to a coming post-antibiotic era. It's already here, and we really are in trouble. There's 16 bacteria now on a drug-resistant list, and in 2019, according to The Lancet, there were 5 million deaths associated with drug resistance. Scary times. Traditional approach to antibiotic discovery is to kill the bug, kill the bacteria, and unfortunately, widespread use, this is resulting in resistance. So what do plants do, particularly plants in wet, warm environments where bugs love to grow? They target virulence, don't kill the bug, but basically reduce its pathogenicity. And so this minimises the pressure for resistance. This is the approach that we're actually taking in the company. Unlike current antibiotics, the virulence-related approach reduces the potential for resistance, and so there's a greater opportunity for commercial life. New antibiotics that are being developed, they're basically being put on the shelf because just for the resistant organisms. And so we have some really interesting small molecules that we're working with at the moment. They're active against both types of bacteria, gram-negative, gram-positive. You may be familiar with the golden staph, MRSA, but also the gram-negative Pseudomonas aeruginosa is a real problem. And our little molecules are actually having great fun there. So that's us. I will say, a plug for Australia and our amazing natural resources. We just need to understand how to unlock them. So thank you, everyone, for your attention.
Thank you, Dr. Victoria. How great was that presentation? Good morning, everyone. My name is Shella, and I will be your MC for today. It is time to hear from some innovative companies in the industry. Please join me in welcoming David Vincent, Chairman of H2I Technology.
Good morning, everyone. Pleasure to be here, and thank you to Wholesale Investor for allowing us to present. So H2I Technology, who are we? We've come up with an enhancement system that allows the injection of hydrogen into diesel engines. So our focus is essentially to take existing assets and start a decarbonisation journey. So if we look at what we're focusing on is the multitude of diesel engines in the world today. There is a big push for decarbonisation, but we have to be mindful that everyone has currently very large investment in diesel assets. What we've looked at is how can we help companies start that journey, and we've come up with a system that in a simplistic way injects hydrogen into the air intake of a diesel engine and then allows that to react in with the diesel in the cylinder and give a much more efficient burn of the diesel. This results in up to 40% reduction in particulates from an environmental perspective, and also a reduction in the diesel usage commensurate with the hydrogen substituting for more efficient combustion. So essentially that can give you up to 20% reduction in diesel usage and also a cost saving on the whole exercise. So what we've tried to do is make it very simple for companies to embrace the start. I've had personal experience where, and I think exciting for the renewable industry, is that now you're finding boards of companies under pressure from investors, and I know there's a lot of investors here who are saying, what are you doing about decarbonisation? don't just write that you're looking at things, what are you actually doing? And what we're excited about at H2I, that we have a product here and now. And essentially showing you, this is our first of 10 live products, being the hydrogen injection system and the IP software that goes with it. And we're excited this morning, we launched that our first 10 units have now been made, of which this is one of them. And we're now starting our field trials out with selected customers, and we've had interest from around the world. One of our first customers being a group out of UAE that actually scoured the world. And whilst it sounds simple, inject hydrogen into the air intake, and some of it sounds not that novel. And again, I've had exposure with biodiesel 20 years ago, injecting CNG. So a lot of people say that's not novel, but having looked at what we've developed over the years, and nearly $1 million gone into it, it's the software and the IP side of it, how you inject it, that is really the crux of our business and what we think will be successful. So in relation to how we do it, we retrofit onto a diesel engine, the injection system, the software package. We're agnostic to the hydrogen. Obviously, in time, it might be green hydrogen, but we're working with a number of players where it can be standard grey, it can go into purple, turquoise. There's the whole range of different hydrogens. But for us, it's a matter of accessing hydrogen, typically now via cylinders, and that's injected into the engine. The company itself, we're established in Melbourne. All the IP is developed out of Melbourne. All the construction of the units is based in Melbourne. And we see this as a fantastic testament to what Australia can produce. And similar to what you'll hear from others today, I think Australia's at the cutting edge of a lot of renewable activities. And we're very proud of what our teams come up with. And the fact that we're getting inquiries from around the world, I think, is validating that what we've come up with is definitely of interest. So in terms of, obviously it's a venture capital show, the investment highlights. What are we offering? We're offering a here and now solution to start a journey for companies to allow a solid start in decarbonisation. We see it as a bridging solution. We're not saying that diesel will be around forever, but realistically it could be 10, 20, 30 years before you're seeing replacement to diesel engines, being whether it's fuel cells, EVs, and other technologies, and obviously hydrogen engines themselves. But right now, companies are looking for what can they do now to attract investors to say we've started and we can demonstrate tons of CO2 saving, starting to use hydrogen and eventually green hydrogen. And we believe what we're offering investors into our company is to share with us that journey of the interest around the world in what we're doing. We have a growing portfolio of IP with our team, which I'll talk to you a bit later about. Very strong in how we're developing it in-house. So we're taking the in-house route, certainly patentable technology, but from that perspective, we see keeping it in-house at this stage. In terms of the market, there are figures we put out. There's 20 million engines around there. I'm sure there's more than that, but we're being very modest. We're starting at a very low base, looking at maybe even just a couple of hundred next year, going into the thousands in the years to come, and eventually getting into 100 million plus revenue with commensurate profits attached to that. Just an example, as I said, we've got Dana International based in UAE. They're the largest steel manufacturer in the UAE with links into India, and we're ready to run a trial with them. We've been speaking to them this week about, with the box here and the others available, kicking off in September with a live trial. They run multiple diesel generators to run their steel manufacturing throughout the UAE, and have offered to take us into the whole of India as well, where you've got probably millions of generators there. We've had Rock Drill as an example, one of the largest drilling companies in Australia, very interested in starting a decarbonisation journey. We've had the Lizard Island Group with 4 generators on their island, again looking to have sustainable travel, sustainable hospitality, and again look at how they can also contribute to decarbonisation. In terms of I might jump to the hydrogen. As I said, we've got alliances with Pure Hydrogen, which will come into play with the green hydrogen. But in the meantime, we've hooked up with Coregas with an association. They're actually moving to the Turquoise, which is taking their steam methane reformer and using biogas from landfills to actually create the turquoise hydrogen. So we're very pleased to be associated with them. Now, a company is really the people involved. Yes, we've got some fantastic technology, but we have key people involved. David Marsden, who's here today, and you can talk to him after. He's one of the acknowledged people in Australia that is the most knowledgeable in diesel engines, decades of experience, and he's the one that's really behind how you can create and manage the software to inject hydrogen to make this whole system work. So we're very excited to have him on board. Kim Vaxman, who's our COO, high experience in logistics, and myself, I've been involved in the renewable industry for over 25 years, actually launched biodiesel in Australia, so I've had a long history in the renewable sector. So in terms of what we're here for, we're looking to raise money. We've kicked off a round with KS Capital, looking for $1 million to take us to the next phase. We have orders pending. We believe post those orders we'll have multiple upgrade orders, and therefore our aim is to get the funds in to grow the business, get more orders, and then eventually move in about a year to a listing on a suitable exchange where we would be raising money for an international expansion. That's it from today, and our booth is out there, so welcome anyone to come and talk to us, and if they have interest from both investment and also from using the product itself. Thank you very much for listening to me.
Thank you, David. Please join me in welcoming Martin Chin, CEO of Hydrogenous Energy.
Thank you very much. Good morning. Let's see down here. Thank you. So Hydrogenous Energy is about delivering zero carbon electricity on demand at a lower cost. We in fact want to eradicate the use of diesel for off-grid power delivery. I'll let you read the disclaimer at your leisure. I'll wait. No? Okay, this is the issue. There is a massive amount of diesel being used around the world for power generation. It's very expensive, and in particular at remote and end-of-grid locations. And a lot of that has to do with the transportation of diesel. So in the world, 700 million megawatt hours of electricity, as it says there, an awful lot of CO2 produced, over 500 million tonnes of CO2 and all sorts of SOx and NOx and bad things. And there's another issue as well. As more and more solar and wind comes into the market, there is an instability created in terms of firm power supply. We're looking to sort of address a couple of issues here. So we have invented, and it is our intellectual property, the first low pressure, low cost, easy to maintain stationary power generation system that runs on 100% hydrogen. There are other systems in the world that have been invented. Toyota announced one for a car the other day. Very high pressure, very expensive platforms. This is a deliberately low tech, low cost and easy to maintain platform. So, as I already mentioned, 100% hydrogen. Its response in comparison to any other power generation system to load changes, which happen in mining environments in particular, is the best measured. Instantaneous response is almost like batteries. It also doesn't need pure hydrogen, unlike fuel cells that absolutely are very delicate and can easily die with quality control issues with hydrogen. Our platform doesn't. It can run on quite contaminated hydrogen. And overall, our efficiency is actually already, at this stage, better than diesel or gas turbines or gas engines, and quite close to the efficiency of fuel cells. And we've got more to do. So long life, easy to maintain, low cost. One of the applications that we see, and we've been approached in relation to this already, is on-grid services where there are periods of unstable supply, I'll say. And in particular, we're working on a project in Tasmania at the moment that where our technology, with hydrogen produced and provided by the actual grid power provider, will solve this problem. So we've got some real near-term revenue opportunities. We're working with a company in Queensland at the moment that is making chlorine for wastewater treatment and water treatment in general, and the byproduct, the waste product of their process is hydrogen. They've approached us to help them capture the hydrogen and deliver power back into their business. This is a revenue-generating project that we can address right now, even ahead of fully finishing our R&D and our testing and our plans to deploy remote area power stations. One of the major fossil fuel oil companies, worldwide oil companies, has approached us to create a green power solution for their camp, even though their camp actually produces natural gas. But they want to be able to go to the market saying they're doing their best to clean up their act. And the inter-grid backup, I sort of mentioned it a minute ago about this opportunity in Tasmania. That's exactly what it is. There's a location that loses power for about 300 odd hours a year, and it's incredibly expensive for the distributor to maintain service there. So they're looking at a system that brings in power on demand, fueled by hydrogen, so it'll be 100% clean. So off-grid energy, this is our longer term plan. We plan to build remote area power stations to deliver solar, wind, electrolysis to produce hydrogen, storage of hydrogen at the site, and then through generator banks, deliver power back into the site. The whole idea here is to completely eradicate the use of diesel. In every measure that we've looked at, whether it's system size, utilisation, or primary contribution, by that primary contribution refers to solar or wind, we are the white line, we are definitely lower cost, and there is opportunity in there for significant margin. Margin means profitability. Profitability is what I hope investors want to hear. So project opportunities right now. We've been talking to various people in the mining market, a lot actually, it's actually more than 18 now, probably 25 discussions going on. We have a head of agreement in place with a silica miner in North Queensland to put in a smallish system, probably only about 250 kilowatt, to prove that our system can work before we then take the whole system into the market. There's also a huge opportunity in the remote community market. There is an awful lot of work going on right now, sponsored actually largely by some of the big mining companies and government, to build out new communities with great facilities and proper housing and everything modern, including the energy systems. And so we've been asked to put forward our solution to deliver clean energy. There's a huge opportunity in the Pacific Islands. We haven't even touched on it yet. We've really had one discussion, but the opportunity there is actually bigger than in Australia. And then, well, the rest of the world, well, that's a whole other story. There is just a massive opportunity in Africa and the rest of the world. We will get to that once we've done what we need to do to prove ourselves here in Australia. So risk. When we started, right at the very beginning on the left-hand side, we got some seeding revenue. We bought our banks of engines to work on. We rented our factory, did all that sort of stuff. And it took us a year and a half, but we have now fully developed that platform. And as I said earlier, it's the only low-pressure, low-cost, 100% fueled hydrogen-fueled stationary generator in the world. All right, commercial agreements. We struck an agreement a year ago, in fact, with a mining services company who are huge in this country. They want to take green solutions to their clients. We will deliver this solution via them. We're not trying to be a mining services company. We are an intellectual property developer that has a component that can then go into the service that is delivered by existing independent power producers and services companies. So the commercial pilot I already mentioned before, it's up in Queensland, and that will be involving that project engineering company. So this is why we want funding. We want to build out our demonstration and testing environment in Melbourne, which means buying electrolyzers, some solar, etc. We want to appoint a senior management team to take the company forward for the next 5 to 10 years and commercialise these near-term opportunities that I mentioned. They're there, they're ready to take up right now, and continue development. We want to go from this 100 kilowatt platform to a 500 kilowatt platform to a megawatt platform. These are the people involved. There's oil company experience here, there's mining company experience here, There's very strong experience in engine development, and our CTO, Peter Bruinstrup, is here today. Our booth is outside. Please come and say hello. That's it. Thanks very much.
Thank you, Martin. Please join me in welcoming Mark Swinnerton, founder and CEO of Green Gravity.
Thank you, Chanel. Really appreciate it. Well delivered, Martin. My name's Mark Swinnerton, founder and CEO at Green Gravity. I left my 25-year career in mining to take deliberate and direct action on climate change. If you want to invest in a company that's going to create software solutions and is going to try and reorganise the carbon emissions of businesses, this is not the presentation for you. If you want to take direct physical hardware action and invest in that change to switch out the world's oil and gas and coal fleet for renewable energy and low carbon energy, this is the kind of presentation I'm going to ask you to listen for the next few minutes and then come and talk to us at our stand right out the front there. I think you'll agree we have a problem. Despite the billions of investment and subsidies in renewable energy, how much do you think renewables represent of today's global energy mix? Only 14%. It is energy-based emissions that create more than 3/4 of our global emissions portfolio, and it is the energy-based emissions we have to tackle. So surely I'm going to bring you a new renewable energy technology. Well, not quite. I'm going to show you, you will see, that it is actually the scaling and integration of renewables that's our true need. We need to address the issue urgently. And you are going to see that we have an opportunity using latent infrastructure right here in front of us to make an enormous difference to the penetration of renewable energy in this country and around the world. And you're going to be amazed by a chart that I will show you with 600,000 data points on it that will demonstrate how we together here through Green Gravity can make an enormous impact and solve the problem. I was recently reading the Australian government's Gen Cost report that is an annual report telling us about the cost of renewable energy, and it says that standalone PV solar is the lowest cost of new generation at $30 a megawatt hour. So it feels to me the problem's already solved, except that solar only produces for 5 hours a day. If we want high penetration of renewables into our grid, we need to produce 24 hours a day. And so you get to the conclusion very quickly that energy storage capacity must be added to our grid at scale to enable the renewable energy transition. If you listen to the Department of Energy in the States, if you listen to McKinsey, they're going to tell you that we need $2 trillion of investment to 2040 in renewable energy storage. That represents a 400-fold increase in the amount of energy storage in our grids today. How much do you think the lithium price responded to that? Well, lithium price was up 500% in calendar year 2022. And in January this year, Elon was quoted as saying that the stationary energy storage business for Tesla is going to be bigger than their car business. How are we going to feed so much lithium into the system to be able to enable all of the energy, the electric vehicles with that lithium, but also at the same time, how are we going to displace all of the coal from the grid that we need to by firming the renewable energy? Surely we need more options than just lithium cells at increased scale. Which gets me onto mining. Do you know what they do with a mine when the ore runs out? 97% of the world's mines are sitting and waiting for rehabilitation. So how does our technology work? We have 3 simple steps. We charge a system, we wait, and we discharge. To charge our system, we take a legacy mine shaft and we progressively lift heavy weights through that mine shaft using a standard mine winder and a regenerative electrical motor. We then wait And when we want to generate electricity back to the grid, we progressively lower those weights back down the mine shaft, spinning the turbine and running an electric motor to generate electricity back. This system works with 80% round-trip efficiency. And because it's simple, it reuses infrastructure and has a long asset life, the system is low cost, with deep mine shafts delivering costs at less than half that of the lithium alternatives. And how much farmland do you think we need to convert for gravitational energy storage? None. We don't need any water resources, land resources. We have short supply chains. We don't need long hot chemical processes. And we do not need the critical minerals that are so often spoken about. Our technology is an all-rounder in sustainable impact. And who do you think is going to buy this product? Anybody closing down a coal power station, anybody closing down a coal mine, or anyone who has closed down a mine. We're working with dozens of mining companies and energy companies right now to validate the technology and to test. We are currently demonstrating the technology in the Illawarra, and by next year we will be demonstrating large-scale facilities in the Hunter Valley right near here. We have key technical partners, engineering and manufacturing supporting us. We have very strong traction. And where are all these mines located, I hear you ask? Not in the middle of nowhere. With 600,000 abandoned metals mines in the United States, the scalability of the technology is profound. As you can see here in this digital twin of our advanced test facilities in the Illawarra, green gravity has strong traction on demonstration and the technology is proceeding as planned. Digitisation is helping accelerate our technology and reduce the costs of development, and it's improving our speed to market, and we expect to be in market by the end of next year. Well, it's common for people to think that mine shafts are out in the middle of nowhere. This photo of some of the members of our team is taken less than an hour's drive from here. It's worth pointing out that 85% of the mine sites we've studied are already connected to the grid with latent grid connection infrastructure, or are extremely close, like this example. And this mine shaft right here is actually capped by a massive concrete cap, but that shaft in that photo is deeper than Sydney Tower is tall. So we're talking about real scale. With demonstrations proceeding as planned, we expect to make our first commercial investments in 2024 with up to 50 megawatt hours of capacity. We have 65 mine shafts currently in discussion, and we have 3 major pre-feasibility studies underway. We've previously raised $5 million of capital, and we're raising $12 million of additional capital in a round currently backed by an Australian major corporate at a pre-money valuation of $35 million. We are seeking investors today to join us on the journey to commercialise this technology quickly and take this to the world. We're leading the world in this technology. We are positioned in a seriously hot market with more than $2 trillion of demand growth to come, and where there are limited options and limited competitors. Our technology is novel, it's simple, it's low cost, it has incredible and impeccable ESG credentials. We have strong traction and capability, and our capital raise here offers an extremely attractive opportunity with a very reasonable pre-money at $35 million and a significant pipeline of projects to justify a very large future valuation. I'm seeking those of you who want to take deliberate action on climate change with real hardware, and I appreciate the time later to be able to speak with you right out there. So thank you very much. Bye-bye.
Thank you, Mark. Please join me in welcoming Carl Chamber, founder and CEO of Kinex Green Power.
Thank you, everyone, and thanks, Steve, for putting this facility on for us. Kinetic Green Energy is developed from my life in sustainability development. When you go to Sydney Airport, you'll find that, in fact, all the Qantas facilities are powered by what I obtained the 8 sustainability awards for, including the Banksia Award, which is Trigen. And Trigen was using natural gas to power a generator and we were getting 3 sources of saleable energy out of it. We've now developed on from that, and now what Kinetics has basically got is a means by which of solving whatever a lot of people are talking about here, the energy sector. And I should say this, the important opportunity that we need to do is look at what the cost resolutions are going to be forward for us. And that's what we're addressing. We're looking at how we can reduce the cost and provide 24/7 sustainable energy on a continuing basis. Now, we've got a small video here, and I'll talk through this, that will basically give you how we will do this. We're going to purchase pretty much used commercial cargo vessels. These cargo vessels will be repurposed and they'll be put into the ocean currents. And how I started with this, I've been a yachty most of my life, and in sailing off up the Australian coast, I'd bring my boat up and I'd put it up at Hamilton Island during the winter months. I found in the East Australian current runs down the coast of Australia that at times we'd be going backwards, especially off Cape Byron. We were doing 5.4 knots forward, but we were going two knots backwards. And this just gave me the first understanding of that particular energy, which runs 24/7. I then engaged with CSIRO that have been monitoring it for more than 40 years. And so we then looked at how we would develop that further by going to Thailand, and we used the Mekong River because the Mekong River runs at a velocity which is suitable for us where we want to plan to be, and that's in the United States. The reason for the United States is because in the Biden government's Inflation Reduction Act, which will give us 30% of our cost back within the first 2 years of our development. So we have got a cost of $30 per megawatt hour. We are basically providing a, what am I doing here? So we're providing a platform that puts out 15.4 megawatts of power. The wind systems we're buying, we're going to buy used wind. We can't wait the 7 years that's the delay to have those wind turbines coming on. We want to get to revenue quickly. And that means, in fact, we can buy these now. These are displaced machines and they're available immediately for us to be able to deploy them. So we're looking at revenue streams, and that's the important function here. We've got solar on our deck. We've also got, which hasn't been mentioned for a long time, is NiCad batteries. I was involved in manufacturing uninterruptible power supplies in my early days. No one talks about the fact that NiCad batteries are designed for 15 degrees C. When we installed them, and when we installed them at the MCG in Melbourne, we air conditioned the battery rooms. People in Florida are now air conditioning their garages for their EVs. That's not talked about. 15 degrees C. In the delivery cycle, I would buy them from Spain to come to Australia. I'd lose 10% of the energy out of that battery. You could look at that situation, but that is the reality of where we're heading. Now, with these systems, and in fact, we've, as I said, we've developed these. We're using what a lot of known technology. Solar is known. Wind is basically well known. The actual tidal generation industry is also well developed, and but it operates for only 10 hours a day. We're 24/7, and we believe we're going to be able to meet that particular requirement of energy as we move further forward. Now, the important facts are that we have already now been offered a public licence. I've had one before for what I obtained in what's called a power purchase agreement with Qantas, with an $87 million contract. And that contract was to provide the actual supply for Terminal 2, all the Qantas facilities, catering and the Qantas Tower. We're very proud about that fact that's operating today. When you go there, you'll have to think about something that my previous company did. We've also basically now had the Board of Investment. All of my investments previously have now been provided for in Thailand. Why Thailand? Thailand was the really Detroit of the East in the car industry. And so we aligned with a lot of the universities over there, the Thai Navy, the actual in colleges and universities. And when they talk about AI, we've been using AI for the last 15 years. The universities are amongst those 28 manufacturers of motor cars, including BMW, Mercedes, Peugeot, Renault, all of those are there. AI is now well involved. For 15 years we've been doing that. We couldn't do what we're doing without AI being involved in what we do. So we've got a professor over there, which is a lady, she goes by the name of Kate. She's the head of the major university over there. She's also looking and ranging for a lot of the PLC companies over there to basically become co-investors with us. We've got a very large co-investor in Australia who's introducing us to companies in the United States as well. On our board, we've got Lindsay, and Lindsay's worked with the government for many years. We've got John Patterson here with me today. He's been a venture capitalist for a number of years. I'll call her Kate, and Kate is basically the head of the major university, Kasasat in Thailand. She is now a director on the company and introducing us to the major organisations, including oil companies and major investment opportunities there in Thailand. That's my stepdaughter, Varchara, that goes under the name of Llew, and my son. My son is the investment director of ARENA. ARENA is the government organisation that decides on the funding for sustainable energy ventures. I won't take another grant, and I won't go why. I'm happy to say it privately. But he has basically given me a lot of what we're heading down the path of. He was the one that advised me the fact, when you get the peak power every evening, last night, the peak power goes from $68 to $334 a megawatt hour, last night. It peaks up to $15,000 between 5:30 and 7:30 often. They don't have an answer. The farmers in Victoria are not allowing the land to be passed over with the transmission cables. You saw read today that now in Italy and in France, the transmission services are the blockage. They're going to remain the blockage. The farmers won't be able to be compensated. It's already been seen in South Australia where the first wind farm went in. It took 4.5 years to go 170 kilometres. We're going to put 10,000 kilometres in. It's just something that only what we do. We don't need to have the transmission services. What we did at the airport, we could not dig up the airport runways and passageways. We did underground directional drilling. Underground directional drilling in Australia can go for 7 kilometres. In the US, they can do 14. And in Saudi Arabia, they do 38 kilometres. So the process further is the fact that we are now in a position where we want to try and get the funding. I've got a major investor, an $80 billion fund. We spoke to them last night, John and I did. They're very keen to work with a large PLC. I want some early cash to be able to go through the development and provide this product into the market. It's their first 24/7 energy opportunity. It's going to get traction. And the first order we get out of the United States is $2.4 billion for a 200 megawatt install. That's a PPA. Very understandable how and where we will get those. I thank everyone for listening to me.
Thank you, Cole. We have a very exciting panel coming up on financial year 2024 venture investment trends. Please give a warm welcome to our distinguished panelists, Amit Verma, Karen Chan, Isabella Rich, and Rajeev Gupta.
Hello. Hi, everyone. Thanks for joining us, this panel. Thanks, Steve. Thanks, Wholesale Investor. It's always good to come and speak to your audiences. Today, the topic, as was talked about, is sort of venture investment theme, but we're going to go a bit broader. We're going to actually talk about some macro thematics too that do impact what happens in venture capital. We're going to cover markets, both public and private. We're going to talk about, like I said, investment themes. But we'll also talk about growing need for liquidity, which is sort of on everyone's mind right now. And I have an absolutely fantastic panel with me here today, covering right from early stage to sort of growth equity to late stage and pre-IPO and crossover as well. So we're literally covering the entire spectrum. Let's do some quick intros first. Why don't I start with Isabella? Can you just introduce yourself and your funds?
Sure. How do I?
Are these mics on? Yeah.
Hello. Oh, it's now on. Thank you. Hi, everyone. Great to be here, and thanks for coming. My name's Isabella Rich, and I'm an investor at OIF Ventures. We are a venture capital fund based out of Australia that invests primarily in Australian and New Zealand technology, range from seed, Series A, and have just raised a growth fund, and have approximately 40 portfolio companies across the funds, all kind of technology.
Hi, I'm Karen Chan. I'm with Perennial Private Investments. We're part of the Perennial Partners umbrella of funds. We run a multiple funds mainly focused on the growth stage through to pre-IPO. So I'd say starting from Series B. And we also are a crossover investor, and part of our mandate is to invest in IPOs as well as selected listed placements. We've made over 90 investments and have also achieved a liquidity event for about a third of them, and really pleased to be here today.
Hello everyone, my name is Rajeev Gupta. Firstly, thank you to Steve and Wholesale Investor for hosting this event. I'm from Allium Capital, which is a 7-year-old fund. We do public and private investments, 70% in the private space, largely technology focused, like my peers on the stage. One of our key outcomes is to get companies to list on stock markets, and we've had success in the UK, Australia, as well as Canada and the USA.
And as was mentioned, my name is Amit Verma. I'm with the ASX New Listings, New IPO team. We work very closely with companies across technology, healthcare, and their investors as well, educating them on the sort of public markets and helping them list when the time is right and for relevant companies. Outside of that, I'm also with the A3 Investment Syndicate with A3 Explorers, and I'm also a mentor. I also mentor companies at the Founder Institute. So, and I think many of us also look at companies, investing into companies at an angel stage. So we do cover the whole spectrum. So let me just set the scene a bit for you all. So like I said before, we're going to talk about sort of investment themes, venture themes, but we're also going to talk about the connectedness of the venture capital ecosystem with the overall capital funding continuum. Venture doesn't exist in isolation. You know, what happens in public does affect early stage as well. So we're going to just explore that a bit. We'll also talk about, like I said, the need for liquidity, the growing importance of that, the ability to recycle capital into new deals, talk about areas of focus for these great folks here. And I would finally love audience questions as well. So probably when there's about, I don't know, between 5 and 10 minutes left, I'm going to turn to you all. So please have some questions ready. We always like audience questions. Sometimes the best conversations happen when the audience questions start. Right, so let's first talk macro. I'm going to start with you, Karen. You know, we're seeing positive signs coming from the US. A lot of talk about interest rates peaking, inflation potentially on the way down. The markets, you know, NASDAQ 100, S&P 500, ASX 200, etc. They're kind of close to their all-time highs, notwithstanding daily, weekly fluctuations. That happens all the time, but overall the markets are high. And we know that there's a bit of a lag that takes time. It takes time for that market environment to translate into activity in the private markets and new IPOs. So Karen, starting with you, what are you seeing out there? Are you thinking that we're turning a corner soon? What are you seeing out there with deals?
So I think right now, I think investor and consumer confidence is actually really important in terms of the psyche of whether we should be investing or not. And we really have started to reach a corner in the sense that we're starting to see rates moderate. We've also started the year out where we actually expected the indices to actually fall over the course of the year, but we actually haven't seen that at all. So just domestically looking at the ASX or ordinaries as well as ASX 200, that's up roughly around 6% year to date. And even in the last month, it's up around 1.5%. And from a deal flow perspective, it's been a real drought. We haven't seen much pre-IPO activity and hardly any IPOs. And so we saw Redox list recently, and it's actually now, I think, just above the issue price. So now it's like a $400 million IPO. So that's a sizable deal. So there has been good institutional take-up. And from our listed desk, we've seen in the last couple of weeks at least 5 non-deal roadshows. So we think that the macro environment has now sort of reached a turning point, and we're starting to see more deal flow. And I think this is really important because if you start seeing an unblocking of the liquidity pathway on the listed exchanges, then I think you're going to see that flow through to the private markets.
Rajeev and Isabella, I'd like you all to touch on the same topic because you'll look at different stages of the market and you might have different nuances and different experiences. Maybe Isabella, I might start with you.
Yeah, no, it's a really interesting market and one that we feel, I mean, if you look at the last 10 years as a base, you had a kind of normalized range of valuations and number of companies coming through all the way probably to 2021. And at 2021, you had a huge wave of capital that was deployed into the venture ecosystem at extremely high valuations. And what you see today is probably a normalization of that, which we see as a good thing, in that founders, we're seeing very high quality founders who have an understanding of how to build a software business because they've been at the Atlassians, the Canvas, the Go1s of the world. They're thinking about unit economics from day one, and the valuations are kind of on a median level in terms of the last 10 years.
Inflation will be sticky. It may go higher, but not much higher. Rates globally in most countries and economies are up 4 or 5% off the zero base, and most people have had 8 to 12 increases. We're not going to get 8 to 12 decreases in the next 2 years. We'll be lucky to get 1 to 2, so get used to higher rates, but they're still only between 4 and 6% globally, generally speaking, so it's not that high, especially for those of you that remember, and I remember I was at uni, it was 18% way back then. When it comes to making money investing in companies, you'll make a lot more investing in companies than you will leaving your money in the bank. So this period that we've had in the last 12 to 18 months is an adjustment period. If you look at public markets, they led the market down. So they started to retreat in late 2021, and it was a hard period for equity investors all of last year. Private markets lagged that. And what we're seeing now is that here on the ASX, in some stocks that were hot 2 years ago and fell by 80, 90%, some of these things are up 100, 150% only in the last month. So in our opinion, small cap technology companies and equity markets will likely lead a recovery for private investors, but it will be with a lag of probably 6 to 12 months, as it was on the downside.
You mentioned valuations, Isabella, and let's probably stick with that thematic. And not just valuation, but the overall fundraising environment for tech companies, for startups. Many of the founders who are here today might be interested in knowing two things primarily. How much money is available in the market for them? Because, of course, deals are taking longer or were taking longer. Some folks, some VC funds are fundraising right now. Some have raised large rounds last year. So how does that translate into that actual fundraising environment for them? What does it mean for them?
Yeah, so I mean, picking up on your point, from a venture capital perspective, we raised a fund last year off the back of distributing capital to our existing investors, and that's enabled us to continue to deploy over the next couple of years, which I think will be one of the best couple of years we've had to invest in early stage technology companies in Australia. In terms of from the founder's perspective, I would say that you only have to look around, to see the amount of dry powder there is in the Australian ecosystem. I think what you see is that there's a number of venture capital funds that have capital to deploy. They'll be deploying it more slowly than what we've seen over the last couple of years. What has kind of dissolved to some extent is the high net worth investor capital into kind of very early stage, high risk companies. And so you're seeing kind of that being made up by a number of pre-seed funds that have come into the market. But overall, you're exactly right. It's taking longer, and the requirement of getting towards profitability with the capital that is going into the company is far greater than we've seen over the last couple of years.
I'd also like to add that I think founders need to also think of value creation as a long-term journey. So you might feel like you're raising at a lower valuation than you would like, but at the end of the day, it is about survival and being able to continue to grow the company. So we think that just also when a company is looking to list, that's actually the start of the listing journey, and there's many opportunities to create that value over the long term.
Just sticking with that valuations theme, I've had a bunch of folks, talk to me across both the listed side, but also in the private space, asking questions like, we want to raise, but we're holding back because maybe we're not going to get what we want. So in your views, what's coming down the line for them? Of course, we don't want valuations to go to crazy levels like 2021. But do you think taking the cue from public, whenever it turns, what do you think is going to happen in the next 12 months with private valuations? 12 to 18 months, let's say that.
They've already started to come down, but they've come down slower than public did. In our view, they'll continue to go down probably another 40 to 50%, because most of these companies were valued, on metrics that just made no sense. Does everyone in this room, I'm assuming everyone's heard of this metric, the people talk about TAM, which is, it stands for total addressable market. Every company that we meet in private land that wants to raise capital has a ridiculous addressable market. They'll dominate the world. We've changed our tune. So for us, TAM stands for totally absurd metrics. Ultimately, business is about revenue generation and how you show profit. For the last 5 years, in an environment of zero rates and flush with liquidity, you can tell any story you want. You can say that you're growing from nothing to 1,000%, people believe you, and you raise money. It is not about that anymore. It's about fundamentally building a good business with a good product that generates good revenue and retention. So I think that is a narrative that has changed, albeit slowly, but I think it accelerates.
Karen, Isabella, any views on that?
I think it's a great time to be investing. I think, as Isabella touched upon, I think whether valuations will keep coming down, I'll be on the sidelines on that. I think it really depends on when a company last raised and what valuation that they raised at. So I think some companies would have had crazy valuations. We've got companies in our portfolio that, for example, raised during COVID in a sector that was out of favour, but have actually proved out very strong growth on the top line and also profitable now. So we think that if they were to go out today, they would get a much higher valuation than which they had previously raised at. So I think for all of us as investors, we need to look at each company case by case. And I think it's a good time to be investing.
Is there anything?
I would just say that, if there's a hesitancy around kind of different valuations or raising an evaluation that was less than your last price, but I would say to founders, look at the amount of dilution that you're taking from any potential investment, and does that return on capital exceed the amount of value that you're going to accrue in the future? And if the answer is yes, then you'll end up with a more valuable stake in your business going forward. So that's typically how I look at it.
I'm going to turn the conversation to liquidity now, but after that, I'm going to turn to the audience when we hit the 10-minute left mark. I've got a few more questions, but I'd love you guys to jump in as well. So let's talk about liquidity, as I mentioned earlier. I know a number of VC funds have already hit their 10-year marks, already started, doing continuation vehicles or getting extensions. Early stage investors want liquidity now. Early stage founders and early employees want liquidity. And Karen mentioned that on the ASX we did Redox a couple of weeks ago. Yesterday we had another really big, day before yesterday, another big one. Abacus Storage King. It was a $1.8 billion listing with about $225 million raise. So that was very good. And we've got a strong pipeline for the rest of the year. Mind you, for traditional, largish, profitable companies though, I think the non-profitable tech stuff will probably come next year. But for the rest of this year, we do have a strong pipeline of profitable businesses. I'm going to start with Rajeev. How do you think this need for liquidity is going to play out over the next sort of 12 to 18 months? Connecting both public and private. Because it's like I said, it's all linked, right? What happens in public and then flows down. So how do you think it's going to play out?
There's been a ton of activity even on the stock exchange. It was, you will know better than me, but $14 billion was taken off through strategic sales. I think that will accelerate. As that accelerates, there will be a need for more and more companies to become listed assets. So I think liquidity for many of our portfolio companies, we are encouraging them to go public at the right time because we're focused on technology. And to Amit's point, You need it to be profitable, generally speaking, in tech. We think next year will be really strong. Corporate and strategic sales will continue to be an important part of liquidity for investors. In addition, there's a ton of secondary that is out there, and you've got to selectively look at them, and you can have price negotiating power in some of those transactions. So I think there will be plenty of liquidity. We're strongly of the view you never want to own an asset forever. We're impatient investors. We want returns.
Can I just add that investors actually are now focused more on distributions rather than just a paper gain. And so I'm sure, Isabella, you can touch on this because I think OIF is one of the few VCs that have actually returned a lot of capital to their earlier investors. Like Allium, we're also focused on returning capital to our investors. So that's a big focus. And so we think that there might also be more secondaries because a lot of the funds are looking to return that capital. So there could be opportunities, and that is an area where you might be able to get some discounted opportunities.
Yeah, I would just add our first fund was a 2016 fund. We sat down as a team in the early stages of 2021 and said, how, what does the portfolio look like, and what do we believe the next couple of years have looked like? And for us to be able to raise a third fund, it was important that we distributed capital from early funds. So we distributed 3x back to investors to then continue to ask them to entrust their money with us. So I think it's really important, and I would just echo Rajeev's and Karen's point where there's, we said there's to be 3 types of opportunities to exit, and all of which, or 2 of which don't actually impact the founder materially. The first is secondaries, which, there's a number of funds that come in on top of us and invest in that later stage. So we exit through that in that respect. Secondly, there's kind of strategic exits. And then thirdly, there's the IPO channel, which we've looked at on a number of opportunities together.
Thanks, Isabella. And talking about that IPO channel, yes, we can't control the market. So right now, what we've been doing is, focusing on building the pipeline for later this year and next year. So if there are any founders or investors in the room that want to talk more about the public markets, please come and hit me up on LinkedIn or catch me later outside. Happy to have a chat, yeah. Right, we've hit the 10-minute mark. As promised, I'm going to open up the questions to the floor, and I would love to see a few hands. Perfect. Off you go.
What are the common characteristics of the management teams that you've invested in, particularly for the CFO?
The question was, what are the common characteristics of the management team, particularly in the CFOs of the companies you've invested in? Who wants to take first?
I think in general, we want to have CFOs that we can get information and good information from, being able to clearly articulate what are the growth and drivers of the business. At the end of the day, it's like a relationship. So from our perspective, we're minority investors. So we really do rely on the management team. So we do want a management team that we can trust.
So 2 comments. In terms of founder and CEO, we generally want the person to be very technical as opposed to marketing orientated. Red flag for us is someone who's very strong at marketing and weak at technical. And it's no different on the CFO. You want them to be a chartered accountant, generally speaking, not someone that's done an arts degree and knows how to use an Excel sheet. In addition, we look for CFOs that are strong at managing capital and can be involved in the capital raising strategy, not relying just on the CEO and founder.
So a few hands go up. Who is...
Yes, I just had a question about accounting. So you mentioned before that sometimes people tend to be over the top about how deep the role is. If you were to complement that in a business plan with standards on the surface called the capital market and the addressable markets, would that be a reasonable approach? Like say the standards of okay, avatar specific, this is how deep the role of the potential be growing. Like this is with our resources.
No, I was being facetious. It's always good to have TAM, SAM, SOM, but you're not going to dominate 100% of TAM. So you are dead right in SOM, and for those that are not familiar, TAM is addressable, SAM is serviceable, and obtainable. Yeah. We don't rely on any of those, but they do exist out there. But I think you're dead right. If you can get to SOM, absolutely. So you should show it. What it does reflect is you've got to understand the market you're playing in. And that's what it does do. So don't leave it out. Just don't rely on it.
We've just seen founders in the past just throw out a massive, like, billion-dollar number, but haven't really sort of engaged or thought about the TAM. So I think that's what you were trying to get at, Rajeev, right? Whether you've actually really thought about what is the actual market and is it big enough for you to actually take share in?
One thing on that I find really useful when founders, what founders do is there's a market that you can go after, and then there's the ability to sell products into that market. And the unit economics behind how you go to market then dictates A, the amount of capital that you'll need to access that, and B, how quickly you can do that. So, the way I think is really important to showcase, as well as the total market.
You raise a good point, though, because we've all looked at thousands of pitch decks, and to Rajeev's point, I hadn't heard of that acronym before, but I might steal it as well. I love it. We do see some absolutely crazy numbers thrown about, and investors often don't take a couple of slides seriously in your deck. One is that TAM one, because it's just everyone's always got a $5 trillion TAM. The other one is your revenue projections, which are always top to the right? I've never seen a revenue projection like that. It's always like this, irrespective. So I think investors want to see you, they want to hear about what your views on the TAM, SAM, SOM, but they also want you to have a very close understanding and relationship with your pipeline. That's more important. What are the sales you're going to close in the next 60 days, 90 days, 120 days? A deep, intimate understanding of that customer pipeline, as opposed to we're going to have 6 times our revenue in this time next year, which sounds not realistic.
And I would add to that in saying that there's probably a number of companies, could fit in one hand, where they've come to us and said, here is the deck that we presented to investors 2 years ago, and this is what we've either broadly hit the targets or exceeded them. And for that, that from an early stage perspective is very rare, and gives investors such confidence that you can execute, to the CFO's point, you can execute on the projections that you put forward.
Can I just also add an additional comment? A lot of companies grow at triple-digit rates for 3 years into the future. To Isabella's point, unrealistic. It's okay for a business to grow at 30% per annum, which is 5 to 6 times the GDP rate. But again, it comes down to, at that growth rate, how profitable can you be? A company that generates a net margin of 5% versus a company like Microsoft that does 36%, they should trade at different multiples. So for people to say, well, our multiple is 6 times EV to sales, it's almost irrelevant.
Yes.
My first question is, what would be the considerations of you co-investing with a principal out of Southeast Asia?
What would be the considerations for investing with a principal out of Southeast Asia?
I think co-investments. So I think all of us here are not buyout type investors where we want to take the whole round. So we are very much open to co-investing, and we have co-invested with actually many funds, as well as many family offices, some of which are offshore. So I think it really comes down to what the investor adds to the cap table other than capital, which I think right now is really important. But that connection and value add is an important consideration for the existing shareholders. Yes, so we do definitely invest across the cap stack. Convertible notes is one of the structures that has become more popular in bridging to the next round. If it's a pre-IPO round, it typically is a convertible note structure because it then holds the company to a timeline. So the pre-IPOs have not been as popular more recently, but we have seen a few more of those rounds actually starting to pop up more recently.
And in the early stage space, of course, convertible notes are popular, but also the other instrument, the safe notes, which are quite popular with the very, very early stage where pricing is just so hard to do.
I think, my only point on that is that I think a lot of founders come to us with to say we want to raise on a convertible note or on a safe so that we don't have to value the company today in an environment which is depressed in terms of where it was 2 years ago. But I would caution founders on that because if you don't execute perfectly, in a lot of instances, the dilution that comes off the back of that is actually far greater than kind of going out and raising at a priced round.
And then finally, on those two instruments, even though it's unpriced, most investors wouldn't invest unless there is a valuation cap. So there is an indication of sort of pricing anyways, yeah. Yeah.
Any views on CSF crowdsourcing?
Could you just repeat that a bit louder?
Do you have any views on crowdsourced liquidity, CSF?
Crowdsource. Who wants to go?
I think crowdsourcing is a great method actually for those companies, particularly say in the consumer space where they have a broad, retail customer base who can actually be part of the journey. I think the one thing to consider is actually whether it is more than one party on a cap table, because if you end up having thousands of people on your cap table, it can be unwieldy to manage.
Yeah, I concur. Consumer companies, we've had 3 that have done it. It's been successful. Just don't do it too early, and I wouldn't do it in the first round.
Is there anything to add? No? Cool. All right. We have exactly 1 minute left, so I think time for one question. Whoever raises their hand highest. There you go.
Hi, and Leo from Spruces. It's great to see the different stages of fundraising. I got a question. What is your biggest single red flag in the current market? Like when you look at potentially people pitching to you, and at the same time, and if I can answer for each very short, and at the same time, what's the magical word? And don't mind me if I take notes on that.
Biggest red flag and magical word.
So biggest red flag for us would be they come in, make a presentation, you ask them to send you things, such as the financial model in more detail or the customer list or contracts if they've got a data room, and they take weeks to respond. So they've been preparing it for you, which means they were ill-prepared when they came in. So that's the red flag. The magical word for us is liquidity.
Say lack of track record, but then promising the world. That's more than one word. And then magical word is profitability.
For us, we invest very early, and it's where there's kind of no product in market or kind of a couple of $100,000 of revenue, and a founder is paying themselves $750,000 and raising $1 million. So majority of the capital is going to go into 1 year's salary. And magical word for us is an awesome team. We're minority investors who kind of take an active role that we want to work with for the next 10 years.
I'm just going to flip it around. So red flag from investors to you guys. So if you hear an investor saying, who else is in the round? Just be careful. And magical word from an investor to you all should be, I'm going to give you all some money, but I'm going to help you with sales as well. That's really good, yeah? All right, please join me in thanking this fantastic audience. Thanks for your questions. Really loved it. And come and grab us outside if you want to have a chat. Cheers all.
Thank you, panelists. That was really insightful. If the audience have any more questions, please do not hesitate to ask them outside during lunchtime or during the networking session. Next up, we have more innovative companies making waves in the industry. Please welcome Brad Hill, founder of Limestone Coast Brewing.
Alrighty, good day everybody. I'm Brad Hill, founder and one of the directors at Limestone Coast Brewing. Thanks for sticking around. I think the last guys there were absolutely fantastic and really worth listening to. So, but I'm also very pleased that you're still sitting here listening to me. Ooh, okay. And how do I move forward on my slides too? I'm not sure how to move forward on my slides. Anyway, the mic's not on. It was just me. Can I have a little bit of help on how to move forward on the slides? I'm just not 100% sure. There we go, it's working. All right, I'll start that again. So thanks for hanging around after an absolutely fantastic presentation. It was really insightful to hear, and thanks very much, Steve, for putting on an awesome event. So I'm Brad Hill, I'm one of the founders of Limestone Coast Brewing, and I'm here to share a little bit about our journey, and it's quite interesting talking about profitability because right from very day one, we've run a cash flow positive business as we've invested into our growth. And so I'm here to share about how we're making money out of making craft beer. So of course, beer is a big market. You can talk top line numbers like $675 billion of beer consumed every year, but the craft brewery segment's about 12% now, and it's growing year on year as people are moving away from the mass-produced factory-style beers into the buy local, made local, and it's in that market that we play. Now, the cellar door is the heart and soul of the craft brewery world, right? It's where we interact with customers, we go through tastings. It's also where we make the most money. So at the cellar door, when we produce the beer, and this kind of spoilt beer a little bit for me when I learnt what sort of margins are involved, we make beer for 50 to 70 cents per pint. We pay about the same in tax. So when you're paying $12 or $15 for a pint of beer in one of the cellar doors, that's the profitable space. The interesting thing about that is that most breweries to scale up, they have a couple of really significant problems. So the cellar door itself, a lot of the floor space is actually taken up with the industrial plant. Now, there's a real opportunity cost here because the cellar door generally, if you're putting craft beer where people want to consume it, it's a high rent space. It's where you've got the opportunity cost where you're losing bums on seats. You're losing people paying that high margin. So you can have a hot plant produce cans and kegs, which, when they're sold out into the marketplace, you're only making 50 cents or $1 a litre. The second problem in there is that craft breweries only have one cellar door. And the ability to scale up and grow in the craft brewing industry has really been limited by cans and kegs. So this is where we've cracked the code. So we've developed a unique hub and spoke business model. We've protected it with patents, where we've split the brewing process between the hot and the cold parts. So the hot part is industrial. It's where we have bulk storage, grain, water purification plants, and the actual hot brewing plant itself. So what we do in the hot plant, and this is ours in Malaga, we make wort. Wort is unfermented beer. It's beer that hasn't gone through the cold process. It hasn't been turned into alcohol. And we ship that wort out into venues. So if this here right now was a venue, there'd be a row of tanks behind me, which are the cold brewing. But actually, let me show you one of our venues. And we have the video now. Yep, here it is.
One of Perth's most exclusive destinations, Point Fraser, has undergone a transformation and is fast becoming the destination to visit for great food and craft beer. And the latest arrival to this iconic location is the Long Neck Brewery. On the doorstep of the CBD, the destination is super convenient with free parking for the first hour during the day and free parking at night. Day or night, Long Neck is well worth checking out. Brad, it's a spectacular venue. You've really done an amazing job, and it's the perfect place to come and relax, isn't it?
When people come through the door, they feel like they've taken a trip down south, and yet we're right on the edge of the city. It's absolutely brilliant. What was really interesting when we first started here was actually getting our brewery approved to make beer here on site over the river.
You guys created your own special IP, some technology that's made the difference, right?
Yeah, so the technology actually splits the brewing process between the hot part of the process and the cold part of the process. In our central brewery, we do the hot part where we make wort. Wort is unfermented beer.
Yeah.
So it goes through essentially the whole cooking process. In Longneck Brewery here, over the river, we're doing the cold part of the process.
Yeah.
And this is where we add the yeast. This is where we dry hop. This is where we run all of those cold brewing processes. And we serve straight from these tanks. The flavours that you're able to get when it comes straight out of the tanks, and you haven't had to put it in kegs or cans and all that other logistics.
Well, as closest to the source is going to give you the purest, best taste, isn't it?
Absolutely.
Yeah. So how many different brews have you got available at any one time here?
We've got 18 different taps on right now. And out of that, we've got 3 seltzers. And so, again, we make those ourselves. So they're real fruit seltzers. We've got anywhere between 1 and 3 different ciders, again, that we make from scratch. And then we've got our core range of beers, plus we also throw seasonal beers and occasional beers in there as well. What makes us really unique, the art and science of brewing beer, the art is coming up and creating the flavours, but the science is being able to perfectly replicate them every time. We make the right water for the style of beer. We filter water down to its purest level, and then we add back the minerals true to that region or style of beer. And that is where that art and science merge. The best way to really work out whether this is a good beer or not.
Yeah. It's the taster. All right, cheers.
So, of course, there's hard parts of our job, isn't there? So we make those breweries for about a quarter of their capital cost. And that's something that's really interesting. I was just having a chat with a gentleman outside today who's building real estate developments, and he wants to have a craft brewery in every one. And so what I can safely say is that we've moved from a pipeline of five venues in southeast Queensland. I think we've just added another 4 today. So we've got some of the world's most advanced brewery technology. We wrote every line of code ourselves. This is bespoke, and while we've got our patent, we've also got deep protection in what we do because of our processes and our own intellectual property that we keep close to our chest. We've proven this business model in Perth. We've also brewed for other well-known brands. Particularly through COVID, we helped out some of our friends in the industry. So each of those hubs, so the hub you've seen in Malaga, it can look after 20 venues doing 100,000 litres quite comfortably. In fact, our capability out of that venue is closer to 5 million litres a year. And let's just, the maths in this business is really interesting. If we build a hub in every capital city and we put 20 venues around it, there's 140 venues. We'd love to do that. That's our plan. But our early stage of our plan, this is the maths. So if we're making, the sort of margins that I was talking about, and we're doing that many venues, we've got some nice gross margin. Understand it's gross margin, not net. I'm not saying we're that profitable. I'd love us to be. Next slide, please. So we're looking to raise 10 million to continue our expansion. That is to keep growing in WA. So when I was up here 2 years ago, we had 1 venue. Now we've got 5 currently, 3 more finished before the end of the year. We're delivering on the plan that I spoke about 2 years ago. And thank you for the tip in the presentation. We've got 5 new venues that we're at very advanced stages on our contract. And that includes funding to go and build those venues in southeast Queensland. And then we're looking to expand into Melbourne, into Sydney, and continue that growth. But all of that is with a mindset that we have a... Come on, next slide. Maybe the battery's going. Oops, there we are. But our plan is to create a liquidity event for our investors. We promised them a liquidity event when they first joined us. And so before the 10-year period where they're able to capitalise on there's a tax-effective scheme around that for them. So we've got a great team. Of course, every founder has a great team, but we've been together since right at the start together, and we've worked our way through it for 7 years. We've won lots of awards, which has been fun along the way. Importantly, we know how to execute. So my invitation here is to come and say hello, learn more about us. We're actively looking to grow, and then again, we're going to continue to look to raise capital as we grow into the future. So thank you very much, everybody, for taking the time.
Thank you, Brad. Now let's welcome Peter Johnston, Managing Director of Horn.
Thank you very much, and hopefully I don't have as many challenges with the clicker. Brad, I'm worked in the grains industry, work with barley, and I absolutely love beer, so you're a hard act to follow. All right. Okay, so everyone's heard the old adage that you can't manage what you don't measure. At home, we believe that better measurement leads to better management. So what we've done is actually taken existing science in spectroscopy and developed a handheld spectrometer that can be used in agricultural applications. So we're able to manage grain quality, looking at various protein of grain, as Steve alluded to in the opening, that different qualities of grain get different pricing. And we're also involved in the regenerative ag market. Our devices can also be used to measure soil carbon. So if you think about it, all these projects with regenerative, looking at carbon sequestration and the like, they have no value unless you can actually measure and validate their technology. So if you think about where we actually play amongst the data sea, we're very much about creating the core data that feeds into the decision enablers and then onto the insight engines. Now, it was made mention on how important generative AI has become. It has got an absolutely insatiable appetite for data. Those that are creating the data that drive to better decisions will be there for the long haul. Now, why are we going for agriculture? Well, without being political, a few things are happening in the Northern Hemisphere. Russia invaded the Ukraine. Why? How many people does Russia feed in a year from an export perspective? 440 million people. That's a huge economic parcel of grain, and more to the point, it's a huge amount of influence. The other thing that's happened globally is farms are getting bigger. So the mum and dad operations 20 years ago is no longer that. They're multifaceted, highly detailed, complex, and also data-driven businesses. So as they've got bigger, and I'll use some analogies for you. So when I was on the farm about 15 years ago, I had a header and it could take off 20 tonnes an hour, and I thought that was great. You can't buy a header in Australia that can't take off 50 tonnes an hour. So my ability to harvest the grain, deliver it to a site has dramatically changed, and the availability of transport isn't there. That has resulted in the rapid expansion of on-farm storage. On the east coast of Australia alone, there's 17.5 million tonnes of storage. To put that into perspective, GrainCorp, the largest bulk handler that I used to work for, caps out at 13.5. So all the decision points, all the data points that the bulk handlers need to do to preserve quality in the supply chain now have to happen on farm. The other thing to consider is we also can measure nitrates. Fertiliser costs equals an energy cost. It's absolutely astronomical. So farmers are reducing the amount of fertiliser they put on and adding to it through the season. But the challenge to get a wet sample of harvested crop, send it off to a lab that's a long way away, wait 7 days to get an answer, your decision window has already been lost to actually make a decision on how much fertiliser and whereabouts to actually put it. And the third part of it is we talk about carbon offset sequestrations, about healthy soils. Healthy soils are profitable soils. I've never seen a government come out with a carrot to say, hey, you can sequester carbon and we're going to pay you all these fantastic offsets, without the stick coming soon behind it saying, look, if you're going to farm, to maintain that social licence, you need to prove that you're not actually reducing the amount of soil carbon. So what is it? It's actually a real thing. So it's actually, we've got one here today, we can play with it, we can see if we can break it, all that type of stuff. So it's not vaporware, it's actually a real tangible product. And essentially what we've got out there is a device that can measure grain, it can measure feed quality, so you look on the back of the cereal box, you know how many megajoules of metabolizable energy or protein that it's got in it. We can measure those types of things. Because if you think about it, grain quality is determined by three aspects. Where it is, i.e. destination to where it's being consumed, Availability, can we get access to it? And that's about time. And the third part is quality. So the whole international grain trade is reliant on knowing what that actual quality is. On the carbon side of things, we're actively involved with the CSIRO, the Clean Energy Regulator. We've been granted a $3.2 million grant for actually validating our technology as a baseline testing throughout Australia for the issue of carbon credits. This puts us in a lead position where we lead industry and actually hold a position based on our relationship with the with the CSIRO and the Energy Regulator. So, what makes us different? First of all, we're not a hardware company. I would love not to be building spectrometers. Love it. Where the secret sauce is the fact is with the expansion of cloud computing and the like, the spectrometer catches the raw data. That raw data is punted off to the cloud where we can process it in absolute detail with resolution that enables us to get accuracy and repeatability far more than the traditional desktop-based lab equipment, because essentially it's desktop-based, i.e. the processor is limited by whatever board's in there, where we're actually using the power of the cloud to bring that capability through. The other thing about it too is we do have a platform where you can get that, but we're partnering with existing ag platforms out there. I think we've got an ag platform following that's going to talk about carbon. We'd love to partner with you and have you display the data. We actually want to be the people that are pivotal providing that core data. Timeline, we're a bit of a tortoise versus the hare. We've spent a lot of time in the R&D. We've spent a lot of time examining lots of different verticals that we could go down. We could apply this in medical science. We could apply it in a lot of different avenues. But doing the tough stuff first is what matters. Ag is low margin. It's a ruggedized environment. Do that right, do that first, and we believe that we actually have a real value to create. So I am going to throw it out there with the Sams on. Don't shoot me, anyone. Okay, real figures, 20,000 Australian grain farmers. I know I used to work for GrainCorp for 9 years. Of that, we know through ABARES figures that 14,000 of them have on-farm storage because of that problem I said. They've got bigger headers and they can't deliver it away fast enough. They had to build it. It was a supply chain related issue. And essentially what we're saying is that 6,000 farms we know have got greater than $300,000, 3,000 metric tonnes of storage, which equals $1 million. At $1 million, the total cost of our device is $8,000 plus $2,000 per year, recurring revenues. At $10,000, you can pick up 1% in value of grain just by knowing what silo to put it in. Therefore, from day one, it's a cash positive investment for farmers. I'm out of time, so I'll whiz through very quickly, and if I can. So we've actually, closing out on a safe, once again, another dirty word. We've already got 2.25 in. That's capped at 3 million. Love to talk to people after this. Thank you very much for your time.
Thank you, Peter. Please welcome Jara Johnson, CEO of EggLife.
Hello, everyone. So I'd like to talk to you today about EggLife. We're a public unlisted company, started out in Geelong, and we're really tackling the industrialised food issue. So using traceability as a platform to differentiate good ESG and sustainable quality farming products. So you're welcome to scan the QRs as they come up. That'll give you a few ideas that you can take home. We're on table 11 here, so very much welcome a chat after today. So myself, I've been in supply chain for some 20 years. Very much, again, it's about joining the dots on international trade and data and shipments. But I really believe that with our business, we can get a reward back to farmers that do good, green, sustainable practices. So very much incentivising sustainability. I've got Paul Ryan, co-founder, who's with us today. He previously ran GPS tracking business. We merged with that some 4 years ago. And Paul has a farming background, so can really understand the plight of the Australian, also the American farmer that we're now talking to. And Mark Toohey, the other co-founder, very much from the crypto blockchain world, professors at Sydney Uni. And he ran a business called SX3, which we merged with. They build cryptographic apps, blockchain platforms. So You can imagine where we're going with this. We want to link that farm and environmental data through the blockchain to products. We've traveled to the US last year. We've got around 27 ranchers that are willing to join the program in the US. And I put this slide up to sort of show the emphasis on the problems, which are very real in most markets for beef and livestock, but certainly extreme in the US. So we've really disconnected the farmer from the quality of their product. They're not able to trace that through to the consumer. And, you know, I can be quite dramatic with America. You can imagine those 100,000 animal feedlots. The farmer's doing great genetics, great animal husbandry and land management, but without any traceable system, and they have no national system in the US, they take the cow down to the monopoly and they get sold for burger patties and sausages. So you can imagine in Australia, you know, 85% of the beef is exported. In the US, they're just servicing a low-cost commoditized domestic market. So what we've built in Australia is an ability to track that ear tag through to the steak and take it to export. In the US, we're looking for funding to scale up, build a light version over there where your farmer can get access to high-end consumers and export markets. Greenwashing is huge, same in Australia with often with the indigenous products. How do you prove with evidence-based data where that product came from, that it has those green attributes? And you're seeing at the moment, the last year or so, a lot of suing and counter-suing where people are vying to say, where's the proof on your green credentials? So we don't sell beef, and we certainly are just there to pick up the data and prove where that beef comes from. But layering that with the environment can really prove those ESG credentials, and that's effectively what the consumer wants. So we've solved this issue around isolated data, plugging in through validation systems. We've got, for example, oracles with the Angus Breed Society, so we can see the genetics. We've got 21 APIs and IoT integrations on the farm, so you can pick up the water, the weight, the movement of the cattle. And again, for farmers, they really want to see all that in a management report, understand the value and the quality and condition of the animal. So we're really just joining the dots, but then carrying that past the farm gate. So there's a lot of software, a lot of IoT, a lot of apps on the farm. We carry that data past the farm gate onto the product and out to the supply chain. So we've broken the weaner sales record in Australia. We've topped the auctions for Angus Verified, which is, again, a software that we've deployed some 2 or 3 years ago. So for 21, 22 and 23, we're topping the market. We're now seeing $5,500 per animal. And that just brings up another interesting topic. If you can see the value of those animals, you can be sure that they're unique, they're not sold, that they're in good condition, then we can bring that data to financiers. And green finance is out there in a big way. They have the same issue. It's hard to then justify or prove which farms are green operations. So we're getting great yield by proof of genetics and quality, but in the future, that data will be very valuable to sustainable finance. Here's a little video, and I'm just looking now from the labelling and customer perspective. We've got a showcase customer in Gloucester, New South Wales. They have 3,500 Angus, and again, as an Australian producer, almost 90% of their product goes to high-end markets in Asia and the Middle East. So a small video here. It's only a minute.
Maccas are very proud to be working with industry leaders such as AgLive. AgLive are offering us the solutions that we need to supply our quality product to the world. Because when you go on that world stage, you've got to have a story, you've got to have traceability, you've got to have consumer trust. So together, Maccas and AgLive are delivering the quality product that you deserve. We've developed a smart label system that can't be copied, that can't be duplicated, that has the ability to tell the whole story from producer to plate. Because if you know, food fraud is a massive cost to the world economy. There's so many businesses out there that are being masked by copycats all around the world. And Australia is focused on delivering a quality product to the consumer. So now, when you go purchasing quality Australian products, you should ask for the AgLive traceability system, because AgLive gives you the trust that you deserve.
There we are. So why blockchain? We've built private NFT exchanges in the past. We just won in Dubai the best paper for tokenizing cattle and taking that data through to tokenized cattle. Blockchain gives us a great record of evidence and a place to bring various data sets together in one place. And most importantly for us, it's an ability to attach events and information to an identity, that being, in this case, the cattle and the cows. So we plug in to that identity information from the farm. Again, we've got 21 integrations, but it could be water and weight. The farmer obviously wants to know the commercial value of that herd and how they're growing. And again, to the financier, we can prove the location, what those animals are eating and what condition they're in. Here's just an example of IoT on the farm, but you can see a digital weight scale that tracks the animals in. We combine that with GPS ear tags so you can see where the cattle's moving. In this case, this is Series Tag, a great Australian tag. They send you some really good information about the activity level and the GPS coordinates. But as you can see here, we overlay that with Google Maps. We create geofences, and the farmer then gets a text message when the bulls jump the fence, for example. But there's a lot more to it in terms of the environment. Could be water, Asparagopsis, seaweed and methane reduction programs, the feed, what the animals are eating. And if you look at those QRs or come and visit us, we can show you where the genetics and the environment bring real performance. Our showcase customer Macca's was on Landline just yesterday or the day before, and they're getting 36 kilos extra per animal. The animal's eating from diverse salad out there in the field, so they're retaining more water, more biodiversity, better carbon outcomes. But the animals themselves are putting on 30 to 40 kilos, same paddock, a year later. So you can imagine the extra yield for the farmer, and it's a really provable and good sustainability story through to the consumer. So if we're layering that environmental information, and again, I can go on and on, but we've got satellite agronomy, vegetational mass, soil samples, all this layered with the livestock is the true nexus of the value of that farm and their output, what yield they can get. Our partners and programs as well, we use much more of the animal. So we're looking at the hides for collagen. We've built the first fetal bovine serum traceability. So that's the fetal blood, which is huge business for cell and plasma generation. So we're layering now the environment and the ear tags, which we believe when we're talking to government and industry, where that can layer into the blue chip carbon credits and the ACCU scores for producers. Macca's is now, and that's why I was on Landline 2 days ago, he's now carbon neutral to the farm gate, one of the only beef pastoralists to achieve that. He's done that without consultants by bringing all the data, evidence-based data to one place. And that really opens up new access and markets. Our customers are winning contracts with Donata and airlines because of carbon neutral beef. And again, whether it be corporate or the food-based industry, everyone wants to be able to prove that they've got the green tick and they're buying a sustainable product for their consumer. The data is very valuable through the process, and that little QR there is the fetal blood. From a scalability point of view, we are picking up these inputs and automating the output. The QR you see on the blood serum is automatically generated. It's a tokenized QR, so it's unique. It picks up the property, the parent, and then even in the lab, it picks up endotoxin, temperature, whatever data we want to tip in. That's all created on a unique web page, unique token, and the QR that you see there. So highly scalable. And if you look at a business like that, it's an 86% margin. And they are signing up abattoirs left, right, and centre because, again, the big companies like a Thermo Fisher or a CSL, they want to prove they're buying Australian blood rather than sort of Brazilian imports. So very much we're working with companies that have a mutual interest to better the life for the farmer and the consumer. Example of that is Gallagher. We have a global integration with Gallagher, 70 countries. They're one of the leading cattle scanning equipment. Now, we work with them. They give the farmer fantastic hardware and visibility, but that data doesn't travel past the farm gate. So to give you an example of where we've gone over the years, rather than pushing our app and software, sign into Gallagher, single sign on to AgLive, we pick up all the weights, all the scans, all the events. The farmer doesn't have to touch our software. But imagine in the US, with that ear tag and those events, he's now got access to an export market that wasn't there before. So we're working with people like Gallagher, where they're motivated to build their business while we take that data further. How do we make money? So we've changed the model quite a lot in 18 months. We're now free for the farmers. So ranchers or farmers in Australia or the US, they get combined data and reporting, as well as the QR codes. We've built a portal where they can build their own brands and create that themselves. They get all that for free, but we get 1% on the export value of products. We also have Australia's largest dairy, Aurora Dairies, mainland dairy, signed up, over 20,000 cattle on the books there now. Our products have really only been in market for the last couple of months, so it's great to see a first customer in beef and dairy. With those large enterprise customers, yes, we charge them a monthly fee because we combine so many of their systems and activity into reports. Traceability as a whole could be certificates. We've just won the DAF award for the e-halal certificate, so we'll be digitising and creating certificates for halal. Again, 80% of Australian abattoirs are halal certified. 90% of that product is export. So that'll be happening in the next couple of months. And on that traceability or certificate side, again, around 1% of the value, or domestically 10 cents per kilo. Here's a TAM SAM, which I'm now nervous about after the previous comments, but we're really just trying to focus on three core areas. Come and talk to me. We can tell you about what we've done for Australian government. We've successfully done the CRCP for medicinal cannabis tracking a plant or a cow, not that different, but we've really honed in on beef, dairy, and the certification in the last 18 months. We've got on the dairy side on the right, on the beef side on the right, we've won contracts for our customers, Ritz-Carlton in Singapore. Again, they want carbon neutral beef. Angus Australia are getting more into the product side. GelPro will be producing next year Australia's first provable Australian collagen. I can't tell you how popular that is. Everyone's trying to source that. The airlines and abattoir industry as well we're working with. Break even this time next year. Again, the wrap up there. Come and see me for a bit more detail. But effectively now we have first customers in beef and dairy. The halal industry is huge, and fetal bovine serum alone is growing very quickly every year. It's over $1 billion now. Thank you very much for your time. We're patent protected in the US and Europe. And please feel free to come and see us at table 11. Thank you.
Thank you, Jara. Please welcome Ires Rakamim, co-founder of Staples.
All right. Good morning, everyone. Lovely to be here. Thank you for making time to hear the journey of Staples and what we're doing. Very excited to share that with you today. I'm just going to try and figure this out. Excellent. Cool. So, welcome to Staples. I wanted to just maybe gauge the room for people's kind of understanding, and I can kind of tailor what we're doing to that. So, in terms of digital assets or crypto, which is a bit of a taboo word in many circles, I wanted to gauge kind of today who's heard of Bitcoin? Lots of people. Okay. Who here's heard of stablecoins? Slightly less people. Or Circle or Tether or those types of things. So if we start off maybe a little bit philosophically this morning, when it comes to cryptocurrency and blockchain globally, what a lot of people kind of started off with was Bitcoin. And that's how it started in 2008 or 2009. And what the core technology was with Bitcoin was to enable a peer-to-peer transaction with no middleman. And with Bitcoin and many other things and profound benefits. But, you know, at the time and still today, it's volatile, it's used in a speculative way. And someone much smarter than me very recently kind of said to me, but what happens if actually blockchain and crypto started off with stable coins? So Bitcoin came along, then a number of years later, maybe 5 years later, then we came across stablecoins. Today, stablecoins are some of the largest markets you've never heard of proliferating without any middlemen. And what you can do with a stablecoin, it actually does 50% of all Bitcoin volumes are conducted in stablecoins and many other significant statistics, which I'll get to in a second. So we're a group of people. My background's in venture capital, corporate advisory, and fintech. We have built and assembled a world-class team that have built some of the most heavily adopted fintech apps in Australia and Asia Pac, being Pocketbook, if you've ever heard of it, or Zip Money app, as well as getting some of the first banking licenses. Our CRO is a very well, credentialed gentleman. So at Staples, what we envisaged is if we can build a digital wallet powered by stablecoins in the back end, then we can drive a lot of efficiencies in the transmission and storing of value. In terms of blockchain businesses, we're about as simple and as boring as it gets. We do a couple things very, very well, and we've all got a strong track record in executing and bringing these technologies to market. So in terms of our vision, we want to build a stablecoin wallet for the world, starting from Australia. So a lot of, which I'll get to in a second, our community is actually global and in emerging countries using this as underbanked individuals for some basic financial services. So in terms of the problem space we're looking at, your fiat, actually in Australia we have a great payments landscape, so I'm not going to complain too much about Australia, but in other countries it's super fragmented. There's a lot of middlemen, it's costly, it takes time to move money. A lot of people globally are underbanked. I'll get to some of the core statistics around that in a minute. And in particular, what we're looking at Stables is around cross-border payments, making that easy and very, very cheap and fast. So welcome to Stables. We're here building a regulated gateway into stablecoins for a global community that are underserved currently. In terms of the app, we've launched the app just recently in the last 2 months. We have organic traction to date of thousands of people using the product every month, tens of thousands globally using the product every month, and we have not spent $1 on marketing. We plan to do that over the next, this quarter is a big focus on go-to-market, particularly in Australia for our card, which I'll get to in a minute. So if you can build a digital wallet powered by stablecoins, as I mentioned before, you can do some crazy stuff. So what I mean by that is we can facilitate a cross-border transfer at a fraction of a cent today with limited or relatively low scale. So in terms of blockchain, we are more of a functional use case of digital assets rather than a speculative one. And then in terms of user experience, our app is world-class, built by, as I said, people who have demonstrated and executed on this before. And everything we've done or you see publicly, we do that all in-house. And we're mainly based in Sydney, just around the corner as well. Going forward, why now? Why today? Why is this something that is a massive, get Erez out of the bed commercial opportunity every morning? Well, if you didn't know, digital wallets over the last decade have now in the hands of around 3.2 billion people globally. This is your Revolut, your Wise, and a few others. But in terms of blockchain wallets, who today knows how many Ethereum, roughly how many Ethereum wallets there are? Not many people, that's okay. So actually, there's about roughly 250 million unique Ethereum wallet addresses. But looking at this stat, you've got 3.2 billion digital wallets. So, massive venture capitalists and other kind of plugged-in investors who, really attuned to this space, they understand that blockchain wallets will grow. They will, start to mirror what we've seen with digital wallets, but maybe, with the complexity and some of the knowledge gaps with blockchain, that's hindering a lot of adoption. So income stables, we want to bridge that gap for that next billion people, or at least to bring it on par with the regular digital wallet scene. In terms of stable coins, they're actually being used today to combat some pretty pressing and important issues. So for example, in Argentina, we have people that want to hold digital dollar, not dollar under their mattress, right? They're not getting charged heaps of fees to hold that dollar either, right? And it's more secure because it's not under their mattress, it's actually in their phone. And in terms of technology, digital wallets are penetrating into emerging markets to offer, not necessarily core banking service, but other complementary services such as holding, easily able to hold US dollar and the ability to spend that or send that at a lower cost. So in terms of market opportunity, I thought I'm asking a lot of questions today, but this may be one that we all know or have an idea of. Average remittance cost globally. Does anyone have an idea of what that is? So the average remittance cost, and this is not Erez's stat that he made up, it's a decently credible stat, is about 7.6% globally. The average cost to send funds overseas is around 7.6%. Now, if you're sending sub $1,000, the average cost is actually between 10 and 15% for the little guys and girls. So stablecoins last year, calendar year, did around, I thought it was either 9 or 7.4. I have to remember my stats. But so 7.4 trillion, okay? Visa card and MasterCard combined were around 9 trillion in volume. So what we're seeing here is this market conducting peer-to-peer transactions at such scale, at its infancy, is almost on par with the largest payment institutions in the world. In terms of the market potential, Asia-Pac is the fastest growing digital remittance market in the world. And if you can offer cheaper and faster services, even if we capture a very small amount, that is a very, very big business. In particular, which I'll get to in a second, we're focused on Southeast Asian or ASEAN corridors. And then hopefully the vision is one day to enable closed loop payments. So what that means is today, which I'll get to in a second, we've embedded our stablecoins in the MasterCard rails, which is a kind of a first of its kind in Asia-Pac. But eventually what we'd love to do is to actually facilitate closed loop payments. So, you know, in Bondi markets or Byron Bay markets, you've got these little vendors or these people using Square terminals. They get charged 2 to 3% per transaction. We can do that today at about 1% per transaction with money in their bank. So we're not alone. There are people that are doing this in different ways. We are at the forefront of that kind of competitive landscape globally as well. Lemon Cash is in Argentina and Mexico. Eco is a great example of one in the US. And Pillow is a little bit different, but they are more Africa focused. But in terms of Asia-Pac and ASEAN countries, they're wide open. That's what we're seeing from a competitive landscape perspective. Outside of the core founders, you'd be hard pressed to find a blockchain business that their first hire was a CRO. He's a great guy. I've known him for many years. He used to run banks. He actually got the first new ADI, the first new banking license in Australia in 50 years. And when he saw what we were doing, he wanted to jump on board from day dot. So he was our first hire. Dave is a great guy. We've also traversed this regulatory landscape with credibility and integrity over the last few years. Today we hold the license in Australia, and we've also got we've got a license and an entity in Europe as well, where we're looking to launch soon. And I'll get to this MasterCard relationship, but if you think about stables, what we do is 3 things. One is we go from fiat to stables. Then we have a wallet. The wallet's live in 130 countries. And then we have a card. So in Australia today, you can spend your stable coins as you would your regular money. And that's cemented in MasterCard's relationship. It's one of the first ones in Asia-Pac where you're actually spending out of your digital asset balance. And this product, we're exporting that to Europe. We'll be live in Europe by the end of the year. And we'll be facilitating payments into Philippines by the end of this month. It's not just Erez. We've got a strong and decently sized team with strong backgrounds in the space. And we've raised something like 7.5 million to date. We aren't necessarily actively raising money, but if there's any interested investors, I'm happy to build a relationship and start to have a conversation. And yeah, thank you for listening.
Thank you, Iris. Welcoming next the visionary founder of Llew Hill, who demonstrates remarkable entrepreneurial acumen and a passion for driving innovation in the field of his venture. Please welcome Adam Switzer.
Okay, awesome. Erez has explained all the blockchain stuff, which is great because we're expanding on that. Actually, we're kind of a little bit further up the vertical, but really good that he's covered a lot of that. So stick around and I'll talk you through what we're doing, which is about bridging on-chain liquidity with real-world assets and asset-backed finance. So what does that mean? If you think about on-chain and traditional, so on-chain is people that have cash tokens or stables. Erez was talking about traditional finance is traditional finance, but specifically in the context of non-bank lending we're talking about. So this is where investors, wealthy investors or others put into a loan, and that loan is originated and then dispersed to a borrower, which might be, say, construction, property acquisition, so on, just outside the banking process. It's a big market. It's 100 billion of new non-bank loans a year in Australia alone. Around the globe, it's obviously much bigger. On-chain as well is very, very big. Again, 100 billion, give or take, of assets staked, which means people have digital assets that they just hold on to, that they're looking for yield. You may have heard the stories about all the digital asset managers and exchanges and so on blowing up recently. A lot of that is from basically cowboy yield investing, where they would collateralize things with other digital assets. So people would invest money into something that would then be relent without any tangible real world asset backing that. So all collapsed, very similar to credit crisis scenarios that we saw back in the early 2000s. But people still have this money, still looking for yield. In the traditional world, we have real world assets that the market is fragmented, technologically a little bit back in the Stone Age, and really good on primary issuance. But if you think about secondary trading, if you want your money back, you kind of have to wait till maturity. There's not much of a secondary trading market. So what are we doing? Putting all those people together. Sounds really simple. There's a lot of really cool tech in the middle. And what this really does is bring people with digital cash, traditional investors, the non-bank lenders, the originators. There's probably 50 or so significant players. There's actually 2 or 3 presenting here today, non-bank lenders, and borrowers, people looking for money. And what this does is massively increase the liquidity pool from both traditional and digital asset investors. People have got lots of cash. Streamlines the whole process of originating loans, facilitating the registry, which some of the non-bank lenders would pay hundreds of thousands of dollars a year to have. Eliminates all that. It's all on chain. All the benefits of immutability and the registry that the blockchain provides. Secondary trading, algorithmic trading opportunities. All the innovation that we've seen in the digital trading space, but applying that to real world assets. And that's what we've built. To kind of cover that already, but streamlined processes, liquidity, access to sustainable yield, and eliminating a lot of the kind of middlemen that happen that still exist in this space. Why private loans? It's a huge market. It's a very stable market. These are real world assets collateralized by property, infrastructure projects, and so on. So they can be clawed back if need be. But there's typically high returns with low risk, low LVRs, done by non-bank lenders that have stringent credit processes with track records. So these are real assets. Bringing them onto the blockchain, they're easy to price algorithmically. So blockchain's a really good use case for these markets because we can apply code to it. And the market's growing. It's predicted to become the second biggest private capital asset class in the world. You can all access the slides, but the key point of this is that blockchain technology is coming to this sector. The big banks are doing this already. The regulators are talking about it. The governments are talking about it. Just to highlight one example, JP Morgan, their Onyx platform, they've already transacted over $1 trillion in this asset class on the blockchain. It's coming like it or not. And we're building the solution to make the incumbent market adopt this in a way that they understand. Again, cover this at a high level, but Web 2, if you're not familiar, is the existing processes around a website. You might log in with your Apple ID or a corporate ID, documents, websites, these sorts of things. Web 3 is blockchain-based stuff. We sit in the middle of the two. So if you think at the moment you're an investor, you have access with your email account or login to a portal to invest in deals. You might get a statement. That's how you interact with your investment manager. On the blockchain, you'd have a wallet that you log into, and that's how you interact with financial transactions. We're supporting both, and we bridged both because we have incumbent traditional financial operators. We have Web3 based digital asset operators, and we're bringing the two together to not just double the size, but exponentially increase the liquidity in the two markets. We have these products, they exist. Welcome to come and chat to us afterwards, of course. We can show you a demo. We have a Web 2 based version, which is login with your Apple ID concept. We have a Web 3 version, which is login with a wallet concept. We're working on a fused integration of the two to a single platform that can handle both. But essentially, we handle the entire trading lifecycle from on-ramping of cash and on-off-ramping back into your bank accounts, KYC and onboarding, customer relationship management, portfolio management, risk assessments, the actual tokenization of the deals, syndication, so primary sale of getting an investor book, secondary trading, on-chain order books of both digital assets, as in crypto assets, and real-world tokenized assets, all the post-life cycle things like interest collection, calculation, yield maturity, a full product suite around private lending, and of course, user experience and so on around that for all the players within that ecosystem. It has a complete end-to-end ecosystem, can plug and play with different providers. Obviously, if we're a technology provider, but we work with the non-bank lenders and fund managers to embed this in their existing CRMs and platforms. Why us? We've worked at pretty much every major organization on Wall Street. I myself used to run one of the top 3 balance sheets systems in the world. So I managed a system that managed about $3 trillion worth of assets. I also used to head up the AI technology at what's been the world's best bank for the last 5 years. And really, so I'm a technologist and a banker at heart. Our other partners, co-founders are on the boards of listed banks, active fund managers, some of Australia's most successful traders, and real estate listed infrastructure and private lending experience. So a real TradFi background. I guess Era's joked before of the first blockchain hire being a CRO. We're kind of the same. We're all TradFi people with very, very strong background who've lived through the GFC, understand the financial markets, and are applying innovation to bring traditional finance into the next generation. Some advisors that are also publicly listed organization founders. What are we doing? We're raising $2 million. Again, it's like areas we've raised in the past. We're just launching a raise again to really push the business to the next level of commercialization. We're kind of tech heavy, focused on product build. And most of this is to start to commercialize and work with our partners and build that syndication of those 50 or 60 private lenders within Australia alone to build up that whole decentralized marketplace. And I've actually got a little bit of extra time, so gone through quite quickly. So what I might do is just go back and show and explain maybe some of the workflow. So if you haven't heard of tokenization, I'll explain that a little bit more. It's the process of taking anything and creating a digital version of that on a blockchain. And for dummies, blockchain could be really sophisticated, or you can just really simplify it down and say it's basically a database with some smarts. So really what we're doing is creating a digital version of private loans. It goes on a blockchain or a database where anyone can see who's traded it anyone can see who's the borrower, the lender, the credit history and the transaction history, the performance of the loan, and so on. So you're making all the registry that is usually done by a back office front and center, so people can really trust what's happening with that particular financial instrument. And as you build that trust, people then can start to trust that they're okay to buy it, hold it, sell it. And that builds efficiencies to take the middlemen out of the process of traditional, or particularly private markets, and let the economic parties, be it the borrower, investor, issuer, interact themselves. And that's really what we're trying to do. And the idea is to as I said, exponentially increase the liquidity, reduce the friction within a very, very big and lucrative market. Come and see us. We're just out the front. Happy to chat more, of course. Thanks for your time.
Thanks, Adam. We have the privilege of hearing from our other sponsor today, with a reputation for delivering insightful keynotes and a strong commitment to driving innovation and growth in the company. Please give a warm welcome to Giles Carhan, the CEO of Rocking Horse.
Thank you. Look, I always like coming to the wholesale investor events. Steve and I really were on the same path from about 8 years ago. So it's been great to see how these have grown, and you know, we're really privileged to be here. So look, I won't take up too much of your time. Very quickly, we lend to companies who are doing R&D. So we factor the R&D tax refund with a very simple, much more simple than the previous speaker's product. Basically, we can bring forward any amount that a company does in R&D, and we can bring it forward into the current year. So, you know, for example, our smallest loan, I think, is about 30 grand that we've done. That company, he came to me it was about 6 years ago. Small guy, didn't look more than 15 years old. He now employs 300 people in Silicon Valley, and he actually offered me a whole lot of equity for $30,000. I didn't take it, unfortunately. And he's now one of the fastest growing, EY had him as one of the fastest growing companies in New York. So we also have done a loan up to 24 million. So we can do all everywhere in between. Obviously, we can talk about why debt, equity. I won't go through, you know, sort of who we are. Debt versus equity. Obviously, debt is you keep your ownership. And so it's a very powerful tool if you can get it. Now, why are we here? Why aren't the banks doing it? We can value what the asset is, which we can look at the R&D. So we work with the likes of your Big Four, PwC, EY, everyone, and the smaller R&D consultants as well. We're quite agnostic as to who they are. We just want to help support the environment, and hence why Steve and I have always got on so well, is because we're very complementary. Only one company that we've ever lent to wasn't raising money. So, and they were a bauxite miner, and they just needed the money to get the stuff on the ships. So our process, you know, is really quite simple. Why do people use it, I guess, is the most important question. It can be a bridge. You know, where are we? The start of August, everyone's putting in claims now. They were running out of money, and they're going to get the claim back in a month or two from the ATOs, so they need short-term cash. Then you can, if a company is a little bit more organised and, you know, they know what they're doing, they might come to us at the end of the first quarter and then borrow the money throughout the year, so they can, and then of course that money they spend on R&D can be then claimed at the end. So using debt to sort of leverage the R&D program. And it can be a very powerful tool. So we can lend up to 80% of the accrued benefit at any time through the year. So, you know, when you're looking at those sorts of numbers, and if you are able to deploy it back into R&D, it's a very powerful tool. Now, as I said, the process takes about a week. It's fully flexible, can be paid back at any time, all those sorts of things. No personal guarantees, blah, blah, blah. So, you know, we've been doing this for about 9 years. It's coming up to 9 years, actually, in October. It's been great. One of the things I really enjoy is that I can see a whole lot of companies coming through. So we see all the trends, what the new technology is. It makes it really interesting, because what I actually do is very boring. So I actually get other people to do that, and I look at all the companies, and, you know, so look, it's a lot of fun. Now, just quickly, the 12-month duration, the quarterly funding is a powerful tool, and I can send this to anyone. I think it'll be on somewhere on the Wholesale Investor website, but it can be a very powerful tool. So if you sort of think about it, if we're letting 80% of the 43.5% that the government gives you back, it can be a significant amount of money. So all it takes is preparatory work, so making sure that you are able to spend it, you're able to deploy it in the right manner. Because look, it isn't the cheapest. If you can go to a bank, I'm the first one to say, if you can go to a Big Four, go. It'll be a lot cheaper, but you might have to put up personal guarantees and things like that. Ours is short-term money. It's short-term lending, but where I guess, as I said before, where we come in is you can. It's a fully flexible facility. So if you're doing a raise like a lot of companies are that come to us, and you raise the money, well, you can pay us back. You're more than welcome to pay us back whenever you want. Now, I guess that's really all I have. It is a very simple process. It's a simple product. It's a basic loan against your R&D. So if you're doing R&D, please come and speak to us. Unfortunately, I'm not outside today, but I'm in the crisp deal room. I know Steve very well, so just give him a call. He'll love to get another call. Look, please come and speak to me if you have any questions. So good luck, and I hope it all goes well today. Thanks very much.
Thank you, Giles. Continuing with our company presentation, let's welcome Alex Perry, CEO and founder of ShareWise.
All right, raise your hand here if you've got a share portfolio. And how many of you pay for research? How many of you got a stockbroker? All right, great. Good morning, my name is Alex Perry. Good afternoon now. CEO of ShareWise, your newest fintech from Australia. There's been a lot of talk about all these blockchains, but we're more traditional with shares, but we're here to disrupt that space. So according to the ASX study of 2023, Australians are increasingly investing in shares. There are so many low-cost brokerage platforms out there at the moment. But what's missing is quality institutional advice and research. So everyone can open up a share portfolio and it gives them the opportunity to lose a lot more money. So the last research from IG Markets, if you've got an account there, about 79% of all accounts lose money. So there's a gap in the market for end-to-end share advice, taking into all consideration all the pain points of the everyday investor. So this is where ShareWise comes in. We're more than just a traditional share advisory and a low-cost brokerage platform. We're the best of both worlds. So basically, imagine using CMC or a ComSec. You're on your farm or you're playing golf, and you're a self-directed investor. You got $2 million that you've retired with, and you've got another subscription that you've paid for. So you get a push notification on your phone to say, okay, we've got to buy on BHP or we've got to buy on Silex. You can look quickly at the tear sheet of the charts. You can say, okay, I'm going to allocate 500 shares to that. We've got experienced share advice. We've been running our share advisory business since 2016. So we're not newcomers to the industry, starting up a fintech. End of financial year results last year, end of year 23, 12.9% versus the market of 8.63%. End of year financial year 2022, we did 20.88%. The market lost -6%. So we're not here to spend $50 million on a low-cost brokerage platform. We understand that is a very, very competitive space and low margins. Instead, we're customizing Novus FinTech's white label solution for us, and we've created an end-to-end app. What that means is it integrates our share advisory with the service. So it's a win-win solution for us with a reputable partner. So there isn't a platform in the market at the moment where you can log in, open up an account, and get advice on the platform as well. So what's basically happened is it's either you've got traditional share advisors or you've got low-cost brokers. We're an all-in-one service. So basically, if you've got a portfolio on a low-cost brokerage platform, you can upgrade your membership. Say you can upgrade it to a monthly membership, and you can start getting research. So we've got a competitive advantage of a holistic revenue stream. We recognise that our return on investment is not through the platform. There are plenty of those. But the primary objective of the platform is a lead generator. So 80 to 90% of our business comes from the advice, traditional stockbroking. Basically, what we've got now is with this low-cost lead generator, we've got thousands of leads coming into the advice business. Now, we've been established since 2016 and we've got over 40 years of experience as brokers. We've got skilled salesmen who are able to close at a rate of about 15%, and we also provide institutional grade research too. So how does this work? There are two main revenue streams for us. In traditional broking, we've got the normal broking, we've got corporate finance, and we've got subscriptions to our research. But now we can spearhead that with low-cost brokerage as well. We're already a profitable share advice firm, and we run on subscription memberships. So we've got brokerage and account management and commissions through corporate finance. By launching the trading platform, we're able to spearhead that and provide it as a feeder to the business. So we've got an estimated launch date for the app in November. As our advisory is already in operation, we've got the reputation to gain easy access in acquiring users once the platform launches. We still predict that 80% of our revenue will be from advised clients, but more users on the platform means more conversions for us, from trading account clients to advised clients. To put it into perspective, Self-Wealth has over 150,000 users. We only need a fraction of that to generate a substantial amount of revenue for the business. So we're looking to raise $2 million. We've already covered that through 10% of that through our Section 708 investors. As we're already a functioning firm, we understand that every dollar that gets put into our business, we can deploy that straight away to get more clients. So we're able to pay for your risk of 12% per annum. And then after 36 months, that gets converted to, the convertible note gets converted to equity at a 20% discount. We're looking at a liquidity event between 3 to 5 years. We're actually looking to list on the ASX. We're brokers, so we've brought many clients to the ASX. As you're probably aware, minimum to list on the ASX is 20 cents per share. With the reduction of risk from the interest and the 20% discount, we'd be looking at a potential upside of about 4 to 5 times your investment. Use of funds, pretty straightforward. We're in talks with several financial planning firms just to increase our database and basically just complement our offering. We're also looking to boost the lead generation of the platform. So we're working with a digital marketing company to expand our reach. And we've also got multiple features in the pipeline for a version 2 already with Novus FinTech. And we're also looking at entering the New Zealand and Singapore landscape. So management, I've been involved in taking another business to market, one of the household names in the advice industry. We're not newcomers. We've been in the broking industry for many years. We've got 40 years of experience with investment management. We know where the pain points of the everyday investor are. And in addition to this, we've got institutional quality research from Banyan Tree. So we've got Sharewise as a great opportunity to invest in a stockbroking firm immersed in this fintech space and we're evidently early disruptors to the Australian share investment industry. Thank you very much.
Thank you, Alex. Next up, we have Muhammad Alinia, co-founder and CTO of Driverly.
Hello, everyone. My name is Muhammad Alinia, and I'm a co-founder and the CTO at Driverly. We are a UK insurtech startup. Just trying to get this. Oh, this one is the bottom. Okay, so what we're trying to do is to make insurance work for young drivers. It does not at the moment. The problem in this market for young drivers is that insurance is expensive, unfair, and boring for them. You can see in the chart, young drivers pay about twice as much as older drivers for the same policy. And not all young drivers are risky. Some of them are actually better risks than older drivers. But most of the insurance companies in the UK put a heavy stress on the age. And just because of the age, they punish the customers and give them these kind of high prices. And also, like with an annual policy, with no interaction with the customer at all, during that policy, there is a whole lot of lost opportunity in terms of interacting with the user and providing them with further value. So what we're doing about it is that we're bringing car insurance to the 21st century. We have created an app that our drivers use, and the app gathers a whole lot of data about their driving behavior. We score their driving from different aspects: speeding, braking, cornering, all that sort of aspects. And the only thing we use is the app. We're not one of those telematics systems that need to install a box in the car. It is only based on the app. And because of this continuous data gathering and processing that we do in terms of the driving behavior, we are in a position to offer our customers monthly subscriptions and adjust their prices on a monthly basis as well. So if they're good drivers, they're going to be rewarded by getting lower prices, and if they are not that good, their price is going to go up, and if their risk actually falls outside of our risk appetite, we can just terminate their contract. Doing this, we are using far more data points to assess the risk of a user than most of the other companies in the UK, and also employing more data from different other sources that I'll go through in a second. We're going to be in a position that we are actually more dynamic than anyone else in the UK market in terms of the pricing. So, as I mentioned, we are providing a flexible policy, a monthly policy, and also it is app-based telematics. These are both like the features that are setting us apart from the rest of the market in the UK. Because the rest of the market, most of them are either not app-based telematics, so someone has to install a device on your car, or they are not flexible. They're annual policies that cannot change or give you a better price after you have proved that you're a good driver. And we are ambitious as well. So we're aiming for 500,000 customers, 500 million pounds of turnover, and 40 million pounds of profit by year 6. And why we think we do that, there are a number of reasons. First of all, it's a huge market. The market size for personal car insurance in the UK is 16 billion pounds. And under 25s account for 30% of that, which is still very big. The market is very attractive from the distribution perspective through aggregators. Aggregators dominate the market in terms of distribution. These are like the likes of Compare the Market or Confused, confused.com, so on and so forth, where people go in and compare policies. So we have a very good relationship with confused.com, which is one of the big four aggregators in the UK with a fixed cost per sale model and an LTV to CAC ratio of 5. Also, apart from the driving behavior information, we employ other pieces of data that will even further makes us able to assess the risk more accurately so that we can give the people the better prices they deserve. And this part of our system has been so far the most sophisticated part of the system that we have developed. I can go through the details of that in chats that we could have in our near our desk, but this part is the most sophisticated one. And last of all, we are operating in a regulated space, and we already have approvals from the FCA, which is the regulatory body in the UK. But in this space, experience is key, and I'm very fortunate that my two co-founders, Armin and Nestor, they have deep experience in the insurance industry. They have worked for Admiral, the biggest car insurer in the UK, for more than 8 years. Armin has been heading up their new products department, basically creating the new products in his last role in Admiral. Nestor also worked for Admiral for 8 years. And before joining Armin and I to start Driverly, he was also a chief underwriting officer of the telematics insurance business. And Mark, our Ned, has been a former Ned of Admiral again. So a lot of Admiral background and a lot of experience in the insurance industry. And as for myself, apart from my technical background, I have been the CTO and co-founder of Citrussat, which was acquired by the Publicis Group a while ago. So yeah, you can look that up if you want to. And where we are now and what we've been doing. So we have created a team. We have created our apps. I can show you the app at our stand. We have created some traction in terms of app usage, which I'll cover shortly. We have our FCA approvals. We have our heads of terms agreement with a carrier, and we're trying to launch before the end of the year in terms of selling insurance policies. And in terms of the traction that I talked about, we have 3,000, more than 3,000 users, most of them coming through referrals, and users spending 10 minutes plus on app on average on a monthly basis, which is really good for an app like this. In terms of funding, we have raised £600,000 so far, and we're looking to raise £500,000 at this stage to get us to the market in terms of launching our insurance policy. And if you have any questions, I'll be available near a stand, and I can show you the app and everything. So thank you very much.
Thank you, Mohammed. Our next distinguished speaker will enlighten us on the Australia-India investment opportunity, offering valuable insights for our audience. He is the founder and CEO of TAD Capital, prominent investment banker involved in a $1 billion USD worth of transactions. Please welcome Ram Gurlamanda.
Thank you, everyone. And thank you, Steve and Wholesale Investor, for allowing me to make some remarks on Australia, India. Obviously, it's a challenge to do a session just before lunch, and that too under a short period of 10 minutes. And yeah, let's see how I go. I will probably skip a few slides. Yeah. So look, I got a lot of content. Obviously, if any of you want to use the slide deck, just approach me at the end. I'm trying to talk only about the broader economy and specifically about the venture capital and private markets industry. So I will be avoiding a lot of listed market data in here. So we will quickly run through economy, some of the key fiscal reforms, what exactly happening is happening on the infrastructure in India, and where is India's aspiration to be a manufacturing giant. Sustainability is a huge conversation everywhere. We had quite a few presenters this morning talking about renewable energy targets. And technology obviously has always been India's core strength. And what has India done since its core strength of being a technology country?
We'll quickly touch on startups, and we'll talk about where is India heading in 2047, which is when India celebrates its 100th year of independence. And we'll talk about India-Australia partnership. Let's see what we can achieve in this short period. Look, again, I'm not going to go through the entire macro data. One data is probably important for all of you to understand today. India's per capita income is sitting about approximately $2,500 US compared to China, which is sitting just around $13,000 today. So in many ways, India is going to be exactly where China was about 2 decades ago. So I'll probably leave that stat in your head, and probably another one we'll probably look at. Domestic credit in India is sitting at approximately 55% versus a world average of 148%. Okay, what happened in the last 75 years since India became an independent country? We have seen 100% rise in its GDP, currently sitting at about USD $3.5 trillion. We have seen 500% raise in total exports. Highest ever recorded in last year, about $660 billion. Fifth largest economy in the world currently, second largest working population with an average of 29. A lot of these are very well known statistics. Most important one is how India is bouncing back since the pandemic level. It has hardly taken a dip. It's experienced a V curve, and FDI in the last 8 years has significantly doubled. So again, very quick pointers. India's growth rate is sitting at 6.8%, which is double the average of global growth rate. World over, we are approximately sitting at 3.4% versus India sitting at 6.8%. All the commodity prices in India is approximately crossed the pre-pandemic pricing, which is an important statistic to know that India is consuming, unlike most countries which are actually contracting. Every indicator that is showing on the ground, it says that India is a consuming market, and it's not going to experience recession that most people talk about. Some key fiscal reforms. I'm not going to bore you guys again here. Probably important ones to note is production-linked incentives called PLI, which is one of the most interesting incentives that the Indian government has thrown to attract global manufacturers to the likes of Foxconns and Teslas and many others who are now making a beeline to actually start setting up manufacturing facilities in India to basically manufacture in India. So there is going to be significant news around it. Semicon India mission, probably another interesting one. Let's pray that there will not be another war around Taiwan. But if that happens, there's going to be a huge issue for most of the semiconductor market globally. From that point of view, India's aspiration to become a semiconductor market is going to be an interesting story. So again, Gati Shakti plan, one of India's leading multimodal connectivity plan. It's one of the few fiscal policies which is actually connecting all forms of logistics, all forms of geospatial data available in the market. That is going to significantly change the way India commutes and India moves between the countries. Quick understanding. Obviously, there's a lot of things happens in India within a span of 12 months. Just to give you an idea, amount of money that has flown in from various parts of the world. We've picked up a few interesting stories. Zepto, equivalent to your milk run, just received $200 million. At the same time in Australia, actually, we had companies like Milkrun literally being acquired because of unit economics not stacking up. So we have a couple of interesting companies. Reliance made a huge joint venture with Brookfield Energy Partners in Australia yesterday. This is to set up a world-class manufacturing plant for producing hydrogen. So that's a huge announcement. Zoho, one of India's largest self-funded multi-billion-dollar profitable SaaS company, opened its fully owned subsidiary. India's Upgrade, India's one of the most popular edtech unicorns, acquired a Sydney-based company called Global Study Partners. So list goes on. Let's talk about infrastructure. Infrastructure is key for its growth. Where is India today and where is India heading in 2047 when India celebrates its 100 years of independence? Yeah, so it's self-explanatory. To be honest, I think probably one interesting one which I really like, which talks about urban infrastructure, is urban railways, where India is potentially experiencing 7 times growth in urban railway infrastructure, which is in urban railways within the city, metro trains equivalent. They are aspiring to build about 7,000 kilometers of railway network within the country. And aviation, another interesting one for all of us who continuously travel between the countries. By 2047, we're expecting about 1.5 billion trips to India. So huge numbers. Manufacturing, this is something that most people don't associate India with. But India has been steadily growing its strength as a manufacturing giant, although no way on the same leagues of China. China is sitting at about 27% of global manufacturing. A third of global manufacturing does still happen in China, but India is steadily growing. India is contributing about 17% to the global manufacturing today. So watch out what's going to happen in the next 2 decades, as most of the world is looking for supply chain resilience programs and China plus one strategy and all of it, where we will see India potentially rising further up. Sustainability is a huge issue, and everybody talks about sustainability. Indian Prime Minister and Indian government has been primarily leading this initiative within the global south and within the developing economy quartet. Well, India is already 4th largest producer of renewable energy. India made a pledge to invest $1 trillion by 2030 to create an international solar alliance network. So India wants to raise non-fuel based energy capacity up to 500 gigawatts by 2030 and net zero emissions by 2070. Big targets. Obviously, how much of them is achievable with the size of its population is a story to be narrated, but they have made a lot of progress. If you see in this slide, so 2021, India had less than 393 gigawatts of renewable energy production, and more than 53% of energy production was coming from coal-fired power plants or fossil fuels. 2030, India is on target to produce 817 gigawatts of renewable energy, which is with more than 53% of renewable energy targets coming through non-coal-fired industry. Well, India is upgrading its technology to move from an offline cash informal low productivity economy to an online cashless formal high productive economy. Okay, 1.3 billion people completely identified. I'm not going to talk about it. It's one of the biggest revolutions in the world. Every one of us have a unique identity number. Second largest consumer of smartphones. Number 1 in the world in fintech adoption today. Last calendar year, India had 74 billion digital transactions with a GMV of just over $1.6 trillion. Okay, I'm going to skip this line. Okay, just one quick example of what happens when government participates for uplifting the poor and bringing more people into technology adoption. So since the big biometric adoption that Indian government has set up, where India has developed the core technology stack, more digital transactions have been happening in India than ever before. And if you combine that with raising infrastructure on producing cheap data, so India is now one of the cheapest data provider in the world. India can give you 1 GB of data for about 17 cents versus Australia actually cost you about 57 cents per GB. So just to put things into perspective, and India moved from consuming 30 GB of data, 2 GB of data per month to 30 GB per data per month today, per consumer. Significant revolution. Obviously, I'm not going to again explain how this all happened. So all of us know India started as an IT services economy with the level of technology stack that government has built. It has moved from an IT services provider to a significant digital identity stack it has built for himself, and with the combination of available cheap smartphones and cheap data, India has built a strong startup economy that led to formalization of many jobs and organizing many workforce across the market. That led to significant visibility for the government to collect taxes, both in formal and informal way at a personal tax level, and GST implementation. That led for financial inclusion, and that led for significant access for higher credit instruments for SME sector in the market. And that's how India is going to achieve its 10 trillion aspiration. 180 companies out of the Fortune 500 companies does have their global R&D centers in India already. So it's a known statistic. Again, 86,000 startups registered, 108 unicorns, 900,000 jobs, combined valuation of 350 billion. Pretty self-explanatory. Well, big numbers, isn't it? So AgTech, 684% growth in the last 8 years. EdTech, 143% growth. FinTech, 47 times. Enterprise Tech, 20 times. Health Tech, 15 times. Doesn't matter where you invest, you will make money. Doesn't matter which sector you go after, you will make money. That's what it says. India is no different to the rest of the market. India has contracted 0.7%. The venture capital industry in India has contracted about 0.7% in correlation with the global contraction. If you see globally, venture capital sector is approximately contracted about 0.7%. Well, again, rest of them is pretty self-explanatory. So high growth sectors in 2023 to watch out is been EdTech, FinTech, mobility, autonomy, and healthcare. And few other sectors to watch out is around human resources, supply chain, and food tech. If these are some of the sectors that, if any of you are interested, you must be looking at India quite seriously. Again, I'm going to skip some of these. What is India trying to achieve by 2047? India wants to be $32 trillion economy and being the second largest economy in the next by 2047. India will get to a 10 times per capita income from wherever it is today. An average Indian will make about $20,000 by 2047. It's an interesting stat for me. Foreign direct investments will potentially grow by 12 times, to approximately about $1 trillion US. So where is Indian startup sector going to head in the next 7 to 8 years? Approximately, we believe India there will be an additional $300 billion that will flow into India in the next 8 years. By 2030, some of the statistics are quite interesting. For example, India is potentially going to see approximately 750 family offices being created, more than 15,000 angel investors, and say 100 plus government entities which will play an active role as an investor. More than 1,000 corporate VCs will play up in India, and more than 450 accelerators and incubators are going to be coming up in the next 8 years. Well, where is Australia, India? Always an interesting story. We got to bring the story back to where we are. So, look, quick introduction to what we did. We run a combination of products, foreign exchange, corporate, and working capital. In the last 10 years that we've been around, we moved about $1.5 billion worth of money across 37,000 suppliers, representing 1,100 of our customers in the last 10 years. We were involved in more than $200 million worth of corporate finance / corporate strategy work across these markets. We have we built over $25 million of working capital instruments for our clients. We did make some proprietary investment in a few interesting companies, and most interesting ones that we made in this year as a joint venture partners, Olympia and SimplyBiz. Olympia is a listed company in India, which is one of the largest listed company which distributes consumer brands from various parts of the world into India. The likes of Sunrise, Capilano Honey, Body Shop, and many other Australian products are being distributed to India through Olympia. And we have made a joint venture with them to help Australian brands to access Indian markets. Some Australian startups which you may be familiar. So Australia is probably still fairly new compared to where the rest of the world is as far as embracing India, but it's definitely catching up. Almost there is a wide representation of all major tech-enabled startups from Australia starting to take India quite seriously, although it may not have been seen in the market, but it's definitely an undercurrent that we are observing. So quick statistics, trade contributes to 40% of Australia's GDP. More importantly, in this slide that I want to make an observation is how the trade dynamics changing between Australia, China, and Australia and India. Australia, China, year-on-year growth is about 7%, and Australia, India, year-on-year growth is 71%. So that is an interesting static that you got observed. The 29th of December, Australia and India has signed a free trade agreement, and since the free trade agreement being executed, within a short span of 8 months, Australia has traded an additional $25 billion with India that it never did before. So Australia and India is sitting at approximately $46 billion today. I'll skip this slide, but quickly pointing out Top Indian exports to Australia: petroleum products, drug formulations, and biologicals, in addition to tech, which all of us know. Major Indian imports from Australia includes coal and education sector and a bunch of others, mainly minerals at the moment. But I think that will change significantly if you've noticed the number of Australian startups representing themselves in India. Indian consumer, this is probably an important slide, primarily because what is happening on back of the venture capital sector being a huge homegrown advantage for Indian startups. It has been creating significant wealth for Indian employees who's working for startups. So if you look at example, in 2022, we saw about $2.25 billion worth of value being transferred from the employee that's being created for the employees with these startups exiting either through IPOs or trade sales, or potentially these startups being profitable and potentially offering them employee share option buybacks. So I think I'm being called to step down, so I'll probably skip some of these slides. Look, I think this is probably one slide, quick attention. India is moving from women empowerment to women-led development. It's got highest number of women commercial pilots in the world. 55% growth in women CEOs and MDs in the corporate sectors in the last 5 years. Most important one, it's about bringing gender parity into equation. Look, I had a little song to give you guys a little bit of set the mood as you guys to get to the lunch. If the organizers allow us to play that, we will play, otherwise we'll skip it. Well, when we talk about India, it's all about celebration. So we've got to have song and dance.
गगन के छोड़ भारत ने भरी उड़ान है, अब आत्मनिर्भर भारत से दूर ना आसमान है। प्रगति और विकास का आनंदोत्सव है, आजादी का अमृत महोत्सव है, ये महोत्सव है। नए भारत के निर्माण का, बलिदानों के सम्मान का, महिलाओं के उत्थान का, अब सर्व के कल्याण का, जन जन का उत्सव है, हर मन का उत्सव है, ये महोत्सव है, ये अमृत महोत्सव है। हर कदम आगे बढ़ाना है, एक नया सूरज उगाना है, हमने मन में ठाना है, स्वर्ग धरती पर ही बनाना है, नए संकल्पों का अवसर है, भारत माँ को नमन सौ है। जन जन का उत्सव है, हर मन का उत्सव है, ये महोत्सव है, ये महोत्सव है, ये महोत्सव है, ये महोत्सव है, ये अमृत महोत्सव है, ये महोत्सव है, ये महोत्सव है।
All right, how great was that? Thanks, Ram. We will now be having our catered lunch, so please be back at 1:30 p.m. Thank you.
Ladies and gentlemen, welcome back from lunch. By the way, I just want to say a big thank you to all of you that come back. If anyone's been an event organizer or been to events, the actual hardest session is the first one after lunch to get people back, because everyone loves a good chat at lunchtime. So thank you. Now, just a couple of things I'll just kick off. One of the questions I always get asked at WI is basically, how do we curate opportunities, that actually participate in the event and that we actually get to work with? And so what I love to do at this sort of time is I love to give you some insights in how we actually look at companies and how we curate them and why they are so unique. So the first part is that when we're having a chat, we want to understand the actual track record of the team. So effectively, we're always looking for board and management that have that sort of been there, done that experience. And that's important because effectively, I said, when building a company and building a growth business, a startup, whatever sort of title you want to give, there's obviously a lot of ups and downs. So having a team that's been able to manage those processes, manage those periods is important. The second part is sector. Sector plays such a massive role in this entire ecosystem. There's a great saying that I learned very early on, that a rising tide lifts all boats. It's also the other way as well. And we've all experienced that over the last sort of 18 months. Now, the funny part is, and for us, obviously, today we've got a lot of very interesting renewable energy tech companies, and that has been such a strong area for us over the last 15 to 18 months. And we've seen so much progress with a lot of our clients in that area. And of course, now you're seeing back again coming the onslaught of sort of AI software. And then also, for me, the one that I want to be proactive in really sort of promoting, drawing attention to is obviously life science and medical device. Because I said Australia, and Victoria mentioned in her speech today, we do such great work in the life science space. And the truth is, the life science innovation in Australia is so undervalued compared to our international counterparts. And the reality is a lot of these companies will end up getting their money from international investors as part of their expansion. So sector is another important area. Now, the other one is shareholders. We always want to know from companies, who are their existing shareholders in their business? As I mentioned to you earlier today, Grain Corp is one of the backers of Hone AG. The reason for that is, for me, it's always good to understand who else has done DD on a business and then also decided to put their money into it. And sometimes it's shareholders, and other times it's who referred the opportunity to us as well. Because we're very fortunate enough to get a lot of referrals from a lot of different investors, directors, advisors. So that's also important for us when we're assessing opportunities. For B2C businesses, we're looking for traction, obviously, because it's very easy to understand, okay, do they have product market fit? For B2B businesses, it's a bit harder, especially if they're a bit more technical or if they're enterprise and the sales cycle is a bit longer. So we want to understand is, do they have trials with blue chip companies or governments or so forth, as part of it. So for example, AgLive, when I was having conversations with them, understand the types of groups that they were already using. Some of the big beef producers were already using, their systems for their tracking and tracing. And, that was important for me to understand. But likewise, all the companies, we go through that curation process to understand what they're looking at and, who they're already working with. Because when a B2B company goes through a procurement process with either a government or a corporate, effectively that's a good assessment of product market fit if they've gone through their own procurement processes, which sometimes can take 6 to 12 months, and have decided to use that technology. So there's some of the important parts for us. So, whenever you're looking at these opportunities, do understand that we have gone through that sort of curate. And we're not a VC or a PE group to do full DD, but we do curate to those aspects because we've got a big belief in that investors can play a massive role in the success of a company. And the reality is there's no such thing as the perfect startup or the perfect growth company. Every company has their own flaws and challenges in different areas, or the way most of you will see it, an opportunity to provide value. And that's what I love about this ecosystem. We've seen it many, many times where an investor has added so much value to a company in different ways. And sometimes it's capital raising, sometimes it's commercial introductions, sometimes it's strategic introductions, sometimes it's at the CFO level, whatever that may be. So I hope that gives a bit more insight, a bit more clarity. I'm going to get Shayla to come up to introduce our next keynote speaker, Dr. Stephen Moss. Thank you.
Thanks, Steve. Welcome back, everyone. I hope you enjoyed your lunch. We will now get to hear from Dr. Stephen Moss, a versatile professional with chairman, partner, and director roles in various companies. He is passionate about human rights and social justice, currently serving as the executive chairman, Asia Pacific at DAI Capital, and was previously the chair of Amnesty International Council. Today, he will talk about innovation in regenerative medicine, an emerging new paradigm. Let's welcome Dr. Stephen Moss.
Thank you very much. Thank you, Steve. Thank you, Michelle. Ladies and gentlemen, non-binary and others, I would like to speak today about a new paradigm in medicine and healthcare. I'm not a doctor of medicine. I'm not a molecular scientist. I'm a psychologist. So I've had 40 or 50 years working in investment and in the emerging markets. I'm 72 years old, and I found a new lease of life, quite literally, in this investment that I'm involved in. You want me to press that button? We're waiting for my slides to come in. Put a lot of effort into those slides. Oh, there's one up there already. That's a good sign. I'll go back one. So what I want to talk about today, my friends, is regenerative medicine. So using your own cells to heal yourself with the promise of living a longer and more productive life with less burden on the economy. Imagine a time, and it's not too far away, when in your 70s and your 80s, you can go down to the tissue bank where stem cells have been cryopreserved to be infused with your own activated stem cells to address and even cure dementia, heart disease, osteoarthritis, and in some cases even cancer. Or just to be infused with your earlier harvested stem cells that are now being reactivated to live a longer and happier and productive life. That's what I want to talk about today. So, I wanted to talk about three things very briefly: my own journey and in development and international banking, but particularly moving towards regenerative health and why at my age. And it's the next topic that is about that, which is health and ageing. What we know about health and ageing today. It's quite disturbing. You go along to a dinner party and there'll be some people around my age in the room today, and you find yourself having an organ recital, and you suddenly or talking about how many drugs are you on, or how many drugs are you on. It's so typical now. And it would just be so good to be able to be more alive with that and to be able to have some answers to that. So, an opportunity to make a difference. I'm an investor, and I'm going to talk about a client's opportunity, Simpler Health, who we've invested in, and the invitation to invest in an amazing project in Bali in regenerative health using Japanese technology with the support of the Australian government. That's my intention today. So very briefly, my journey started with law and psychology. And as I said in my opening, I'm not a molecular scientist or a medical doctor, I'm a psychologist. And then an early career in investment banking. And my slide is not working again, where I've got a picture of, here it comes. So there's my journey. Starts with law and psychology, then it goes, but it comes to PwC, and usually you have to be proud of that. And now I'm finding that's being less proud of that, but I had a tremendous 14 years as partner and managing partner in PwC, so I enjoyed that a lot. Could you keep the slides going down the back there for me? So after PwC, I was headhunted to join a company called Cardno. In fact, it was a company called ACEL, which we listed along with Cardno in a listing in 2004. And that it was international development, so it was working in developing countries. In the introduction, Michelle kindly said that I came from Amnesty is one of the organisations that I've been involved in for many years. And it was a real privilege to serve as their last chair of their council. And the human rights, the social justice, alongside of having the opportunity to work in this area and actually invest in this area and make a difference in this area. So Cardno listed, as probably many of you know, I got removed from CEO position after 8 years, and I started doing M&A in the sector and really got to know a number of companies that were moving in the sector of international development, but also finally into regenerative health. And last year, I took the position of chair of a company called DAI. DAI Capital is a 5,500 people, $1 billion turnover international development organisation. I'm trying to get it to come up on my slide by pressing the button, but it's not. Anyway, that's DAI. Are you going to give me a new one? Yeah. There you go. There it is. So now I'm chair of DAI. You can see that. I guess it complemented bringing those two areas together. So So here's a few things that I would like to tell you about health and ageing. And I'm doing it again, health and ageing. The top green button. Okay, thank you. That helps. Okay, so as you get old, you suffer from dementia and cognitive decline. I'm pressing away at this button. It's not doing anything. Thank you. Young people. So the average age expectancy when people die in the world today is 69 to 72, my age. So 69 for men, 72 for women. And Australia, it's 81, so I've got another 9 years to go. But I kind of like a little bit more than that. So the leading cause of early death, heart disease. I mean, do you know in the US that a person dies of coronary heart failure every 33 seconds? And do you know there are 200 million people walking the earth today who've got terminal coronary heart disease and don't know it? It creeps up on you. And cancer's the other one. Cancer, 2 in 5 of us will experience cancer personally in our lives. Now, everybody here knows about cancer and knows the effect of cancer and knows the pain of cancer, right? I lost my mother when she was 64 from smoking cancer. Everybody's got those stories to tell. The other's dementia, and it's a major one as we sit around our dinner parties, us young guys. 400,000 people a year get diagnosed with dementia in Australia. And they're predicting by 2050, it'll be 600,000 people every year. Diabetes. 1 million Australians suffer from diabetes. And I guess it's a horrible disease for people. I'll tell a couple of stories in a moment about diabetes and some cures with stem cells for diabetes. But osteoarthritis is the one that gets a lot of us in this room. 1 in 7 Australians will suffer from osteoarthritis in their life. It's all fairly glib picture. I apologise if it's felt like that as I've said it. But the money spent on healthcare obviously increases exponentially with the ageing population. So let's take a look at the future. Regenerative medicine. Now, the definition of regenerative medicine is it's a process of replacing, engineering, or regenerating human cells and cell tissues or organs to establish normal function or re-establish normal function. So allopathic medicine is what most of us know about. It's drugs that just mask the issues, right? Or it's surgery. Regenerative medicine is far less invasive, far safer, and far more proven in the world than people realise today. I'll give you a couple of examples. Across the developing world, which is the world that I know about through my work, every 30 seconds, a person has a leg amputated for diabetes, every 30 seconds, through a lack of blood flow, basically, through the extremities. My colleague, or my dear friend, Dean Kilby, who's here today, CEO of Simpler Health, told me of a study that he was doing in Fiji, I guess 10 years ago, where they did a study and found out that 1 in 3 Fijians have type 2 diabetes. And what they did was a trial using stem cells extracted from the patient's fat, isolated in the laboratory, reactivated and injected back into the injured foot. And in their case, I mean, that was a fairly small sample, but over 50% of those patients avoided amputation. This is really significant if you think of the developing world and equal access to healthcare. In another study, a Japanese study, which I'm going to move on to Japan now, a Japanese study where using autologous immune cell therapy, they took 200 millilitres of blood from a patient, isolated the stem cells in the laboratory and reinfused those activated cells into the patients over 6 months. This is in a study about stage 1 and stage 2 cancer, so very early stage cancers. Now, that study showed that 1,300 patients in this study who were in remission from cancer. So they went into the study already in remission. There was 0 reported recurrence in stage 1 and 2 solid form cancers over 10 years. That's significant. And that's the sort of stuff we're dealing with now. We've mentioned Japan. So let's go to Japan. Japan, Abe, the Prime Minister, saw the incidence of cancer growing exponentially in the population, with a declining population and the cost to the health system. At the same time, and you probably know this history, Professor Shinwa Yamanaka won the Nobel Prize for Medicine in 2012 for his stem cell research. And Japan passed the Regenerative Health Bill in 2014. What they did was they allowed, what that bill allowed was, after they had proven stage 1 and stage 2 trials, they had proven that the stem cell therapies being used didn't hurt you, didn't kill you, were safe, then you can commercialise them and continue to use the Japanese regulatory system. So after they're declared safe, a place like Australia, it's all these things are available, but you can't get them because the TGA hasn't approved them, and it'll be 10 or 20 years before they do. And that goes back to what happened in America with the moral outrage that people were using embryonic stem cells, because Yamanaka's study was on embryonic, but it's not embryonic stem cells. Nobody using that. It didn't work. So Professor Kilby tells me. What they use now is cord blood cells, which are equally as strong. So Japan poured billions of dollars into regenerative healthcare and research and supported commercialisation. So in fact, cord blood's regularly used, and Japan maintained that regulatory system, the only country in the world to have that sort of rigour for safe procedures, regulated and controlled. So what are we up to? DAI, my new company, has won a job with Simpler Health, which is an Australian biotech and regenerative healthcare group, to build a 200-bed treatment facility in Bali, Indonesia. We managed to get a $700,000 grant from the Australian government, from DFAT, to do a feasibility study of this hospital. And we found a special economic zone in Senur that gets tax incentives, using international doctors, using overseas regulatory systems into Bali, Indonesia. And so what we did is we went and brought the Japanese technology. We spent about 6 months on this, bringing the Japanese parties to build the technology into Bali. And there was an agreement now between the Japanese Minister of Health and the Indonesian Ministry of Health. And by agreement, they're building this project. And we're also supported, very importantly, by the leading immunologist of Kyoto University in Japan. And it's being built next to the Bali International Hospital, which is run or invested in by the Mayo Clinic. So it's pretty exciting. So I'll get down to the pitch now. I'm pitching on behalf of Simpler International. So this is the artist impression of the building that we're building. This was a site visit to Bali we did recently. Dean Kilby's the one sitting on his own there, and then we're in different groups there. There's a major hotel next to it. We've got the Bali Clinic. It's 9 hectares. It's all about medicine and regenerative medicine with the Mayo Clinic's backing. And when I was travelling back on my very full Jetstar flight the other day, I realised that more people are travelling now, and this is a fact, more people are travelling now than they were pre-pandemic to Bali. Bali's a beautiful place. It's a place of healing just in itself, a beautiful place populated as it is. So cell therapy, so immune cell therapy, mesenchymal stem cell therapy, and also cryopreserving stem cells. So it's an enormous opportunity to affect a safe, regulated environment to improve the health and strengthening of your immune systems, can help prevent cancer development in healthy individuals, and an opportunity to invest in this project, which you're very welcome to join us. We're investing in it. So it's real. It's real. We've formed a unit trust, an Australian regulated unit trust. Often people like to invest in Australian companies. Mills Oakley have helped us to do that. And then we're searching for an anchor investor for US $25 million for the build. It's a real opportunity. In conclusion, the Japanese regulatory approved healthcare facility in Bali will be the first of its kind in the world outside of Japan. It's governed by a strategic partnership with Kyoto University in a special economic zone with tax incentives, international doctors, supported The international hospital is supported by the Mayo Clinic, with a local Indonesian partner who's running a medical tourism business where, for Indonesia alone, $2 billion worth of medical tourism leaves Indonesia to go to Thailand and Sydney and Singapore. Want to recapture a portion of that, but also for Australians going to Indonesia, which is why the Australian government has supported it, and people from all over the world. It will be one of the most advanced regenerative medicine destinations on the planet. I invite you today to join me on this mission, a passion to make a difference and to live to 100 happily, healthily, without being a burden to our society's health system. Thank you very much.
What a great suggestion, Stephen, living to 100 and healthily doing that. So I just want to spend a couple minutes and talk about something that I'm really passionate about for going forward. And one of my biggest beliefs, I showed this in my early slide, is that we are super passionate about creating opportunities, what I love about what we do is we literally create things from thin air. Like I always think about, you guys could have all been in somewhere else today. Instead, you chose to come here. All the companies that are presenting could have been somewhere else today, and they decided to be here. And it's like this beautiful ecosystem, the network effect that gets created from it is something which is special to me, and something that you can't do it, like online you can do a certain aspect, but there's something powerful about the in-person part. Like I look around and I see faces that I've known for at least 10, 12 years, right? And one of the biggest decisions I made that ended up being one of the most important ones for me, and I'm going to strongly encourage you, whether you're an investor, whether you're a founder, whether you're industry, is that the best decision I made was actually testing our potential in Singapore. So I'll put the details up here. You know, one of the things that a lot of people utilize us for from a company's perspective is that for the last 9 years, we've been building networks, building relationships and so forth in Singapore. And it's just, for me, like, I don't know how to describe it. Like the friendliness and the warmth and the nature in which people recognize and receive us there is something that I really love. And so basically in August 31st, we're going to be hosting our venture and capital version of this in Singapore. We expect 300 to sort of 500 attendees at Marina Bay Sands. And so whether you're on the investor front or whether you're on the founder front or whether you're on the industry front, I strongly encourage you to basically come and join us in Singapore, even if you had zero plans to go to Singapore this year. Because what you realize is that Australia and Singapore is far closer than what people appreciate. I remember the first time I went there, I was going around in taxi cabs in a suit and a tie, you know, very stuffy and so forth and singing. And then now, you know, it's like shirts and jeans in every meeting. They are some of the most friendliest people to do business with. But more than that, the amount of doors that get opened up because of a lot of the Asian investment groups actually have their sort of main sort of investment vehicle based in Singapore. The amount of networks that you can get from just one trip to that is astonishing. So I just want to make that encouragement for all of you. If you haven't been to Singapore in some time, or if you want to test what your potential is, or if you just want to build your own investor relationships there, our Singapore Venture and Capital event is incredible to do that. So that's it from me. I just want to give that strong encouragement to come and join us in Singapore. You'll see communications come about over the next sort of month. That's it from me. Over to you, Shayla.
Thanks, Steve. I'd like to invite Dr. Christos Papadimitriou, CEO and Managing Director of Tessara Therapeutics Pty Ltd.
Hi, everyone. That was a fantastic keynote talk and really sets the background for my presentation as well. Good afternoon, everyone. I'm Christos Papadimitriou, CEO of Tessara Therapeutics. And although we have a regenerative medicine opportunity as well, today I will tell you more about our drug screening opportunity. So Tessara commercializes a disruptive drug screening platform that enables the pharmaceutical industry to bring better therapies for neurological diseases to market while saving millions of dollars in the process. Our platform is based on the real brain technology that we use to create human mini brains. We are the first to deliver a scalable and predictive human brain model suitable for the pharmaceutical industry. We have generated our first revenue very recently, and we have now a pipeline of more than 20 customers, highlighting our potential to become the new gold standard in a $2 billion market. Tessara is raising $5 million to expand operations and distribute our technology globally. We target more than $80 million in annual revenue by 2028 and an exit event in 3 to 5 years, offering more than 12 times the return on investment for our shareholders. We present a unique opportunity for investors seeking to capitalize on Tessara's imminent value inflection points. Also, your investment will contribute to the development of better therapies and healthier communities for all of us. The biggest problem in the pharmaceutical industry is that existing testing methods poorly predict the effectiveness of new therapies in humans. We can see the impact of this problem in dementia and Alzheimer's, a killer disease that will affect most of us at some point in life. There is no therapy available, and the failure rate for new drugs is higher than 99%, wasting billions of dollars from the pharmaceutical industry. FDA recognized this problem, and they removed the requirement for preclinical animal testing, a move that underscores the need for more accurate, human-relevant testing methods to bring better therapies to market. This is exactly what we have created, a human-relevant mini-brain able to find the best therapies early in their development and save millions of wasted dollars from failed clinical trials. What you see here is not a cartoon, this animation. They are real neural networks that function and respond to drugs like a human brain. We can mass produce our mini brains with unparalleled reproducibility, making them suitable for the pharmaceutical industry. And importantly, we can make them develop Alzheimer's. Our 8D brain model of Alzheimer's disease has been used already to identify new therapeutic candidates and has been international news when we published our findings. With Tessara Therapeutics, we scale up this technology and make it available for the pharmaceutical industry. Real brain technology successfully predicted already the human responses of more than 20 known drugs, including Alzheimer's disease treatments, and the list is growing. To create our mini brains, we mix human neurons with our proprietary biomaterials. Our biomaterials then instruct the neurons to start building brain tissue like they would do in the actual brain. And after 3 weeks, the microtissues are ready for use. Our first commercially available products are the RT brain model of the healthy version of the human brain, the AT brain model of Alzheimer's disease, and this will be followed by our model of neural development, traumatic brain injury, and brain cancer. Unlike traditional cell testing methods and existing brain-like technologies such as organoids and spheroids, Real Brain uniquely combines predictivity and reproducibility, making Tessara the first to deliver a human mini-brain system ready for industrial use. Tessara holds a grown IP with international patent families, proprietary methods for biomaterial synthesis and manufacturing of our microtissues, and a pipeline of novel drug screening models. We are not a service provider, we are a technology company. Our customers are contract research organizations and pharmaceutical companies with an addressable market larger than $2 billion per year. Tessara Therapeutics will charge an upfront technology access fee and generate ongoing revenue from the supply of our biomaterials and cells. We have generated our first revenue through pilot drug screening projects, and more than 20 companies are in a waiting list to access our platforms. Due to confidentiality, I cannot mention the names of these companies, but I'm happy to discuss with you during this conference. Based on confirmed selling pricing, cost of goods, and market penetration estimates, we aim to be profitable by 2026 and generate more than $80 million in annual revenue by 2028. Since 2019, we have raised $6 million, bringing us at the cusp of commercialization where we are today. Now we raised $5 million in exchange of 20% of the company. This capital will fund the expansion of our operations, generating more revenue, and will help us to establish our technology globally through a network of distributors. We plan for shareholder exits in the next 3 to 5 years by trade sale or IPO, and generate more than 12 times the return on investment for our shareholders. All this is possible because we have a team of industry experts with proven ability to achieve value inflection milestones. So, we present a unique opportunity for investors waiting to capitalize on Tessara's imminent value inflection points. And at the same time, your investment will contribute to the development of better therapies and healthier communities. Thank you very much, and I would be happy to tell you more about our technology in our booth.
Thank you, Dr. Christos. I'd like to invite Corinza Phoenix, Executive Chair and Founding CEO of MyoPharm.
Good afternoon. My name is Corinza Phoenix, and I am the Founding CEO and Executive Chair of MyoPharm Limited. On behalf of the MyoPharm team, I'd like to extend my thank you for this invitation, and it is my pleasure to be presenting to you today. Please allow me to give a small insight into MyoPharm as a business. We're a leading biotechnology company, and our mission is prevention of diabetes and all metabolic-related diseases. Firstly, a bit about diabetes. It's the fastest-growing chronic condition. The International Diabetes Federation have now released new figures that suggest that the comorbidities in diabetes have now surpassed that of cardiovascular disease and oncology at once, thus placing a big strain on the healthcare system. So let's touch on diabetes. There's now around 800 million people affected by it. Diabetes mellitus is a complex disorder to live with and to treat, and there are many different types of diabetes. The incidence vary from country to culture. However, it usually has serious complications and comorbidities. Closer to home, the Australian government have recently launched an inquiry into diabetes, and particularly into diabetes research. Currently, the gold standard for treating diabetes is metformin, the most prescribed generic modality in the world. The problem with metformin is that up to 50% of people can't tolerate it, or it's not optimized. Thus, they experience treatment failure, never really achieving long-term sustainable glycemic control. In spite of these intense therapies and modalities used and currently marketed drugs, these 50% of patients that experience these comorbidities never really achieve their treatment goals. This failure to achieve their treatment goals puts a huge burden on the glycemic control mechanism, and therefore puts them on a certain path to receive and to get diabetes-related complications. Complications such as diabetes retinopathy, stroke, skin ulcers, hypertension, and diabetes kidney-related disease. The list of complications goes on. Metabolic disease, particularly type 2 diabetes, is an inflammation disorder. And MyoPharm's solution is Triglitzer, also known as RK01. It's a novel beta-centric dual combination formulation that consists of valsartan and celecoxib. One's a delayed release and one's an instant release. Triglitzer is our lead candidate. Because of the beta cells and their inherent incapacity for compensating an insulin resistance, systemic glucose intolerance, pro-inflammatory signals originating from the activation of cyclooxygenase 2 in the RAS system induce progressive deterioration of pancreatic beta cell function, which therefore leads you to insulin resistance. Ultimately, beta cell function is important, and beta cell failure and insulin resistance leads to diabetes complications. Needless to say, there's plenty of scope for new modalities and innovation in the type 2 diabetes space. Triglitzer, RK01, can also be used in isolation as a monotherapy or as an adjunct therapy to metformin. Our commercial pipeline for Triglitzer is tracking well, At the moment, we have started to raise capital for our commercial formulation. So we are formulating from a tablet into a polypill with 2 different timed releases. Preceding that, we'll go into tranche 2 capital raising for our phase 1 to phase 3. We're a highly experienced board. We've got eight PhDs on the board. We've got, in the team, we've got 2 medical doctors and 1 legal counsel. We also have a formulation expert and we have an endocrinologist. So MyPharm is a snapshot. We commenced in 2020. We're in the diabetes and obesity space. We're IND approved with 68 metabolic claims. Our lead candidate is Triglitza, and we're focusing on beta-cell-centric dual combination drug development. We're outsourcing to CROs, and we're inflection point driven. We are 100% unencumbered. We own all our assets across both portfolios. To date, we have raised $2.8 million, and we're seeking a further 2.9 in 2 tranches. We have an internationally recognized board and scientific advisory, and this year we have executed 3 licensing agreements. The diabetes drug market is set to reach $91 billion by 2029. Recent acquisitions in the diabetes space, I get a lot of questions about this. Essentially, it's usually you're acquired within a phase 2, and recently a company was acquired for $500 million, including shares and cash payment at an IND stage. So outside of our Triglitza program, we also have built and own a food for special medical purpose business that's focused on strategic partnerships and sold through pharmacies. It's an end-to-end solution for diabetes and obesity. Our key flagship product within this group is OmniD. OmniD was researched and developed through the Baker IDI and through Adelaide University. It has had over $8.1 million spent on it. It flattens the glycemic curve after you eat a meal or a heavy carbohydrate meal, thus not inducing the organ damage that can come with type 2 diabetes. It's strongly endorsed by key opinion leaders, GPs, and most importantly, diabetes accredited educators. And it's perfect for those who want to make a lifestyle change or possibly target remission if they've been newly diagnosed. So our capital structure is very tight. Our market capitalization is $4.5 million. It's a modest valuation. We're raising money at 12.5 cents. We have just over 36 million shares on issue, and the bulk of the funds for this round are going into our formulation of our polypill. So why would you invest in MyPharm? It's a good value proposition. We're de-risked. We're talking about repurposed drugs. We have direct market access. We have an expert team, novel products end-to-end for all types of diabetes, from pre-diabetes, type 2 diabetes, and uncontrollable diabetes. And we have a comprehensive IND with over 68 metabolic claims. And we are ready for phase 1. Thank you for your time.
Thank you, Karinza. I'd like to invite Margie Baldock, biohacker or AI lead of Future Health.
Hello, friends. I am Margie Baldock, but I have a confession to make. The company I represent is not Future Health, and that is not our logo you see on the screen. Sadly, the true company name is under wraps for 2 more weeks when we get to announce who we have partnered with, because they are the leaders on a global scale in the space I'm going to represent to you today. And what we have done, they've curated the solution to the problem. We've picked it up and we're bringing it to this territory so that every Australian and hopefully Kiwi and Southeast Asian can get the benefit of the past 4 years of great innovation in this incredible wellness space that our speakers today have started to touch on. So I am talking about rolling out wellness centres across Australia that have the latest game-changing IP. And the reason this is so important is because I do government lobbying as a job as well. And in the research that our Australian government has done, health is the number one priority on Australians' minds at the moment, followed by cost of living, naturally, and a very distant third is actually climate change. So we know that Aussies want to be well, and we've got the solution to that. Let's see if I can make the slide work. I did, yes. Okay, I think. Nope, I didn't. Could I get the slide to move on, my friends, please? Great. So think Apple stores for wellness. That's the look of the retail component of these wellness centres. Now, what we offer is proactive, preventative and personalised treatments to ensure people have optimal health for their whole lives. Some of the speakers have mentioned the state of our health at the moment. Half of Australians currently have some form of cardiovascular disease, and the first symptom for 50% of those Aussies will be death. Cancer's not much better. 40% of us will get cancer and 17% of Aussies will die with that diagnosis. So these diseases that are killing us, diabetes, you name it, most of them are actually preventable if we screen you, catch it early and treat it. And at the corner of the treatment of most of these diseases is actually treating inflammation, which our speakers have mentioned. So we've got some amazing TGA-approved inflammation treatments that we can give people today, and we've got cutting-edge things coming such as stem cells, peptides, exosomes, that we are going to be able to work with the regulators to introduce safely into the Australian market. And I'll tell you how we're going to do that in a moment. But importantly, in the overseas experience, as I said, this has been curated, both the treatments and the marketing of the treatments, so that customers understand what they're getting and get the full benefit of it. So it's been curated over 4 years to work out what works. We're picking that up and bringing it here. Now, in these centres overseas, 1 in 3 people who walk into these beautiful bricks and mortar centres, when they're screened, we are going to find that they already have the start of a life-altering condition. So by getting to those people, screening them and dealing with that information early, we're going to save lives. And that's what's happening overseas. And when these stories hit the press, people are gobsmacked with what's happening. Major celebrities are finding that their lives are being saved and they're telling those stories. And we're going to be able to start sharing those with you in the Australian market in as little as 2 weeks. And we can't wait to do that. Sadly, I'm NDA gagged for 2 weeks. But if you sign an NDA with me, I can tell you everything. So please, if you're interested, reach out. Moving up forward, my slide. Okay, nope. The middle one, the green one, great. Thank you. So this is the secret sauce of the offer, our proprietary wellness technology. This is an AI platform like nothing else I have seen anywhere else, and I've been in AI personally for 20 years or since the start of the whole concept. So essentially clients come into our centres, we get their genome done. It was $1 billion when the first one got done. It was about $5,000 10 years ago, now $500. It's going to keep democratising. Everyone will be able to map their genome in the very near future. Then with biomarkers, hormones, nutritional status, we're able to give an interactive wellness plan customised for that individual. Essentially, I'd like you to think of it as a clinical trial of one, where you are the clinical trial. And we work out with each client exactly what nutrition, what exercise, what supplementation, what interventions they personally need to lead a vital, peak healthy life. And if we do catch disease, as we do in 1 in 3 clients, it costs 80% less to treat those people when we catch it early than if we wait till they get a nasty symptom and then we face chemo, radiation, loss of limbs, surgery, you name it. Importantly, as an offer, this data remains with each client, personalised and private for their own interaction with clinicians in our centres. However, the de-identified data, we have that as a company across all cohorts, meaning we can work out in men of a certain age who have this genetic profile, if we do this, this and this, what are the health outcomes? And where this gets really exciting, the Australian government is begging for this data right now, and they're prepared to pay very, very handsomely for it because we are being bankrupted by our healthcare system. It's not working and it's very, very expensive. We, as I said, can do everything 20% of the cost if we get to it early and are proactive and preventative. So the government is giving $20 billion for this kind of research at the moment. I work as a lobbyist, we're working with government, we're already positioned to take advantage of this research. And we then can formulate healthcare guidelines going forward to keep cohorts uniquely healthy based upon what they need to do for their optimised health. And we have a health insurance offering as well for well people, the coveted demographic that every health fund wants. We know who are healthy because they've come into our stores and we have their data. We can therefore give an actuarially based price for each person based upon their conduct with regards to their health. This is extremely lucrative. We have begun it and we're going to be rolling it out. Now, going forward. Right. Running out of time, so I'm going to skip to who the team is. So, think of us as a data company, a research company first and foremost. The people behind it, we have a massive overseas team. As I said, we're picking up a curated solution and popping it here under NDA. I will reveal those players. They are the world leaders in this space. Think stem cells, peptides, exosomes. We have the leaders who have done clinical research that we are going to be able to, with the Australian government, in our clinics, under grants, introduce in a test basis in Australia, and then as it becomes proven, roll it out as a standard treatment. Our team, Dr. Kelly Francis, she's in the audience here today, an integrative GP, 25 years experience, but she's at the cutting edge of these proactive treatments. So IV therapy for nutritional deficiencies, customised to what you need, not just anything goes. No, customise what you need so you get peak health. She knows ozone therapy. She's studying peptides and stem cells, which we can't yet do in Australia, but we are, with our ability to lobby government, going to be able to. Secondly, Graham Stark, a lobbyist of 30 years, so he knows everybody in the corridors of power and media in this country. So we can make a media phenomena explaining case by case how we saved a life, how we turned around a cancer, how we transformed individuals, households, because they went from disease to wellness. So we're going to tell these stories one client at a time. Then me, an AI lover. I did my first software in 2001. So this is an extension of my love for all things tech. Again, running out of time. So what are we after? We have everything we need to launch very, very soon in Australia and roll out ubiquitously. We're after $1.5 million to finalise the AI system for the Australian conditions. We are prepared to give 25% of the whole play to the person who brings that up. We have a lot of stores already developers saying, come and develop in our new development. So we've got prime sites being thrown at us by billion-dollar companies at the moment. So if you like what I'm saying, talk to me. There's so many deals to be done in this space right now. And next, we'd like to roll out New Zealand and every Southeast Asian country. If you have a medical license in any of those jurisdictions, or you have contacts that would see the value of this, please talk to us now, because when this launches in Australia in 2 weeks, it will be a phenomena. The people behind this are the world's best. Lots and lots of celebrities are on board, and 5-star reviews for every centre that is running this now. This is coming to Australia. We'd love you to be part of it. Thank you.
Thanks, Margie. I'd like to invite Ian Reynolds, co-founder of Feasley Pty Ltd.
Good afternoon, everybody. My name's Ian from Feasley, which stands for Feasibility Easily. We help property developers do their financial modelling in the cloud. See if I can get it to work. Here we go. So we built an intuitive software as a service platform to remove the complexities of the many things that property developers have to deal with, from acquiring sites, all the associated costs, managing construction, sensitivities, contingencies, acts of God, sales modelling, all the sorts of things they have to do. And that currently they're trying to manage all that process with a spreadsheet. More about that later, of course. So here we are as a platform. We in first sales. We went to the market and acquired 100 users very simply, without doing any marketing. They all paid us as well. And they came back and told us of all the things they needed to be done to complete the product. So we're back building the final version to be commercialized, hopefully in October. So these are the experienced founders. I'm the good-looking one. I was a derivatives trader in London for banks, so I know maths. And since I came to Australia in 2002, I've been investing in startups. So it's rather unusual for me to be standing this side of the fence, being all nervous. My other co-founder is Elizabeth. Elizabeth was the head of digital at News Corp for a long time, and her speciality is commercializing SaaS platforms. She ran their Bolt, I think it was called Bolt Accelerator, where all of the not so good investments of News Corp went to be fixed up, patched up, and sent back into the market. We're ESIC qualified, which means that the government has very kindly given our investors via the ATO tax offsets equal to 20% of the investment, and also relief from capital gains tax if they keep the shares for just less than 10 years. So why a feasibility and financial modelling cloud solution? So let's talk about the product that we believe is essential in the marketplace. Property developers live and die by the numbers. It's all they do. And they are right at the beginning of the development process, and developments power cities, towns, villages, hamlets all around the world. If you think about it, in the last 50 years, how many buildings have been built with some sort of feasibility being done on it? I don't know the answer to that. So currently, software options are the problem in that everybody uses spreadsheets. There's one cloud solution, which is for enterprise only and very expensive. And no doubt, Mirvac and the likes in-house have in-house proprietary software and spreadsheets and modeling stuff, which doesn't get outside of their business. And spreadsheets, well, they're often inaccurate, can't share them very easily, and we'll talk about that in a sec. So this is the title I like. Spreadsheet errors are at a pandemic level. So there's a link on our website to an article by Forbes magazine, which says 88% of spreadsheets have formula errors in them. And 50% of spreadsheet models in large businesses have material defects. And I'm sure you can realize if you're doing a multi-million-dollar development project and you put a large number in the wrong cell, it's not going to be good. Well, it could be good, I suppose, but it's not going to be accurate. So a cloud solution is the immediate opportunity. What does a cloud solution do that spreadsheets doesn't do? Well, firstly, it's 100% accurate. It's a single source of truth. There's no more different versions of the same spreadsheet going around. It can be shared natively on the platform. Pricing's an opportunity for us. Currently, there are spreadsheet and derivative spreadsheet software models that are rusted into the marketplace. Some are 25 years old. And so they've done a really good job at the time, but now it's time for a change. So we come in at sort of 40% of the price of the current incumbents. So what is the size of this industry? Well, I can tell you, it says here, 411 billion construction industry revenue. Obviously, that's got nothing to do with us. We contribute to it, but that's a really big number. So our initial market is about 60,000 user licenses, which comprise of individual developers, mid-sized development companies, town planners, valuers, etc. So that's our Australian beachhead. Our biggest challenge, of course, is getting people that have been using spreadsheets for 20 years into the cloud. Why hasn't the gap been taken? Getting people off spreadsheets is difficult. There's been no solution there that is ubiquitous. The cost to build technology is very expensive because you can't get any money out of it until you built it and delivered it. Also, property development modeling financials are very different because they're project-based rather than company-based. So a cash flow of a property development project is vastly different to one of a company. So this is our short game, and there's a long game as well. So we've developed what we called this tool, and we spent 3 years developing it so far, which is longer than we thought it would be. So the short game is Feasly One, where we help property developers manage those, site acquisition, expenses, construction, acquiring the debt, selling the product, renting the product with build-to-rent products, covering residential, commercial, industrial, hybrids, all of the things, stage development, all of the things a development company would want to see. Currently, we think the market is there for the taking because there's a gap in the market and a market in the gap. So this is the short game. The long game is called Feasly 2, which is pretty unimaginative. And this is where we put our tool on top of a two-sided marketplace where developers can come and do feasibilities, work out how much they need to borrow, and lenders such as banks and, of course, non-bank lenders can come in and lend them that money to get those good developments going. So it should build greater accessibility for property developers to capital, and it should build better portfolio management for banks and non-bank lenders. This is a RegTech solution. This is down the road. We're still commercializing Feasly 1.0. So what we've done so far is we've launched an MVP. Sorry, to start again, we're ASIC qualified. We raised some money. We built an MVP. We went to the market, got 100 customers. They told us what we need to build, and we're currently building all of the extra features to commercialize it properly in October. So there's immediate pipeline, commercial, industrial, all the things that are being developed at the moment. The long game, as I just said, Feasly 2.0. So why are we here today? We need money to have more team. Currently we have just the two of us and 3 developers in Vietnam. We need more products, as I've just said. We need to automate testing, and we need go-to-market funds. Why would you invest in Feasly? We're in the market, got first sales. It's critical that property development moves into the cloud, we think. It's a subscription model. I'll tell you some numbers in a minute. So the top line commercials, we break even at about 850. It says 890 there, 890 subscribers. That's possibly about 10 months into commercialization. And that would give us an ARR of about $1 million after about a year. The cost to acquire a customer is low, and there's a very low churn rate normally once you move customers from legacy products to SaaS products. 0, for example, for accountants, and Atlassian products, Jira Confluence for software developers, Monday for marketing. So we're raising $500,000. $300,000 is already funded this week. If you want to come and have a word with me, I'm at booth 13 outside. These contact details will be removed in 10 seconds according to the clock there. But come and have a word with me. Find us online. Thanks very much for listening.
Thanks, Ian. I'd like to invite Craig Bannister, Executive Director of Palace Capital.
Thank you very much. Good afternoon, everyone. My name's Craig Bannister, Exec Director of Palace Capital. A little bit about the group. Palace Group consists of 2 separate businesses. One is Fortis Development Group. They are a development manager, and they are currently developing 32 development sites through Sydney, Melbourne and Brisbane with an end value of a little over $4 billion. That's one side of the business. The other side that I'm here to talk to more about today is Palace Capital. Palace Capital is one of the non-bank lenders in the space. We make loans to commercial real estate debt loans to developers, and then we fund that through investors. And our investors generate returns between 8 and 18% in these debt investments that we organise. A little bit about us and the numbers. We've done a little over $3.1 billion of lending. That's 420 odd individual transactions. Along the way, these loans are relatively short term. They're sort of 9 months to 18 months in duration. And so 1.4 billion has been repaid, and we've got an outstanding FUM of about $1.7 billion. Along the way, we've paid $190 million of interest to our investors with 0 loss of capital or impairments on any of those loans. The origination pipeline for us, we started back in 2016, and we're now up to about $1.5 billion of origination per annum. It's a strong pipeline. There's a great need and demand out there. We tend to lend to borrowers that just fall out of the bank space. If we're talking about commercial real estate loans, we're generally lending to people building smaller apartments, commercial or residential apartment blocks, and for whatever reason, they're just falling out of the bank space. So that could be certainly time to market. People going to the banks are sort of 4 to 6 months to get approvals through. We could be up and down in 4 to 6 weeks with approval and money to the developer. Yes, we are more expensive than the banks, probably 2 to 3% more, but time factor, we're flexible on our loan terms to the borrowers, and that's why this market space is expanding so rapidly in terms of the growth of non-bank lenders. The opportunity here, with some numbers here around APRA, the market's growing from $375 billion up to $475 billion out into 2026. Traditionally, the big four banks had 85% of this lending market, and that's changing now. It's the non-banks that are taking up more of this extra $100 billion over the next 4 or 5 years. The non-banks will probably account for about 30% of that. And a lot of that money is coming in from offshore. We're seeing a lot of the US fund managers coming through, deploying capital into Australia, and they're looking at Australian market. And I spoke to one of them recently. They said, look, we love Australia. We know the history of it. The commercial real estate market and the property market in general has been fairly stable. Yes, we have our ups and downs and we go through dips of 10 to 15%, but as we've seen in the last year when everyone was calling for 30% property and it was all doom and gloom, we're back up and we're starting to rise. And immigration's a big part of that and the supporting factors for property in Australia. They like our legal system. It's very well supported there and it's easy, much easier than the States, for example. So a lot of money flows this way. And the currency is easily tradable. So Australia is a great destination for offshore capital coming in, looking for opportunities in the commercial real estate debt market. Lack of volatility is one of the big plays in this. As debt providers, we generally lend to 65% of the end value of a project. And so, yes, there are, we've got to get from here to there to complete the project, but within that space, we've never had a dollar in impairments or losses. Now, you compare that against equity markets or bond markets in the last year. Of course, they've been up and down and people have certainly incurred losses in those markets. We've continued to pay our investors this fixed return, which is based on a margin that the borrowers are paying. So in the last year, we started to change our methodology. We previously were a fixed rate to a borrower back in 2018, 2019, and a fixed rate to an investor. And then with interest rates, when they started to rise, we were making a margin over a fixed rate. So a rate to a borrower might be 6%, 7 or 8% plus the BBSW rate now. And BBSW is now at 4.1. So we might be lending money to a commercial real estate developer building an apartment block at, say, 12%. And our investors are getting a rate of now 10%, 6% plus BBSW. So we've been able to move up with inflation. It's a great inflation hedge. And so this lack of volatility is one of the reasons why I see quite a few investors coming through to look at our space. We've got various products for investors. We've got single asset opportunities, which people can pick and choose the style of investment. And then we've also got a pool of mortgage funds. Some of the rates here, 4.756 and 6.5 plus BBSW. So we're getting up to sort of over 10% for first mortgage debt at 65 LVR, which basically means that property's got a 35% equity buffer. That prices could fall and then that's the equity buffer that's going to protect you as an investor. We also have some interesting 18 to 25% returns, and that comes back to the Fortis developments. In those 32 developments for Fortis, we fund those through wholesale investors. So our wholesale investors take up preferred equity and ordinary equity opportunities in those developments. And that's the sort of 18 to 25% returns that are available there. So thank you very much for your time. We've got the booth outside. If you'd like to learn more, just come and have a chat to us. Thank you.
Thanks, Greg. Please help me in welcoming our next speaker, Chris Carrigan, Head of Property Investment at Quanta Investment Funds.
Thanks very much. Good afternoon, ladies and gentlemen. I'm Chris Carrigan from Quanta Investment Funds. By way of introduction, we're a Brisbane-based real estate fund manager. We are a multi-sector specialist, so meaning that we're not beholden to any individual sector. We've got an agnostic approach where we simply seek out the best risk-adjusted return in both sector and market. We currently have a portfolio of investments over $300 million. That's oscillated depending on market conditions, and the investment strategies for each of those investments has been as much as $700 million in the last 12 months. We have approximately 700 wholesale investors that invest with us in scale between $40,000 and one investor over $50 million. As I mentioned, we're in Brisbane. We have a staff of 35 people, and that we have in-house acquisition, investment management, property management, facilities management, project management, so that we can deploy management into these investments very easily. So in terms of our investment style, we predominantly have invested historically in retail, so shopping centres, but we also have industrial, office and some health investments. We are a core plus and value add investor. So what that means is our investment style is to give a very strong distribution that we pay net of expenses, interest and fees to investors monthly. We target a minimum distribution of 8% per annum paid monthly, and an equity IRR of 11 to 18%. That higher end of that IRR scale is based on the value add style assets that we target that have a very strong value creation thesis to them. As mentioned, our market we're somewhat agnostic in what markets we target. We're invested in every state in Australia except for Northern Territory, South Australia and Victoria. Our trusts, we've moved away from pooled open-ended trusts, and we typically we are bringing to investors typically single asset closed-ended trusts, so that we give investors certainty of what asset they're investing in and the certainty about how long they're going to be investing. So the last 4 trusts, including the one I'm about to talk about today, are 7-year trusts, meaning that we have an investment outlook, an investment horizon of 5 to 7 years, and once we have delivered the value creation initiatives we have as a part of that investment strategy, we look from year 5 or thereabouts, we're looking to exit that investment and return the equity to investors. As I mentioned, invested right across Australia, and that's currently 21 properties in 8 trusts. A couple of recent acquisitions. The property on the left there, Quanta Launceston Retail Trust, is a large format retail asset, 100% leased in Launceston, as the name of the trust suggests. Launceston was a market we really liked. There are more tenants that want to get into Launceston than there are tenancies available for them. We also bought that asset very counter-cyclically, and so we were able to buy it at very soft metrics. We're delivering 8% distributions to our investors currently, and upon renewal of the 4 tenants in approximately 3 years' time, we're expecting a strong capital growth and then an exit strategy. The multi-sector trust is a very robust safe haven style investment that we acquired again in 2022. It has a lot of health uses, service station, and has very long leases. Our strategy for value creation in this asset is that it's a classic case of the sum of the parts is worth more than the whole. So if we are to subdivide off service station, the food pad sites, sell them individually, we're going to be able to sell them for a lot more than what we bought the asset for. 157 Ann Street was another acquisition last year where we acquired a 48% occupied office building with a pre-commitment for a sports performance and recovery centre to take out the majority of that vacancy. In the 9 months since we have acquired that asset, we've done 8 leasing deals and that's now 100% leased. The broad brush strokes of that investment are 8.15% distributions being paid to investors monthly. We bought the property for 39 million. We've spent 7 million. It's currently valued at 59 million. Next week, we launch the South East Queensland Office Trust, which is 2 assets in a closed-ended trust. So again, an investment horizon of 5 to 7 years, forecast average distribution of 8.5%. What is really standout of this investment are 2 things. One, the tenancy mix is unrivaled for this type of asset. Within these buildings, they're 99% leased, but 73% of the tenants are Commonwealth Government, State Government, Head Office for Queensland for Bunnings, Head Office for Queensland for Coles, Head Office for IOOF, NAB, and a whole host of household names making up the tenancy mix. It's got inbuilt capital growth, comes with surplus land with a DA that we're paying 0 for. We think that during the investment term, we'll be able to do something with that surplus land that has a carrying value of 0 and be able to deliver a special distribution to investors. The properties are under rented. Buoyed by the Queensland economy, the leasing markets, unlike Melbourne and Sydney, are very strong in Queensland, as evidenced by our performance and track record at Ann Street. We expect to be the tenants in these buildings average $460 a square metre gross, which is as cheap as it sounds. We believe that the market rent for these buildings is over $500, so we look forward to delivering rental upside and the capital growth that comes along with that. Could go on, time's running out. We are at the booth outside. As I say, this investment will be, we're raising $55 million. It will be launched next week, and we look forward to your participation. If you'd like to come and talk, we'd love to have a chat to you at the booth outside. Thank you very much.
Thanks, Chris. I'd like to invite David Brifa, CEO of Genix.
Good afternoon, everyone. It's quite interesting to come in after the property developers or property investors and hear what they're on about. Genius started back in 2016 to provide a solution to the property space. And we're not just talking about urban property, we're talking about farms right through to industrial properties. Clearly for us, we're seeing a shift in this market and it's all about sustainability, net carbon to 0, and also ESG. So ESG is about environmental, social and governance, sustainability. We add one other factor to that. We can't deliver that unless it's economic to our property partners. Our approach very clearly is to our partners, being the property owners, and also the tenants that they can provide. So we believe that any property developer or property owner needs to have a clear ESG strategy, or they won't be attracting tenants to their buildings coming into the future. We're already seeing that today. So our solution is about a decentralised distributed utility. So the problem that we solve is quite clearly that tenants and owners of properties are looking to sustainability solutions that they'll own, tenant or invest in. In terms of government, we're seeing government legislation driven from Europe with the Green Acts, with the Inflation Reduction Act out of the US, and we've seen the change in government in Australia with the Albanese government now pushing to a clear net zero strategy. So government legislation is on the horizon. We don't know what it looks like. We have a general feel what's going to happen, but it's definitely going to influence the economy. The second bit is flight to capital. In the EU, we have very solid evidence to show that capital will only now invest in investments that are ESG compliant. I can tell you by December 2028, every registered organisation in Europe will need to meet its ESG compliance requirements. Doesn't matter how big you are or how small you are, you'll need to meet that. Therefore, capital will be looking at those issues. Last but not least is the supply chain. The likes of Coles and Woolworths are saying to their suppliers, show me your scope 1, scope 2, and now they're even talking about scope 3, zero carbon emission strategies. That's massive. We know that there's companies out there right now that we're talking to are asking for us to give them a solution so they can attract the right type of tenant, a Coles or Woolworths, an IGA and so forth, to their premises. So the supply chain is definitely looking at this, and government is. So the market size is 1.2 trillion in total of the total clean technology market. It's a massive, massive market, and we're only scratching the surfaces here in Australia at this point in time. Our distributed utility model is different to most of that market. So we talk about distributed utility. Most people describe distributed utility as going from a centralised generation point and distributing that utility to different locations, properties, wherever it is, be it on electricity grids or be it on water schemes and so forth. Our model is quite different to that. We don't distribute the utility, we actually distribute the infrastructure that makes up that utility. What does that mean? Well, it solves a lot of market risk. For us, what we see is, just moving on, this is where we make the difference. What we see is there's massive, massive risk in dealing on the open market. We've already seen that on the NEM or the National Electricity Market over here for the last 2 years. With the increase in gas prices, we've seen a lot of independent operators disappear. We've seen some huge numbers being lost in the billions and billions of dollars for people that have been played on the grid. And I'm not talking about fossil fuel operators, I'm also talking about renewable operators as well. There is a huge risk in playing in the open market. The second bit as well is the consumers out there are looking for some relief. We've had cost of living increases. We know in the media they're talking about energy price increases every day. So we present a clear solution to that by embedding the infrastructure at the point of consumption. Our investors have said to us they are really, really concerned about playing in the open market. We present an opportunity to our investors where we have a clear line of sight to our customer with no intermediary in between. We collect every month and we deal directly and we can pay our investors. We're currently paying our investors an 8% return on their money behind these assets. So we ring fence our market. We've tested it in government. We've got all our contracts set and we know how to do this. So our significant point of difference is we own the infrastructure at point of consumption. We don't play on the retail market and we definitely don't play with the big boys, and we produce a very much a social dividend of reduced cost of living costs to our customers. Currently, we're providing our customers, our utility customers, a 15% discount to current grid rates. And I'll show you in a second our model in that regard on how we're impacting over here with our SME customers. But this is something that we say, and this is on our website. What is your company doing, or what is your property doing to target net zero to make the world a better place? This is a must do. This is not a wish that we should do or a want. So I said this is how we do it. When we wrote this slide up, we're actually providing our SME customers a 25% discount to the grid rate. I can tell you with the 1st of July increase, it's a 40% discount. And we're just getting a lot of positive feedback and demand for this. It's a very simple model. This is just a straight solar battery model. We target clients up to 30 kVA, which is general supply to an SME who operates from about 7 o'clock to 6 o'clock at night. No upfront cost to them. We put it in, we do a deal with a landlord. who benefits out of this as well. They get a clip, and our investors get an 8% return. So there's a win to the tenant, the win to the landlord, and win to our investors as well. Our bigger model, we're talking with a national port operator at the moment out of Western Australia who's going through a massive upgrade. We find by consulting at the front end, we can actually give them their ESG solution right through the whole project life of the property. So we consult, we give them sustainability solution, we do the installation, and then we do the ongoing asset ownership and management. Times are clicking on, so just what we've done to date. Started in 2017, we've gone through concept, we've gone through proof of concept, we've delivered projects, we're now monetising and we're producing income. So we've got about $10 million worth of assets that we've got completed or underway. We've got $3.3 million worth of assets under management. Excuse for the error there on the two next lines, but we've done 16 embedded network projects. The environmental impact, we're now working with the West Australian Government through their land developer, Development WA, to deliver their first true net zero building. That means they don't import any green energy. Everything is generated on site. 100% green. It's very exciting, and they're now giving us a second project. We target an 11% IRR on an ongoing basis, and we take contracts out to 25 years, and we're finding people are happy to sign those. So in a nutshell, we've got about 300 million in pipe, 48 million of those are assured. We're here today to talk about we've got revenue growth. We've got a great team of a board, all experienced public companies. We are projecting the company to go to listing in 18 months. So we've got public company experienced directors. We've got over 300 years experience in our team. We're looking to raise $3 million today. And that sits at about just over 30% of the company that we're looking to raise. Our application of funds, and sorry, I can't move forward. I'll try to. Is really to build our team, if I can get there. It's to build our team to help us meet our pipeline. I just can't keep up with the demand. The phone's just ringing hot, and I need to have my fulfillment team properly established. I've got some great skills already in there. I need a market to build my pipe as well. The 300 mil, we basically closed that off at the beginning of the year. We've got our own service as a software platform, which we just need to tidy up a little bit. It's an automatic billing system. It reads the utility, it bills as a utility, and actually gives you your carbon reporting as well. There's also the carbon market that we're dealing on. But look, lots of opportunity in this space. I thank you for your time. We're at stall 15 if you want to have a chat to us after this. Thank you.
Thanks, David. Up next, we have an engaging panel discussion on alternative investments, property funds, and private equity. Please welcome Ben Kingsley, Sam Phillips, Vanessa Hayes, Craig Bannister, and Colby Phyllis.
All right, good afternoon. Thank you for having me here today. My name is Vanessa Hayes. I am a portfolio manager and trader at State Street for the currency management business. So when we talk about alternative investment, we're talking about anything except the traditional bond, equity, or cash, right? If we're looking at alternative real estate sectors, already about 235 billion. So what does it mean? In terms of size, it's already the size of industrial or real estate sector. So for the next 30 minutes, we're going to be focusing on alternative. We're going to be looking at what level of exposures the investor should have, why it should be added in the portfolio, and most importantly, how. All right, so please allow me to introduce our panelists today. First, we have Sam Phillips. Sam is the CEO of Rich Alternative Investment. He has 3 decades of experience in financial services across Australia, Hong Kong, Taiwan, and US, while holding a few different roles in CBA and setting up a family office and managing a large China-focused fund in the US. Prior to returning to Australia in 2021, Sam was the head of secondary private equity at MCM Partners in Hong Kong. Welcome, Sam. Next, we have Ben. Ben Kingsley is a founder and managing director of Empower Wealth. He's also the chair of Nonprofit Property Investor Council of Australia, co-host of Australia's #1 residential property, finance, and money management podcast, The Property Coach, and a 2-time best-selling co-author in the same field. Next to Ben, we have Craig. Craig Benster is an executive director of distribution Palace. Craig has worked extensively across Asian markets while based in Singapore for over 20 years. And he had a different roles with major international financial services firm while building high-end relationships with senior managers and traders. Last but not the least, we have Kobe Phyllis. Kobe is a manager of investor relation at Arcana Capital, and Kobe has been involved in the property fund space since 2021. All right. I used a lot of time already, so now we're gonna move into the questions. All right, let me start with the first question is the shift, right? The current economy situation is very interesting. So what do you guys see, what's some of the shifts you're seeing in the alternative space? I guess let's start with Ben.
Yeah, sure. Obviously, we deal in direct residential property, and so we're basically helping investors buy existing established property across Australia. So our biggest shift, obviously, is around interest rates on the back of inflation. Some of the bigger challenges and some of the interesting observations is we were predicted to see property prices fall between 20 and 30% across the nation on the back of, obviously, a post-COVID record low interest rates movement. Now, what we've seen from that is that hasn't materialised nationally. We've only moved around 9%, and now we found the bottom of the market in February of this year. We still think that the market is challenged. We didn't get an interest rate rise on Tuesday, but we do feel like we're seeing an increased number of listings coming through. So although we are still in positive growth territory, we do believe from a property point of view, resi property point of view, that may flatten out a little bit before we then are confident that there'll be a freeze in rates and then obviously potentially a cash rate reduction next year, and we're off to the races again, potentially around what the market's going to do.
Yeah, I think there's definitely a lot of focus on we see the presentation on the property. Not only residential, right, Craig? Can we touch base on commercial real estate as well?
Commercial, a little different in terms of the commercial buildings. Under our business Fortis, we're developing luxury boutique buildings, sort of 4 to 8 stories high, and those suburbs are Double Bay, down in Melbourne, in South Melbourne, Cremorne. Generally, obviously, cap rates have gone up, and that's affected the valuations of buildings. Now, whether it's an A-grade building or a B or a C-grade building is the biggest challenge to the valuers to value a building. It's created a lot of problems around refinancing because valuers are always trying to sort of say, well, here's the latest data that they've got, and it's difficult. And actually, we're selling, Fortis has produced and we have a pipeline of completed buildings. We're actually selling one in Double Bay right now. It's in Guilfoyle Avenue. It's a 3-level building, and it's got a lease of 6.5 years with an anchor tenant. We want to sell that building to try to get a cap rate, to actually sort of put something in the sand to say to a developer, here you go, here's a 4.5% cap rate. That's what we'd like. I'm sure an investor would like to buy it at 5%. But we're going to find out really soon what's the actual demand like, and then that sort of starts the process. At least in Double Bay, you can start to put. So it's all about trying to get markers now. What's the value of a building? We've seen some of the big funds limit redemptions coming out of some of their big property funds. And unfortunately, I think they had to do it because otherwise they're into a forced sale of B and C grade buildings, which will just exacerbate the problem. So it's difficult. It has been difficult for the last 12 to 18 months. But as you said, if rates start to come off and stabilise, then we're off to the races.
I have to ask, what's your view on the rates?
On the rates?
Yeah.
Look, definitely. Inflation's coming down. That's been the biggest driver of rates going up. So without a doubt, across Australia and throughout the world, it's coming down. How fast it does is anyone's guess a little bit. No economist has got it right going up, and no economist may be right going down. China's interesting. They've got deflation coming through, and so we weren't hearing about that 6 weeks ago. Now it's suddenly a big thing. So watch that space, and we work out how quickly we can go down.
Thanks. Thanks for that. We talk about a shift. I cannot stress the importance of risk as well. As a portfolio manager, that's very important. We look at the risk. We want to make sure all the portfolio are essentially the risk can be mitigated. So Sam, your background is in global markets, is that right? Yeah. So, and can you maybe tell us a little bit about your background? Actually, maybe just give a minute. I just realized I didn't introduce your firm. Maybe can we each give a sentence or two what your firm does? Yeah.
Yes, sure. I'm Sam Phillips. I'm the CEO of Reach Alternative Investments. We are a private markets or private equity company. Our mandate is that we partner with the world's leading asset managers and bring access to their private market funds. Those funds normally need $5 or $10 million US minimum investment. We bring the access right down to about $50,000 and handle all of the administration. So you can log into our system and get repeatable deal flow at reduced minimums from the world's largest asset managers.
Yeah, we're a financial planning services business, sort of whole of wealth, but really with a bias towards residential property to add to the portfolio. We've got offices in Sydney and Melbourne, around 100 staff, around 10,000 odd clients. So that's sort of what we do. We're very passive. Risk management is around cash flow management for us and not getting into too much debt. And because we don't buy new or off the plan, we just buy existing. That seems to also protect us a little bit because we're retesting the market in that secondary market.
I've just presented, so you should all know what I do. I'll pass. I work for Arcana Capital, so we're a boutique property fund manager. It's all exclusively commercial property across varying asset classes, and it's essentially yield focused. So we're very focused on monthly distributions paid to investors and looking for value in that regard.
Thank you. Moving back to risk, right? Sam, when we discuss prior to the meeting, you mentioned you don't like liquidity. And can you share with the audience what's your view on liquidity?
Yeah, sure, Vanessa. Look, from a risk perspective in private equity, we're firm believers that liquidity actually brings risks into a portfolio. There's a reason that private equity has tended to be closed-ended funds. And the reason for that really is that when you enter into a private equity fund, that fund manager typically takes 4 years to deploy the capital to purchase the portfolio companies. They then need another 3 or 4 years to generate the value creation, to increase the value of these, and then another couple of years to effectively exit the transaction. So very different than a listed company, say Commonwealth Bank. If Commonwealth Bank, being listed on the stock market, wanted to do a huge change of focus in the business, which meant that they may not be profitable for 4 years, good luck, because you won't have any shareholders left. Everyone will dump the stock and they're in real trouble. So there's huge benefits of being unlisted and illiquid in that the managers have the time to do things properly, to create that value, and then to exit the strategy and return the money to investors. So it's one thing that we're very passionate about, is trying to keep private equity in as close to institutional format as possible. If liquidity is needed as you come down from institutional investors, unfortunately death and divorce happen. We do have some mechanisms to allow people to exit, but there's a lot of education about why these are illiquid products and why it is much better for you to keep them illiquid. And it also removes volatility. And a lot of people say, well, why does it matter? Long-term investment. It really matters because volatility creates two things, fear and greed. And both fear and greed result in bad decisions. You know, when we're greedy, we buy at the top of the market. And when we're fearful, we make a bad decision and exit. So from a risk perspective, we really do push, go into closed-end funds, try to keep them illiquid, make sure that you balance your portfolio so you've still got liquidity where you need it. But more and more we're seeing people are adding illiquid alternatives to their portfolio.
Thanks. I guess the same in terms of equality for commercial or residential space as well?
In terms of allocation, what we've certainly seen is a little bit, and this is speaking to fund managers, I suppose, an allocation into the commercial real estate debt market. As I was sort of talking in my slide, the lack of volatility in this space is something that it certainly comes back to the investment manager making proper loans to end borrowers where you don't get defaults and impairments. That's certainly key to it. And I know we have a 23-man credit team inside, so it's a big operation to get it right. And certainly you've seen the markets, but definitely fund managers started to look at this and commercial real estate debt as an alternate with these stable returns that we've been able to provide, sort of with a hedge with inflation, going up with BBSW rates. He's certainly getting more airplay where we're speaking to wealth advisors and managers who are taking on more of that into their portfolio. We're still a small allocation, we're way down here in the 10% mark, but it's growing and it's a nice alternate to the volatility that you're seeing in traditional asset classes.
Ben, anything you would like to add?
Yeah, so from a resi face, it's our risk is actually macro-prudential. So we've got regulators who are throttling borrowing power, and we also have risk of government intervention in regards to rental freezes or rental caps, which is currently doing the rounds at the moment. So on the whole, when you think about resi property, it's a pretty predictable asset. Someone has to live somewhere. And then you've got growing population coming in and you've got a severe undersupply of property. So when you think medium to longer term, land value resi is actually not a bad bet. I'm not saying, overload on resi. 1 or 2 simple properties as a passive income for a rent roll later in life is what we focus in on. We're not interested in people building mega portfolios of property. We're just interested in adding to a sensible execution on that. But yeah, they're probably our biggest ones in terms of risk mitigation, is the intervention and the sentiment around property investors at the moment as not being small businesses, but are being greedy landlords.
Thanks. I would like to dive into a success story, right? So we all like to celebrate success. So Kobe, it's my understanding your background is house science, is it right? Yeah. How did you get into commercial real estate? And can you probably share a success story with us?
Entirely by accident, really. I suppose I've worn a few hats in a short period of time, purely out of interest, and I suppose the health science career prior to this was very beneficial in terms of, I suppose, moulding way to look at everything holistically, and particularly when dealing with investors. That's my primary role, is investor relations and capital raising, and understanding that like in health, an intervention isn't an intervention because they'll just follow it. It's got to match into people's lives. There's got to be sort of a reason behind everything that you do. And likewise, I think we can get stuck in the nuts and bolts, the numbers, which obviously that's what finance is. But investors invest for a reason. It's very important to be trusted with everyone's, with money, essentially, because what that money represents is extremely hard work for a number of people. It represents their own freedom, financial freedom to do whatever, the security for their families and possibly legacy in the long run, depending on what their strategy is. So that's probably been the biggest crossover, is just on the individual level. Now, how that's tied into a success story, I suppose it's hard to say, because you do get the odd win with some of the acquisitions that we've had, where it can be a bit of a grind to raise money. I think a lot of us are aware that it's difficult to raise money this year in particular, just with the changing environments and the changing sentiment. And it's often, as a fund manager, it's often you versus the media to some degree. So it can help understanding people on intimate levels to get some capital across the line. But then the flip side of that is sometimes the numbers don't lie and they're hard to argue with. So an example of that, I suppose, back end of last year, we did an acquisition of a cold storage and logistics facility in far north Queensland, and it was one of those where thankfully we're a small team and we're agile enough to dust things off and look at them on their merits. So at first glance it was nothing special, but as we looked to engineer the deal we realised we had a gem there, and got it on a sale and lease back to one of Australia's largest banana producers who wanted it off the balance sheet so that they could buy more growing land. And I suppose upon uncovering that story and being able to deliver that story to investors, but also have good numbers attached to it, 5-year whale, 10% returns for equity in a property, that one went off like an absolute rocket. It's a bit of a brag, but really it's down to the numbers. We raised the money that we needed in 14 hours, which was excellent compared to some other raises.
That's great. Although I would love to continue to talk about property, but this is not a property panel, so I have to come back to my private equity guys. Some other success story you can share on your field?
Yeah, sure. Look, I've been overseas for 20 years and I came back to Australia to set this company up in 2021 for the purpose of benefiting from the relationships I'd built with the largest asset managers and to try to give access to the most proven funds that we couldn't get because we weren't large institutions writing $10 million checks. And I made the mistake of thinking that I was bringing access, and that was my value add. You can now access these funds. I think the success we've seen is twofold. We hope to get 3 or 4 of these top 20 asset managers to support us, and we now have 8 of the top 20. So I think that was a success that they've really bought in and been very supportive. But on the other side, I think the real surprise was we've got some investors who are, the largest family offices in the world who manage 10 or more billion dollars who actually like our platform. Now, they can definitely go direct to these funds, but the value add that they're seeing is they just don't have capacity to go and look for all of these funds themselves. If they're looking for an infrastructure fund, it may be a 2 or 3 month process of going and finding them. You've got to get into the data rooms, do all due diligence, arrange meetings with the portfolio managers, go through the documentation process, which can be 2 to 3 weeks just to sign on and on board for each investment they want. And they're very excited about, they've now got a one-stop shop where they can come in, sign on once with us and get exposure to, 8 to 10 of the world's leading managers with repeatable flow. And a lot of these guys aren't even in Australia, and Australia's our market. So we're getting inbound inquiries and engagement from people in the Gulf states and Singapore and Asia. So that's the success that was unexpected. It's great, but they're now wanting to invest in these funds as well, and we get limited allocations. So we have to make sure that there's enough to go around for Australia and New Zealand, because that was our original intention.
Thanks, Sam. Now, we still have some time left. I want to talk about the future, right? So given the current economy climate, what's your outlook for the future of alternative investment? Maybe let's start from the other side. Kobe, start with you.
Yeah, sure. Obviously interesting time, and it's all anyone has been able to talk about since April last year when they started raising rates. So it's been interesting to follow, and we've seen across the last 12 months that a lot of people have been looking to keep their powder dry, and either on the one hand waiting for the blood in the water to come in the market, all these great opportunities, and then as Ben alluded to with the resi market, say these 20-30% price drops in resi housing never happened. And likewise, I suppose we've seen that across a number of asset classes. So as we go into the future, given that we've got higher interest rates and what was essentially free debt before, let's be honest, 0.1% cash rate, which isn't likely to happen again anytime soon. I think people are being reintroduced to cost of debt and being reintroduced to certain aspects of their cash flow that haven't been as obvious in recent years. So we're starting to see a shift towards things like the private debt market with those high yield sort of regular payments rather than going for the long-term capital hold. And likewise, given that we're a yield-focused fund at Arcana, we are seeing a lot more interest because of monthly distributions and stuff like that. Because everyone has overheads. Everyone's got to either service debt or pay fees or just do whatever. So there does seem to be a bit more of a shift into more of the high-yielding environment.
Thanks. When I look to the future here, there was a slide that I had about the commercial real estate debt market in Australia, a $375 billion market that's growing to $475 billion. That's APRA sort of numbers. When we currently in Australia, that's funded by 85% being the banks and 15% to non-banks. When I look to the overseas markets, the Americas is about 50-50, or probably more so in private debt funding those types of developments, and Europe is around the 50% mark. So Australia's got a long way to go to catch up to that, and that will happen, and it will happen from a weight of offshore money coming in to be in the commercial debt market here in Australia. We're seeing offshore fund managers come through the local managers that are onshore with teams onshore, such as ourselves and other non-banks, and that creates the opportunity more for high net worth family office money to come in and also support those loans. So the market will grow in that way. The future is going to look strong in that, and it will happen through the ups and downs of the property cycle as well. So it's an exciting sort of next 5 years for commercial real estate debt. Yeah.
In terms of resi, it's a $9.1, $9.2 trillion market. Loan to value ratio is sitting at around 23% globally across the resi market in Australia. We'll have a supply issue, I suspect, for the next 2 or 3 years. We just will not be able to meet that demand for housing, both residential for owner-occupied purpose, but also for rental. So I think from a yield point of view, yields will continue to keep lifting back to what I would say the regression to the mean, which is around that typical for every 100,000 you're sort of getting about 1% yield. That would normally happen in terms of what we're doing. If you start to then add granny flats and all those other things, you can start to move that yield story even higher. But it's a pretty boring passive investment. That's the way we like to see it. You should think of resi property in decades, not years, and basically just let it do its thing and lift your head up in 15 years' time and realise you've moved the curve on the loan to value ratio. It's now a passive investment. Sit on it for the next 20, 25 years and enjoy the spoils.
Yeah, and for me, I think the future is that the realisation is that the 60-40 portfolio doesn't make a lot of sense anymore. It's not 60 in shares and 40 in bonds and that's it, and you're set for life. The world's changed. I remember 2005, 2008 in Hong Kong, I'd walk down the street and there would be a queue going twice around the block wherever there was a bank, because people were queuing up to get a prospectus because there was a new IPO coming, because you were going to double your money. I mean, that was just the life back in 2005. I don't remember the last IPO that actually went up anymore. Private equity is now, they're funding these companies until they're very, very mature. They're not actually listing on the market. Companies listed on the ASX are actually shrinking now. So if you've got all of your money in the stock market, you've got a shrinking pool of investment opportunities coming, and it's only going to get worse. There's 144,000 companies in the world which are not listed that generate over $100 million worth of revenue a year. That is huge compared to what's listed on the stock markets, and you're missing out. So I think the future is that all of us are going to be investing more in unlisted assets, whether it's property funds or private equity or venture capital infrastructure. And we just have to accept that that's the way that the world's going to move. IPOs don't make us rich anymore, and you have to be diversified.
Thanks. We only have a couple of minutes left. If I were to ask a final piece of advice you can give to our audience, would that be? Maybe we'll start with Sam.
Look, if you're moving into private equity or unlisted assets, my only advice or insight, I should say, but not advisory, should be just look for proven people and proven teams. In our space, we look for asset managers who've been around through multiple market cycles. If you find a venture capital fund that's done well from 2017 to 2020, doesn't mean they're going to do well in a high interest rate environment. So look for cohesive management teams who've got a track record of success over multiple market cycles, and that's a really nice way to help de-risk your portfolio.
From an individual investor's perspective, I'm pretty simple, right? I talk about knowledge is empowering, but only if you act on it. So most of the big reasons why most people don't have financial well-being is because they procrastinate or they don't act. So just get educated and then act. You'll be far better off by making a decision than not making a decision.
In 2016, I remember having a press cutout with the non-bank lending sector being described as cowboy shadow banking, and be careful, it's all going to blow up. It hasn't. We're here. We've got great controls in there to limit losses and great credit teams making these loans. So that sector has definitely come to its fore and will do in the next few years. So again, it's great to pick those leading investment managers in the non-bank lending space and invest, and they've all got a good track record. So go for it.
And I suppose similar to that, but from a commercial property acquisition standpoint, there's a lot of conjecture in the media at the moment around the future of a number of things. If we stick to reading newspaper articles, then as far as I'm concerned, there'll be no more CBD office ever again, ever, and just run for your lives. When ultimately it's, there are cycles, there are reasons that things happen, and I suppose it's important to lift your gaze to where things might end up off the back of what's going on right now. For example, there's opportunities in a lot of places because people are hesitant to go there. But if the foundations are right, if the numbers make sense, if the story makes sense, probably most importantly, then don't be afraid to give it a better look.
Thank you. To summarize, if I may, borrowing is good when you come into investment. Yield is lifting and market is growing. So thank you, everyone. And please, let's give a round of applause for our panelists today. Thanks.
Thanks, Vanessa.
Thanks.
All right. Thank you so much, panelists. Again, if you have any questions, please do ask them in your own time during the networking session outside. Next up, we have Jeroen van Son, CEO and Managing Director of Verency.
Thank you. Click and move on to the next slide. Is that how it works? Yeah, good. Awesome. All right. Well, firstly, thank you very much for having me here today. I'm Jeroen van Son. I'm the CEO and MD of Verency. I was given 8 minutes today. 8 minutes to convince you to invest in a business and a product that can change the world. So I thought that's a cool challenge. So here she goes. A little bit of context. The problem that at Verency we're looking to help solve is that pesky problem of greenhouse gas emissions and global warming. Doesn't seem to go away. Before I get into that, I'm going to tell you why. Why it matters that at Verency we combine two sectors, fintech and climate tech. Why should you care as investors? Talk to you a little bit about how we've built a product that we think can address that problem, how we sell it, how do we distribute it to the market, also how we monetize it. Lastly, I'll tell you a little bit about who we are, where we come from, and then I'll talk to you about what's next in our journey. Let me start with a little intro. So Verency operates at the intersection of fintech and climate tech. That is deliberate. We believe that in that intersection, you find the opportunity to build technology products that do good for the societies we operate in, but they can also scale. Lastly, the product distributed through financial services give a frictionless experience for the end consumer. Because let's be fair, no one is looking for yet another app in your iPhone or your Android phone, right? You want to consume services through apps fully embedded in a way that you're already using them, frictionless and easy. So, global warming. Depending on what statistic you believe, anywhere between 60 to 70% of greenhouse gas emissions originate from consumer spending. Now, market by market, it changes a little bit, but in this market, north of 60% of that spend is done on a card. A credit card, a debit card, a mobile wallet. That statistic in and of itself gives us as consumers an enormous opportunity to help address global warming. Some would go as far as to say we have a responsibility to do that. So we've built a product. And our product, in a nutshell, calculates the carbon emissions of a consumer's spending pattern. So everything you buy on a debit card, a credit card, a wallet, we calculate the carbon emission from that purchase, and we present that back to you. Initially measured in grams or kilograms of carbon, but then quickly, in a more relatable term, could be this has caused 3 trees, or this was 3 weeks driving in your car, or something that relates to you. And then lastly, we give you the opportunity to offset any remaining carbon emissions by purchasing carbon offset credits from the voluntary carbon markets. We have embedded that product fully into what we call the payments flow. Now, what does that mean? It means that as a consumer, you can continue to buy goods and services as you do today. Tap your card, swipe it, dip it, pay with your phone. It doesn't matter. You do exactly what you do today, but now in the knowledge that you can live a carbon neutral life. We believe that scales. Why does it scale? Because we distribute the product through banks. We distribute the product through merchants. That's where you get your scale. That also helps us drive down our cost per acquisition. By embedding this by embedding this product inside of a native mobile banking app, it's fully frictionless. Again, as a consumer, you do nothing else than what you do today. You buy for goods and services, but now carbon neutral. So minimum friction. Lastly, and importantly, we have entered into a very powerful distribution deal with Visa, the largest payments brand in the world. They have embedded our technology inside of what they call the Visa Eco Bundle, which is a product that's badged and branded by Visa. Visa sells it to banks in Asia Pacific and the Middle East and Africa, and we are at the core of that product. So what does that mean? Visa goes out day to day, every day, meets with their banks. We leverage the Visa sales force to sell our product. They bring back an inbound pipeline of banking customers that we then subsequently convert into customers of ours. So why would you care? Well, firstly, the problem is pretty big. There's every chance that all of us here in this room are going to experience the effects of global warming this coming summer. The forecasts look a little bit grim. So, that's the obvious one, right? But we're talking to investors here. So why would you care from an investment point of view? Well, firstly, the market's huge. So we've done some analysis and we believe that the market is $4 billion. Well, don't take our word for it. Morgan Stanley sees this market grow to $250 billion by 2050. That's a compound annual growth of 17.5% of today's numbers. So the market is big and it's growing. Secondly, we're Verency. We're a small Australian startup company. We operate around the world. but it's unlikely that we're going to capture 100% of that market. So if we capture 2% of that market, that is an $80 million ARR. Got to be honest, right? $80 million ARR. Today we do about 1.1. So the investment opportunity is up to 80% growth. So market's big. That number, by the way, excludes business to consumer, which is also an opportunity that we'll be looking to target. So market's big. Now let's flip the coin and look at demand. So why would you care? Well, I think investors should care because consumers care, banks care, Visa cares, we care. I'm not sure if that's a major influence, but we do. So we've commissioned some joint research with Visa. And that research suggests that a very large number, 70% of customers, want to know the impact of the carbon impact of their behavior, right? 70%. 50% of customers say that they are willing to change the relationship with their financial institution if that institution gives them the tools to not only see their pollution footprint, but do something about it. So the numbers are starting to stack up. Proof is in the pudding, right? So banks care. The best example I can give you of that is that in the last we started doing this with Visa about 9 months ago. We now have signed 3 banks. It says 2 banks on the slide, but we've signed another one just 2 days ago, which is pretty chuffed about. Large banks in Asia Pacific, millions and millions of customers. They're rolling this out. The first live to market will be on the 16th of August, which is the week after next. So banks are voting with their feet. There's not a bank in the world nowadays that doesn't have an ESG or a sustainability strategy. There's not a bank in the world that is looking for very concrete ways to demonstrate that strategy, not only to their corporate customers, but also to their retail customers. And that's where we come in. So customers care, but they don't have the tools to act. If you really wanted to today, what would you do? Well, if you really wanted to, you can go to Google and you can download a carbon calculator app somewhere. That'll probably give you a bit of an idea roughly about your pollution footprint. And you probably need to go to a different website to buy carbon offset credits, and then you feel good about yourself. Well, who's going to do that? Right? The friction in that experience is outlandish. Just no one does it. Again, our product fully embeds all of that into the payments flow in a completely frictionless manner. So how do we do that? This is a busy slide. I'll try to speed through it, but in its essence, what we do is we calculate the carbon emissions estimates of a consumer's transaction behavior. Every single transaction is scored. We then play that back to you as a consumer, again measured in kilograms or grams, but then in more relatable terms. And we then give you some nudges, some suggestions, right? If you didn't get into your car 5 days a week, but you took public transport, your emissions footprint would reduce by this. We give you we benchmark you against the peer group, and if you're performing really well, you can say, hey, you're in the top 10% of best performing customers, or here are some opportunities for you to reduce your footprint. Then we give you, and this is a one-off thing as a consumer, we give you the opportunity to set some parameters, to buy carbon offset credits. You can set a monthly cap to your contributions. You can say, I want to offset one transaction. You can say, I want to offset all my transactions, or something in the middle. You can then choose what project you want to contribute to, because there's carbon offset projects at the end of the value chain. Now, that could be a tree planting project in Tasmania, or a solar project in Queensland, or it could be a wind project in WA, or it could be a project in Greenland. So we've gotten access through partnerships to 7,000 global carbon offset projects. Lastly, most importantly, set and forget. Go away, spend, buy what you want to buy, purchase what you want to purchase, do it the way you want to do it, but now in the knowledge that you live a carbon neutral life. How do we monetize this? So monetization is done in two ways. We think about our product in two ways. One is insight, scoring of transactions and presenting it back to you as consumers. And the second is action. That's where you buy your carbon offset credit. The insight component is sold to banks, and banks pay us a fee per transaction. Really simple. It's a fraction of a cent. It's a volume game. Then the action component is where the consumer or the merchant buys the carbon offset credit, and we take a cut of that transaction. So fairly straightforward monetization model, but it does give us access to multiple sources of revenue. Now, questions I get a lot are questions around, a little bit cynical questions around, well, do you think that consumers are going to actually buy carbon offset credits? Are they actually going to dip into their own pockets and purchase these things? I've got some data points here. One interesting one that I found was that if you look at Qantas, right, and Qantas, if you sort of look at their product suite, so to speak, and divvy that up in corporate travel and leisure travel. Let's ignore corporate travel. It's so easy to tick the box to offset it if your employer pays for it, right? So ignore that. Focusing on leisure, consumer travel. 10%, creeping up to 10% of consumers actually tick that box, right? So a number that's quite a bit higher than I thought it would be. I spent a fair amount of time at the competing airline, and I know that number is pretty close to 10% as well. So there is a segment of customers that will pay for it. Our calculator suggests that the cost of buying carbon offset credits is anywhere between 80 and 140 basis points, right? So it's up to 1.5% of the purchase value of your transaction. That's not going to break the bank. For the average Australian consumer, that's roughly $15 to $17 a month, right? It's not going to break your bank. And it's certainly a segment of customers that would be willing to do that. If you're not willing to do it, you can set a cap and say, you know, if you tell me, Mr. Bank, that it's going to cost me 15, I'm probably going to set a cap at $12.50. Perfectly fine. Technology enables that. So that's how we monetize this. So let's move forward. A little bit about us and who we are. Yeah, I gotta move on, right? Yeah, I got 8 minutes, but I'm taking 12. There you go. So who are we? We're Verency. We have a small team. We're about 11 people on the payroll and another small team of offshore developers in Vietnam. Our team has on average 20 years experience in financial services. Myself, I used to run consumer finance at Westpac. I ran Hong Kong and Macau for MasterCard and financial innovation for PayPal in Asia Pacific. It's that sort of experience that we have in our executive leadership team. We've got a very impressive board. Our chairman of the board is Stephen Benton, the ex-CEO of FPOS. Also happens to be my first boss when I came to Australia 20 years ago. Sean Gaydon, 30 years in payments, last 15 years or so at China UnionPay, and prior to that at MasterCard. Tanay Matanda, investment director of Salter Brothers, our cornerstone investor, and then myself. So we are maybe a little bit more experienced than the average fintech startup. And we're here to make a difference in the world. So a little bit about what's next. All right, so number one, we're fielding an inbound pipeline of customers. We're bringing banks live. First bank is going live in a week and a half. So we're commercializing and scaling the current contracts. Then we're going to scale the partnership with Visa in the Middle East and Africa. That contract is signed, and that's 83 markets in that part of the world that we're looking to light up. Then we're in the middle of, well, not in the middle, we've kicked off our equity capital round just recently. We're looking to raise 3 to 5 million Aussie. We're hoping to close that round in October. So if you're interested, please reach out. Love to talk to you. Then in the next quarter, we're going live B2C with our own brand direct to consumers. And then lastly, we're going to target the merchant market. And the best analogy I can give you is that, in my humble opinion, there's no reason why Woolworths would not offer the ability to make the purchase carbon neutral at the checkout. So that's our dream. That's what we're aiming for. May not be Woolworths, may be someone else, but the merchant market is huge. I've got a detailed investment memorandum in the CRISP deal room if you want to learn more. Thank you very much. Appreciate it.
Testing, there we go. Okay, so this session I'm going to be doing a fireside chat with Matt Allen. Matt is the co-founder of Tractor Ventures and also of Side Stage Ventures, and I'll let him give a bit of an introductory on that. Super excited to be doing this. And first thing I just want to say a big thank you to Matt. He's obviously flown up from Melbourne for this, and also in sort of observing you for the last sort of 10 years, you know, there's funny things you come across, you know, we've obviously been doing this for 14, 15 years, and you come across a bunch of different people sort of in this area. But the very rare type of person you come across is the people that actually do all the work at the ground layer to actually help build the next generation of entrepreneurs coming through, and also proactively building ecosystems around what they do as well. And I know that for you, you've been involved in so many different layers, whether it be startup ecosystems, different organizations. Like, I'm sure you've been to countless events like this, actually doing everything just to try and help people build. And the record of companies that he's been associated with as an investor or as an advisor is just absolutely astonishing. So welcome, Matt, to the Fireside Chat.
Thanks for having me.
You brought your own fan club as well. It's fantastic.
Is it on? Does it work? Yeah, right, cool. Now we have, hello everyone.
So Matt, as a starting point, you know, please just obviously I've given you a bit of an introduction, but, you know, I'd love you to give an introduction for yourself about your own sort of journey in this space, firstly as an angel investor, and then obviously, you know, starting Tractor Ventures, and I suppose the motivation as to why you started Tractor Ventures.
Sure. It all starts back in the mid-90s because I'm old. So the first half of my career as a software developer. So I'm kind of a weird mix of spent the first half writing a bunch of code and building a bunch of software for the internet mostly. Was always sort of on this mission to become a business person. So when I sort of hung up the coding keyboard and decided that I didn't want to write code anymore, I actually built a recruiting company and sort of build out the software engineering teams for the big scale-ups in Melbourne, like realestate.com.au and Redbubble and Jetstar and so forth, which is kind of convenient because it also was the beginning of my angel investing career, and recruiting is very lucrative, especially when you're hiring software developers and your mates are all the CTOs of this company. It was kind of a perfect storm back in the mid-2010s. Interestingly enough, you know, my investing career started because the last thing that I coded was a company called Practice Ignition, which is a scale-up Series C company, you know, worth several $100 million now. And it was sitting on top of Xero. It was all sitting on top of Xero, the accounting platform back in 2012. And I made a very dumb, good in hindsight, dumb at the time bet, and basically set up an SMSF and dumped my wife and I's entire SMS on Xero on the ASX on day one, and just went and like slid over, I don't know how many tens of thousands of dollars that was. And it went pretty well, which gave me the capital to then start investing in early stage tech companies. And, you know, conveniently, you know, a lot of the first investments I made were from Practice Ignition, the one I built, and my mates who were software developers who were doing startups who just went, we don't know how to raise money, can you help? So that was convenient. After recruiting, I went to AWS. So there was a time, a couple, 2.5 years, sort of finish up in 2019, where I ran the venture capital and startup team at AWS. So that was interesting. I was in a BD role, didn't have anything to sell, but I did have $100,000 in AWS credits to give to whichever founders that I decided to talk to. So there's a little bit of like drug dealer, first one is free stuff with the cloud. It worked well for Amazon.
Good way to make friends.
Worked well for me. And also because I was looking after the VC portfolios, I was able to speak to all the VCs. But it was really at that time when the thought process behind Tractor started. You know, in technology, the VCs like to speak to all the founders, but they invest in so few companies because venture capital requires a ridiculously large return. And, those venture funds are happy to have 8 out of 10 of their portfolio go to zero, while hopefully 2 out of 10 sort of return the majority of that fund. And it was my time at Amazon when I used to get these spreadsheets full of this sort of billing data that sort of showed these companies growing and going up and to the right. And you'd click on them and you'd like, who the hell are these people? I've never heard of them before. It's not Canva, it's not Atlassian, it's some random thing. A couple of dudes in a shed in Ringwood, doing $4 million a year in revenue. And they're not venture backed. They didn't want to be venture backed, but they're always happy to have entertain the idea of taking more capital on to grow their business. And there's just really no way to do that. So there's kind of the thought process behind Tractor, which is a bit of a funny / silly name, is I wrote a thesis that said, in VC land, everyone talks about unicorns. You all sort of heard about these unicorns. It makes us sound like a bunch of fucking children. So how about we write a thing called, and I'm like, maybe it's tractors versus rockets. So the rockets are, they're exciting, they're expensive, they're hard to land, and they blow up pretty often. That sounds like the venture capital financial vehicle. And tractors are consistent, reliable, and they just keep going. So we started Tractor Ventures to sort of fund this asset class that was kind of invisible, where they're not risky enough for VC and they're too risky for banks, but they're still sort of scaling product companies being led by founders who are growing, who want to grow, who just sort of aren't risky enough for venture. And the banks, they're non-tangible asset companies. There's nothing to touch. The balance sheet's got some IP and some laptops, and that's about it. So that's what we do. So Tractor is a cash flow, a revenue-based finance company for people that have scaling tech companies that have identified that they can put more capital in and grow their business.
So there's really two sides to it, right? One, you've got to sell you've got to communicate and articulate the proposition to the founders, and on the other side, you've got to articulate the proposition to the investors. How'd you go articulate to founders in the early days, like when you were starting, just for the fact that this whole ecosystem I found sort of frustrating is geared towards how to pitch a VC and how to create a pitch deck. How did you find that when you're actually looking for tangible, when you've got a different approach in how you do it? Yeah, it's interesting. A lot of tech founders sort of get swept up in we've raised money from insert large venture fund here. Their AFR never writes an article about some people taking finance. It just doesn't happen. So, if you want to get written up by the AFR, you've got to get Blackbird or Airtree or Square Peg to drop a couple of bucks into you and off you go. So it was really interesting, and especially we started in December 2020. So I wrote 2 loans myself leading up to then, and we officially launched in December 2020. And if you all remember 2021, money was free, and the VC funds, especially the big ones from the US, were doling it out like lollies, which meant that when you said to a founder, hey, maybe you shouldn't sell those shares and retain them for yourself and use some of my money because you've got millions of dollars in revenue. We can use that to help you grow faster and you don't have to sell as many shares. They were like, nope, I'm just going to take this equity over here because the valuations are toppy, things are happening fast, and off we go. And founders, interestingly enough, usually really great at product and they sort of wrap a great solution around it and they sort of business around that. And finally, they think about how to finance it. And it's up until recently, they've had to sell shares. It's either customer revenue, friends and family or other people's money. So in 2021, we just sort of went about saying, maybe you shouldn't do that. The hardest thing to get a founder to know the hardest thing to get a founder to do is say no when someone wants to buy shares off them. Like they're just happy to sort of do that. So there is definitely some education at a high val. So fast forward to 2022 and all of a sudden, we say that in 2021, the founders were curious, and in 2022, they became serious about using alternate finance to grow their businesses because the equity markets dried up. So equity and interest rates are inversely correlated. Interest rate goes up, prices go down, founders stop selling shares, people stop buying shares, and all of a sudden they're like, maybe I could use other forms of capital to grow my business. So the tailwinds really whipped sort of at the end of 2021, beginning of 2022 for us, and it's been quite a significant growth for us since then. You made the offhand comment about getting the big round, obviously being featured in the media and so forth. And I think as a founder, sometimes when you're building, you get envious when you see those big rounds. You see a company's just raised 60 million, 30 million, 100 million, so forth. And that's in 2021. And then you see in 2022, and I'll never forget this moment. I remember speaking with one of our clients and they'd been VC funded, they'd just gone through a sales process, and I was ringing her up to congratulate her because it was actually covered in the media. And, basically at that point she goes, and then she was mentioning she was going on a holiday, and I asked her, are you taking a 3 to 6 month break to celebrate, She goes, well, we actually didn't make any money out of it. Because effectively the preference shares. And that moment, it's funny, you hear that word, but when you actually hear someone who's a founder who's put their absolute soul on the line in building a business and actually sold it, which is our dream for every founder, and walked away with nothing, you're like, okay, that wasn't what I was expecting. And you think, so I said, you hear those stories in sort of 2021, and then you hear 2022, and then you hear about some of the situations founders find themselves in from taking those top evaluations with preference shares, with lots of money attached and massive burn rates attached and told to grow. It really does put a different perspective on, what should growth capital look like going forward?
Yeah, I mean, we talk to founders all the time about, like, as soon as you take other people's money, just be really clear about, the devil you're making a deal with, right? I also have requirements for my capital, but they're quite clear. It's like, pay me back over 2 years with a bit of interest, and that's very different to saying, I want 10 to 100 times my money back. And the problem you've got with that particular type of capital is, if you were on a rocket ship and then all of a sudden the market changed and this happened, I saw this happen so many times that the VCs went, well, you're not in the top 5% of my portfolio. They sort by kind of awesome descending, whichever their definition of awesome is, and chop off the bottom 80, 85%. I got founders calling me going, like, last board meeting, they said hire more people. This board meeting, they're like, make your runway go for 5 years. And it's like, how do I do that quickly? And, it's not, the challenge that I've got is that my friends are all VCs and they're lovely people. It's just that their business model is a shit show. It forces it to do that. And, let's be clear, I have a business model as well, but it's very clear about what we need. And it's far less pressure most of the time to do those kind of things with your business.
So now, as I said, that people are getting serious about it. Like, one of the things me and you in our sort of pre-chat before this, we talked about, obviously the fascination I love about software because of the infinite scalability. Obviously, then you could bring in generative AI. I suppose the question, when you're thinking about the companies of the future, and obviously you focus on your business models, you focus on side stage ventures as well, which we can talk about. But how do you see the business models of the future? Is there the need for those massive, outside the tech, we've obviously got a lot of renewable energy tech business. Technical businesses require lots of capital, right? But for the software businesses, do they require those large funding rounds going forward?
I mean, it is the topic of concern. I mean, when I did my first startup in 1999, the 3 machines cost me 25 grand a pop each to buy and 5 grand a month to run each. The capital requirements were quite significant even to get to the game. Now you speak to your friendly AWS guy, get 100 grand worth of credits and you're off to the races. And I do think that the ability to get software to a point where you can solve a customer problem is much shorter. And in the days of free capital, you could overspend and hire a big team. But yeah, it's interesting, especially in Australia, and I'm certainly tracked it perpetuates this problem rather than solves the problem, which is you should be able to get to customer value and potentially revenue relatively quickly with relatively low costs, even if you're not a coder, because of some of the tooling that's around there. And you're not going to solve the entire problem, and it's not the eventual thing that's going to make you, hyper rich, but you should be able to validate that it's real without spending a whole bunch of money. And, Australian VCs traditionally are very bad at investing in ideas. They don't sort of go that early very often. Some do, like we do every now and then, but there's other factors involved then. So, yes, I reckon that the software stack of the future will be very different. The generative stuff is kind of mind-blowing. It can do all kinds of stuff that, required deep skill sets like coding prior to, last year. It's only brand new. So it's a bit unknown. And yeah, there was a couple of articles, I think, was it Forbes or someone did, the startup of 3 people. It's like the just be able to prompt the AI to write the code, to be able to build the stuff. It's not a long way away. Like, I don't think it's impossible.
And then you start to think about, well, some of these companies that you're funding right now, and this is, I suppose, the thought process going through my head. You think about, obviously, the technology aspect. Then you think about, obviously there's the social media platforms. If you're a B2C business and you want to get reach at scale, if you're a B2B business, you can literally just buy the data and do the scaled outreach of whoever you want to target. So, should we be, from an investor's perspective, thinking that the software companies coming down the pipeline should be we should be looking at some of the most profitable companies over the next sort of 5 to 10 years because of, I suppose, those head starts?
I mean, I've got a strong view that, as you said, the margin on software ends up being, infinite because you can resell it over and over again. But I think, again, some of the biggest thing, the biggest problem with the overcapitalization of businesses is that they forget that you should run an actual business. That the high margin, high growth software businesses doesn't need a whole bunch of people, shouldn't need a whole bunch of people. There's plenty of businesses out there that are doing the physical stuff that, that do need a bunch of people and do need a bunch of warehouses and need a bunch of things to be able to actually get them going. But the ones with sort of infinite margin software should be able to do that without a cast of thousands.
Now, obviously, you've got two businesses that you're co-founder of based on your investment thesis, what you're passionate about. What is Matt Allen personally excited about for the next sort of 3 to 5 years?
Personally excited, I don't know.
Or angry about, one of the two?
I don't get super angry. I'm pretty chilled. Can I talk about what I'm worried about?
Go for it.
I don't know. It feels like there's some significant changes in the world that are pretty existential threaty to us. Not that I worry too deeply about them, but the way that some of the odd shit that's happening in the climate, that's sort of first times. It feels like the mean time between first time things happening is getting shorter and shorter and shorter, and the compounding effects, and we just don't know what's going to happen, which kind of just makes me want to go really, really fast to whatever success looks like and enjoy the rest of it before it all bursts into flames. Sorry.
Should we be prepping and buying a farm in Tasmania?
I'm not going to lie. When COVID came along, I did do a very large Amazon order of tuna and water. But I'm like, to be clear, I ate the tuna.
He secretly owns land in regional Victoria in a bunker.
I did live on a farm once. No, it's just I do think that there's I would like to see some urgency in some of the stuff around climate. I think that some of our favorite billionaires, tech billionaires, are throwing basically all the money they've got at it. And, the people who think about innovation and think about the future and think about the ways that software, hardware and products can solve for some of these things are basically investing every dollar they've got. And I think it's a strong leading indicator that we should all be thinking about it all the time.
This could be a bit leading, right? But you mentioned that. It's funny enough. You're a software guy talking about, obviously, you would have walked around today and see how many renewable energy tech companies or hydrogen based. What's fascinating for me is you don't really see it covered that much in startup media, in business media, in AFR, and so forth. A lot of the great work that's being done by some of these companies.
Yeah, and a lot of the time it's because their capital requirements come from places that are not your headline venture funds. They're coming from different places. People like
family offices and high net worth.
A lot of them get to the point where they can find asset finance or supply chain finance their growth, and it's just not the thing that Swanee talks about, right? It's boring as shit, but it works if you get it right. Yeah.
And is there any questions anyone wants to ask Matt, just while we've got no time left? Maybe two questions from the audience. Anyone want to go?
No. Oh, there's one. Have I invested in climate tech myself? Yes, I invest in GoTerra, which is they takes all the food waste from Woolies and a bunch of places here in which I think is really important. I think some of the funds I'm in have done it, but not directly. I haven't done many direct investments because I'm focused on Tractor at the moment. Tractor has actually got a whole bunch of things that are climate related in them when they're able to sort of get to the point where they're able to have revenue and scale. So, yep, definitely doing it. And my team is super focused on that. I've got a few conversations in place with some climate tech lenders who can only lend to big projects and trying to get Tractor to allow them to do some of the smaller projects so they can actually get some more capital out. these huge funds, the CEFCs who have $200 billion on their balance sheet, it's very hard for them to write a $5 million check because they don't have the team to do it. So, try to figure out how we as our platform can get some of that money out into earlier stages into companies like that.
And one more question for Matt before we finish up. Oh, we've got two. We'll go two. Given I know Matthew well, go for it.
If you were starting off as an investor today, knowing what you know now, how would you go about sort of building deal flow and establishing the connections to get the right opportunities?
Yeah, I get this question pretty often. Stay in your lane and stick to your knitting. So there's something you know way more about than everyone else in this room. Go out and find founders that you can have an intelligent conversation with, and try and create a bit of leverage for yourself. So, my first portfolios were all dev tools that were selling to software companies, and I was a software developer, so I was able to understand the problem quicker than anyone else in the room, which allow you to build trust with the founder, gives you access to deals because you kind of understand the problem already. There's an inverse correlation between how less you know about something and how exciting it is. So if you actually know something and you can still be excited, then write them a check.
That's gold. Matthew.
All right, yeah, Tractor. So we do loans from 100 grand to a couple of million. It's usually 2 to 3 times your monthly revenue is over in a payback period of 24 months on average.
Sure, why not? One more. Sorry, Llew, wherever you are.
Good question. Yes, how do we
More
get out?
side stage, isn't it?
No. Tractor is funded. So we're funded by family offices at the management level, and we have a very large wholesale lending platform. So you can lend into our lending platform, which I can talk to you about, and that's yields quite a lot, paid monthly, 18-month term. And then at Tractor, we have shareholders who have supported us on the balance sheet. As we grow the lending company, we need to grow the balance sheet as well. So the answer is yes. Come and have a chat if you're interested in what we do.
All right, official last question. Ram.
Matt, well, going by your sticking to your lane approach, let me ask you a question about what is your observation on Australian startups looking at India? Have you seen any of your portfolio companies actively engaging in a dialogue about potentially wanting to go there? If they're going, what sectors you're seeing? If they're not going, why are they not going?
So startups going to India, that's the question? No, not certainly not as a motion, and certainly not more than 1 or 2. And it's, to be really frank, it's usually if the founders have a connection over there. It's probably unlikely to be as high on the list of places to go first, mostly because it's probably a long way away. And founders they like raising capital. They like to go to the States because it's big and relatively well known. So I imagine there's a whole bunch of things that are just unknown about it, and there's certainly not a lot of information flowing back in to suggest why that would be, except that there's obviously a lot of people there. So if you want to go to a big market, I'm sure they should go. But I can't tell you why it's not number 1 on the list.
Okay, thank you.
Right, Matthew, thank you very much for your time. Appreciate you coming. If you'd like to learn more about sort of Matthew's fund or investing in projects, please have a chat with him. All right. Shella, I'll let you do the introduction for Llew.
Thanks, Steve. Thanks, Matt. We have our last empowering keynote speaker of the day on how to globally scale your VC and alternative investments. So Llew is the founder and executive chairman of Sprint Ventures, an early stage VC based in Brisbane, managing 2 funds and 18 portfolio companies. He previously founded and managed the Reload Group, a major digital marketing agency with offices in Brisbane, London, and Manila, and later sold it to Hardy Grant Media in 2022. Llew also co-founded Alfresco, a prominent web, e-commerce, and digital agency that was sold to a consortium led by the ASX-listed SDW Group. Please welcome Llew.
It's good to see you still here. I'm literally the speaker between the door and your beverages, so I can see the eyes already saying you've got to be quick, so I'll be quick. My name's Llew. I don't know a lot of you, but there is some familiar faces in the room. And I'm here today to, I suppose, share Matt's wonderful wisdom about the venture capital space. Matt is a big supporter, and like him, we back in some amazing companies and founders that want to go global. In fact, we've got a portfolio company together called Submarine, and Matt's place is very important, just like your place in the ecosystem. A lot of you are angels, wholesale, high net worth, your family offices, you might be PE, and everybody has their place in this ecosystem. And I wanted to just take you through a bit of where we all locate, and it's all part of this ecosystem. And Matt gave money to Submarine, to Gavin Ballard, and then we came in the next round and supported him with a number of other investors. And then we'll all share in the spoils, as we were talking about in the foyer, now that Gavin is going global. And that's what it's all about. We're all in this together. So a bit about the Sprint team. I've actually done 2 exits. So when you're in the VC space, yes, certainly we want 100x. We're not all bad. We're not going to chop people off at the knees. And I'm here today to talk about social capital, not about financial capital. Matt's about financial capital, obviously. We're about social capital, and we're about the heavy lifting that goes on with startups. In our ecosystem, we built Sprint to be founders first. And founders first is all about giving that leg up, that hand up, to the truly generational founders that are going to move the needle and build a better future. So our motto is founders first that build a better future, and that's how we invest in the 18 companies to date across the 20 million that we've raised, and we're raising another fund you'll be interested in towards the end of this year, which is going to be a $30 million fund. So in VC, you either come from the startup or the software space. I'm an entrepreneur. I've done 2 exits myself. I've had hundreds of staff in many, many countries, and I've done those exits. And I call that the T-shirts. Or you come from the suits. And people like Professor Michael Drury, you might be aware of. He was the Chief Investment Officer of the Meyer family. He advises some of the largest family offices in the country, together with Dr. Adam Walk, who's the chair of Rest Super's governance committee. And a little bit of a point of difference about Sprint and how we've built our venture capital firm. We actually have what's called governance. And we have this thing called governance and risk. And we have a governance, risk and compliance committee that sits above our investment committee and actually handles the asset allocation of our behaviours and what we do within the ecosystem. And it's been cleared up. And I should actually say we're under the AFSL of Boutique, which is based here. So this is general advice only, and past performance is not an indicator of future performance. So just getting that out there, and please record that so I'm compliant. So some really good people on board, led by our managing partner, Georgia Barkell. So here's our investments, and we're about portfolio theory. We're about de-risking. We're not about that systematic risk or that market risk that kicks in when you guys do deal by deal. And I believe that portfolio theory is more important than ever in the current times. I actually dusted a year's worth of school fees in 2015 in an HR tech company that actually got me into this. And the reason why I'm here is because I dusted the 25K at the time, and I owned 1.2% of that company. And that company went bust within 6 months. And what it taught me, though, was that's a year's worth of my kids' school fees, and I need to actually de-risk this and actually put in place a portfolio of companies and not do this systematic piece where at the markets level, and if there's risk, there's going to be problems. And so, of course, like Matt said, companies are going to fail. But if you're in a family office, you're an investor that's going deal by deal, and you've got a couple in your portfolio, and you put all your eggs in that basket and not spread that risk, then you could come unstuck and lose quite a bit of money. Unlike Matt's super fund with the 0 shares, which is an amazing story. I love that. So what we've done was we've built the first fund to try out this new founders first model, and we invested in companies like Koshi's Ausbiz. We invested in companies like Plaza, Umps Health, Music Health, who are really growing well, Submarine, as we said. And one of our companies actually just returned a dividend the other day. And this sovereign seed fund had checks of 200 to 300K. It closed out last year in terms of the investments in 15 companies, and it was in pre-seed and seed capital. And that proved up what we're doing, and we've already had a company returning dividends. We then had a couple of companies break out, and we decided to build the Expansion Capital Fund, which has just closed. to wholesale sophisticated investors, but it's still open to instos, and there's institutional chats going on right now with that fund, and that is minimum check 500, and average check at the moment is about $1 million. And that's got companies like Paper Plane, which you might be familiar with, and UPay, Clipboard here in Sydney as well, and of course Vapor. So we invest in companies across 4 disciplines. And we invest them across the life cycle of the funding continuum. And as you know, as I said at the start, we're all in this together. We need you, we need Matt, we need the 5V capitals, we need the perennials, we need everybody after us, but we sit in that sort of middle ground. And VC is very important when it's truly active capital management, not just handing over financial checks. It's the experiential capital, the social capital, the network capital that all of you can provide as well. And all 75 of our LPs and investors are actually rolling the sleeves up and sit on the advisory boards and want to be part of that active capital. And so we sit just before the revenue generating stage of the life cycle. That could be pre-revenue, that could be that revenue, that pre-seed, seed sort of stage, and then the scaling up stages of the latter stage seed and the Series A. We generally drop out about Series B. We invest in 4 swim lanes, and that was a great point that Matt raised, and someone else raised it as well. Stick to your knitting. When we sat down and set up Sprint 4 years ago, we didn't want to go off-piste and invest in NFT sneakers or table ordering QR codes or things that we just didn't have any experience with. So we invest in AI and automation, which is a key pillar of what I've done for the last 15 years. Health and ageing, which is Heath. Property and energy and infrastructure, which is Ben. And finance and e-commerce, which is me and one of the other silent partners. And we stick to those 4 swim lanes. And 2 of them actually are post-Royal Commission. Financial Services Royal Commission and the Aged Care Royal Commission. And we've made investments in deep thematic areas that are important to the sovereignty of Australia and important to all of us moving forward. But we believe the alpha comes from the founders. We believe if you surround founders with great social capital, network capital, your experiential capital, our LP's experiential capital, they're actually going to provide that ultimate alpha towards the success and the return. And I think that's really important. And the other piece to that is building up trust. Building up trust that we're actually going to be there through those hard times. And we're in those hard times right now. We're having those conversations at the board levels about paring back. And everybody should be doing that. We should be actually reorganising and re-energising what we're doing and the directions we're going in. And the prudent companies have already done that. They've been on that pathway for the last 12 months. So there was another question. There was another statement about deal flow. And the funnel is really important. A lot of family offices that we meet, what they do often is sort of grab a young lady or a young fella straight out of uni who basically becomes their VC desk in their family office, and they put them into the desk and say, go out there and get us some VC investments. And unless you're plugged into the ecosystem, like we've been for the last 15 years as mentors to the places like River City Labs with Steve Baxter, to doing a lot of the nights at Stone and Chalk here in Sydney, to sitting on a lot of the StartMate pieces, the remarkable things that are going to be happening tomorrow. We're mentors for a lot of these places. Unless you're plugged into all of those accelerators, incubators and startup system enablers, it's very hard to find those early deals. But when I say deals, I'm actually talking about the founders. Because you actually meet the founders 2 to 3 years before they actually set up the successful companies. And even if they set up a great company, they might actually pivot and go into something completely different. And that's really cool. We don't mind change at that early stage. But what we want to know is those truly great founders have the resilience and the grit to actually make it. And so we bring them through that funnel. And the ones that get to the bottom, we invest in 1 in 100. The ones that actually get to the bottom of those investments have been through that process with us and actually gone through, it's a bit like dating. They've gone through those hard times, those easier times, the coffee catch-ups, the lunches, the meeting the LPs, put in front of other founders within our network. And really what they're doing is proving that they actually have the stamina, like an entrepreneur who can, get through the 10 years of building a business does as well. So really important, finding those unique investment opportunities and then bringing them through an investment process. Now, buy, hold, sell, we all know that, 101. We call it acquire, mentor, value realization. And that's probably a better way in our world to distinguish that investment process. So pre-investment, we're doing a lot of the sourcing of those opportunities, as I mentioned. You're doing a lot of initial DD on the founder, their behaviours. We do a lot of psychometric testing. We do a lot of behavioural testing. We use HR, if you want to call it that, within those founders. And a lot of direct investors that are trying to find these deals direct just don't have that capability and that wide network. The other piece we do is we have consultants that go in and do audits on their AI. There was an article today about that Metagy. If you've been following it in the AFR, the CFOs come out and said actually they weren't doing AI. They were doing sort of a different, just a basic 20-year-old form of calling up and querying. So there's, AI is a good one. A lot of these startups that you're looking to invest in actually truly doing artificial intelligence, or are they actually doing machine learning, or are they doing just a chat GPT? So really interesting. We then go into actually closing out the deal. And then number 6 there, the next level value creation kicks in. And that's that mentoring. To get to value realization, you actually need to have deep mentoring. You need to actually roll your sleeves up. And look, that's a key thing for everybody. Even if you don't invest in VC funds, it doesn't matter. You actually need to roll your sleeves up in these times on all your investments and really help them out. A lot of you sitting in the room are very successful. A lot of you sitting in the room have been through it. There's a lot of grey hair and no hair like me. And so I think that, take that active management and dive in, because you're going to get better alpha and financial value realization from it. So the different forms of capital really quickly. Capital is really important. As I said, it's not financial capital. Financial capital should be the last on your list. The check should be the last thing. It's the first thing in, but it should be about the experiential capital that you bring, as I said. It should be about the social capital in your networks that you can introduce them to. Give them their first customer. That's really, really important. And I've got some examples here. And then, of course, it's about that human capital and that real opportunity to sit as an advisor on their boards and create governance and things like that. But what I wanted to really quickly show you is some of the direct things we do for some of the founders right now. And we use innovation science. And this is like, you probably think our VC funds, they kick back, they take their 2% a year and off they go, just waiting for their 2 and 20, their 20% return. And, they go off to lunch, in their big yachts and all their planes. I haven't been paid for 4 years, by the way. We don't take a wage. We're on performance. So you'd be pleasantly surprised. What we do is we go in with the strategizer models from Switzerland and actually do innovation science. And we come in and we do complete test and learns, and we use these sort of models here to actually build, measure, learn on different stages within the business. And I think that's really important, that you constantly iterate, you constantly innovate within these companies. It's not just casting the founder out. You want to actually interrogate, especially in these times, whether actually they're on the right track and use innovation science with their hypothesis to see whether the desirability, the feasibility, and the viability of the business models is actually there. So you can see how deep we go, and this is all for free. We don't charge a cent, because this is what truly is active capital management. And these are some of the processes, as I said, that we use, the human-centered design approaches, the culture of prototyping, and we introduce these behaviours within the startups. The other thing we do is we hack business models, and we actually say the model you go in with might actually not be the model that you come out with. There might be a freemium model, there might be a rent instead of the buy model, there might be subscription models, things like that. There's all these different models that come up, and we actually then do some test and learns and build, measure, learns on those as well. We've got 1 minute left, so I want to give you a couple of quick case studies of actually the benefit of true active management from a venture capital firm. Halo is one of our companies from Melbourne. They're in our Care Factor Aged Care Accelerator that we ran in 2019. They won it for Australia, and we invested a check alongside Social Ventures Australia into Halo. We actually introduced them into the CEO of Anglicare Southern Queensland, and they picked up a very large contract this year through that direct link, that network capital through our former chairman. Paper Plane Simone, chair of FinTech Australia, is just jumping on a plane with her 4 kids, and basically we've been providing the opportunities because one of our directors set up Tritium and got them domiciled as a Delaware C Corp before they did their listing, and they're the electric chargers. So we're an investor alongside QIC, MasterCard and Cusco. We're the only VC fund in the last round because of that social capital that we can unlock. And that's helped them scale into New York. Health out of Melbourne. This is AI for Falls Technology. Adam, one of the really great founders. I interviewed a future CEO this January in London. I happened to be in London, but I did a side trip to go and actually meet and introduce and really work out whether this person who will become the UK CEO was the right person. So really, going off away from my family, from my holiday, to head to London and meet him in the Strand to actually, really work out whether this is going to be the right person, and it was. And the final one is UPay. I'm on the board of UPay, and we built the governance function for UPay and helped them scale into the US. But we got Deanne Kettler on our board, who was Australia Post. She's now Tyro. And we also got Amanda Beard, the sister of Simon, who's the founder of Culture Kings, who is also an investor in UPay. And these are little companies that are out of their bedrooms and things like that we're scaling globally just through our connections and what we do. And I just wanted to highlight a few things. I'm sure there's a lot of people in the room that can do the same through their investments and their scale opportunity. So that, in summary, go to sprint.vc. We're raising our third fund at the end of the year, another seed, Series A and growth fund. And yeah, I'll be out for a beer and look forward to catching up. Thank you very much.
Thank you very much, Llew. Great talk. All right, everybody, that concludes Venture and Capital for 2023. As I said, I strongly encourage you, if you're interested in coming with us to Singapore, we'll be there on August 31st. Said Singapore, every time we go there, I feel like it's one of the most special things I do each year. As far as from an event perspective, there's just something about it. But once again, I want to say thank you very much for everyone for coming today. I want to say a big thank you to the companies that participated. What I love, I mentioned what I love about what we do is creating opportunities out of thin air. I said everyone could have been in a different location today than actually here in this event. The reality is the second part to it is I love how passionate and hard. Like Llew was joking about how as a VC he's not sitting on his yacht, having long lunches, which is disappointing for me because as an ambition standpoint, it'd be nice aside from the punishing 16 to 18-hour days. Aside from that. But, what's really nice is these guys, how hard everyone has worked over the last 12 to 18 months, right? The one thing is everyone knows how challenging this market's been, but actually the reality is the last 2 months, I've definitely felt a sense of change in the air and a change in momentum. The other part is you just won't hear the founders talk about it unless you really get to know them. The reality is the optimistic nature of what they would have had to have worked through over the what someone describes as challenging. So you have no idea what things they've got done in the background and what's happened in the background for them to make sure that they've been able to continue momentum with their business, raising capital, achieving milestones, etc. And that is what makes the people behind the companies truly exceptional and go beyond belief. So, as hard as everyone works to try and do a succinct presentation within 8 minutes, and sometimes people's presentation skills are better, sometimes are worse. The reality is you're dealing with a human being that is working relentlessly to build that business. And when they're not on this stage, they're working day and night to build it, and sometimes, not the social outings are gone, the family outings are gone, and said people will never understand the real price of actually building a business. And that's why that's why I love to champion founders and their ambitions. So again, thank you everyone for coming today. Really appreciate you being here. Have a great afternoon. Enjoy the drinks and networking. Thank you.